If you are a swing trader and you are looking to get funded, then check out today's video sponsor, Ola Prime. Ola Prime has a challenge built deliberately for swing traders. Check this out. The Prime Challenge offers the ideal setup for swing traders with leverage up to 30 times. They also allow news trading. Weekend holding is also allowed. They offer up to 95% in rewards, and they have a 100% challenge fee refund available if you are able to complete the challenge. I know that a lot of people who watch these live streams tend to be more swing trader focused. So when looking for a partner to sponsor today's show, Ola Prime stood out as a perfect candidate. If you'd like to check out Ola Prime for yourself and get a live stream discount, then check this out. Simply use the promo code A1Live, that's A1Live, for 35% off any of their challenges. As always, make sure to do your own due diligence to see that this is in fact the right firm for you if you are looking to get funded. All the information will be now dropped in the live stream chat or in the description down below. Now back to the stream. If you are a swing trader and you are looking to get funded, then check out today's video sponsor.
Hey, good morning, everybody. Happy Wednesday. Happy FOMC day. Let's see what we've got for this morning's news. So we had PPI this morning drop, core and monthly. Let me take a look at Bloomberg calendar. See if there is some year-over-year prints. Let's go just Wednesday, 8:30 drop. Nick was feeling a little bit under the weather this morning. I'm curious if anyone's looking, 8:15 start. Why'd we start late? Nick's not feeling too hot this morning, so hopefully we'll see him back this afternoon for FOMC. But today, PPI dropped this morning. Month over month, we had 0.3 expected, came in 0.5. Previous was 0.8. Year over year, this is what I pay attention to the most. Revised from 3.6 down to 3.5. Forecast at 3.7, came in 3.9. So a little bit hotter print there for PPI. Year over year, headline 2.9, 2.9 came in 3.4. Certainly way hotter producer price index than before. Excluding food, energy, and transport, revised up. No forecast. So again, slightly hotter print. Futures market down a little bit this morning. This was up about 0.3%. Starting out the morning. Let me go to a smaller time frame here. Let's go to the 15-minute time frame. So just in the last maybe 30 minutes or so, this market is dropped a decent amount. We had a peak here around 2 in the morning. Just in the last, there's a pretty decent drop around 7:15 a.m. Eastern time. So the last maybe hour or so, we've had a quick turnaround of about 0.8%. Wow, that's a pretty substantial drop in futures. We'll see if the trend holds. I mean, structurally, this is kind of a situation where I'd like to get out of the market's way and try to fade this. I know we have FOMC this afternoon. I still think if you're looking at the charts, technically, we're still in a big stuck range. I mean, I know my charts might be a little bit messy, but I'll make some sense of it here in just a moment. So here is what I'm looking at on the daily time frame. Let's go weekly first, actually. Weekly time frame. Still looking for a potential breakout. Measured move around 65.50. Top side measurement around 72.20. And the market is making these slightly lower highs, slightly lower lows. Big target here around 6,500, 65.50. Same thing we had with this October 10th, November 20th candle. This is part of me wants to just fade everything right now. There's a couple decent trades I was talking about these last couple of weeks, or I've been trading. A lot of it is this. I mean, I trade this type of move every single day, which is I have the brokers. They give me the expected move for the day. I'm kind of using that to my advantage. Where yesterday the market was up, and I sold some bear call spreads. It's an option trade where basically I say, here's the line in the sand. Don't go above that price. And you can get a sense of that every single day with what the brokers give us as an expected move. That was the print yesterday. Today it is 53.60. We're going to be opening a little bit softer. This will be a gap adjusted indicator that I have every single morning. So I will update this. This will be over here with a new day, 53.60. So it's not going to be a huge change. 53.60. And then I'll make this gap adjusted. So 53.60. And then those green lines I usually just put on my charts once I establish my trade. That way I've just got a quick visual reference on what to monitor for the morning. And with FOMC, couple things here for today, right? VIX is off the lows a little bit. Do I want to go long VIX at 21? Not really. Do I want to go, short VIX at 23? Not really. We've been dealing with a lot of elevated VIX. 20 seems to be now a low VIX. If we break to fresh lows, 2150, we break the 20, get into the teens again, then that's fuel for the market to continue to head higher. It wouldn't surprise me off the last, several weeks now. Let's go to like the 1 hour chart in the VIX. Look at this thing. I mean, just an easy climb, higher lows and higher highs. Again, I don't really look at the chart and say, oh, the VIX is going to be in an uptrend. It's like, I don't trade it like that. However, we are making higher lows and higher highs. 20, is it a round number? 20 to 21 round number where it holds and stays elevated. We still don't have this this conflict in Iran tamed. The timeline, we're still here in 4, 5, 6 weeks. I did share this with Nick yesterday. Somebody created a pretty interesting dashboard. They basically gave all of these geopolitical factors to AI, and I think they use Grok, they use Gemini, they use ChatGPT, and a couple other ones. Let me see if I can find that from the message I sent Nick. All right. So this is what to expect for the U.S. economy week by week, and the factors include gas prices, Brent crude prices, S&P 500, U.S. GDP quarterly impact, U.S. CPI inflation price, and consumer sentiment. Let me just take a screenshot of this so I can share this with you. Okay. Now, I'll take it with a bit of a grain of salt. I mean, it is AI. It's not 100% anything, but thought it was an interesting read where, okay, we're in now week 3 of this conflict. Okay. If this persists and continues out to week 8, going into the middle of April, see what this zoomed in. This says downturn. So we've got week 4 contraction, week 5 shortages, week 6 looks like crisis. Go over here. Yeah, week 6 crisis, week 7 recession, and week 8 downturn. Okay, anyway, let's just look at some numbers. So here's where we're at week 3. Gas price, AAA, $3.80 a gallon. If it's forecasted to go up, airlines and trucking surge, $4.20 a gallon, $4.70 a gallon. I mean, I know that everyone is sensitive to this, right? U.S. inflation, what's sticky? Energy prices. Nick and I talked about this quite a bit last year, which was one of the big thanking points, or one of the thankful points of our inflation readings last year, despite having the longest government shutdown in history, is that we had low energy prices. Energy was on nobody's radar last year. Oil prices were on nobody's radar last year. I did talk about being long oil. I had a oil futures long trade. CL was long from 55. I had trades at 52.50 and $50, and I benefited from this big squeeze to the upside. Did I expect it to go up to $120 a barrel? Not really. Do I expect to be in a Middle East conflict? Not really. But technically, I was long. So anyway, I think it just paints a picture like if this continues to drag on, things are going to get worse. Right? Gas prices going up over $4 a gallon, instantly felt by most Americans. Grocery store prices pay at the pump. Brent crude, we're going to get over $100 a barrel. S&P, what about the correction territory? We've already had about a 6% correction from peak to trough. Our market breadth is actually terrible. I looked at this yesterday. Market breadth is terrible right now. I think we have like less than 40% of stocks in the S&P above 50-day. And even the stocks above the 200-day are starting to deteriorate as well. They're under 50% now. So we technically don't have a bull market. We're not even in correction territory. So, again, this could all change. Like we could have a surge to the upside. But, if U.S. GDP is impacted, CPI, all these things that would come in for your major news headlines, and sentiment just getting way, way worse, right? But the model here, this is a Gemini model forecasting 95% probability of accuracy if this is accurate with numbers. So anyway, thought it was interesting. Take it for what it is. Take a screenshot if you want it. Am I trading off this? Well, all it means to me is if things continue to escalate and drag on, I can't see this is going to be a good sign for stocks. Now, that being said, how have I been trading this entire year? Okay. Outside of having the run in gold and silver, this market, I've been trading primarily all the way down here. So we start out with all this churn, all this dispersion. I do have some stacks in here from like 62 to 6,000, and that's about a 10 to 12% correction from all-time highs. So if we get a correction down to that previous all-time high, that would be peak to trough around 12%. I mean, 12 seems like a rare number to get like, oh, that's all the correction was, peak to trough. I mean, 12 can probably become 15, right? 12 becomes 15, 12 becomes maybe 20. Do I think there's decent technical support way out here around 58, 57, 56? Sure. I saw a forecast yesterday. Somebody, I think Reuters was forecasting 75 or 7,600 end of the year target. Okay. I mean, I've also seen targets down to 4,500. I've seen targets up to 8,000. Nobody knows what this market's going to do. It is not looking great, however. So if you are a bull, and I know that I've said this all year, I know Nick is seconded this, it's cautiously bullish until price shows us otherwise. We're sitting right around the 200-day moving average. Could it break and go lower and get worse? Sure. That's a caution sign for sure in this market if we're breaking below this 200-day moving average. So a couple of places to look. October 10th low, November 20th low. If we poke that same level, I could see price testing that level, bouncing off these areas, and then going right back up. So if we hit and head higher, then this is kind of a contained correction. My concern is that we, test this low, go up, and we have another leg lower. That's my bigger concern, is that this would be some type of dead cat bounce or a lower high, and this is where most traders are going to feel the pain. Most traders feel the pain. It's not that first flush, it's this follow-through flush where most people feel the pain. Right? So that's my just technical outlook. I mean, we get back into like 6850, 6900, then my outlook changes. But right now we are what I think certainly a bit of a weakness window. This rotation continues. Here is the market breadth that I've talked about. So here's S5 FI for the stocks above the 50-day moving average. This is really bad. Okay. Now, when we started out this year, you can see that we had about 60 to 65% of stocks above the 50-day moving average. We had that massive rotation, leaving Mag 7, big flush into energy stocks, big flush into consumer staples, big flush into industrials, materials, right? Even financials had a pretty good start to the year. Financials have been hit hard recently. Private equity concerns. 60% has deteriorated now down to 34%. Now, typically, I use this indicator. S5 FI is how many stocks on the S&P are above the 50-day moving average. I use this indicator as a timing measure because if we can get this thing down to 10, 11, 12, even sub 15, I tend to use it as a timing indicator to buy the market. And maybe that is what's happening. Maybe this dispersion is happening in front of our very eyes and underneath the hood, where maybe we do drop to 15 on this market breadth. I mean, in years past, if you see these lows, they've marked pretty significant buy opportunities in the market, with the market obviously going to all-time highs. This one here, like June of 2022, was that a bottom? No, the bottom was actually October of 2022, but it was a decent leg in, considering the market did break out of October lows, headed into a nice 2-year bull market essentially from 23 and 24. We still had a bull market 2025 minus the peak to trough at 20%, right? We hit all-time highs. Same thing over here. Here's your September 2022. We marked the low within 30 days of that. Here is a October 2023 that marked about a 10% correction in the markets, and we had another strong finish to the year. Here is Liberation Day. I was synthetic long. I was long SPY, long Qs, long Russell. I was long everything during Liberation Day, and that was like within, I want to say like the low was the 7th, and the burst higher when Trump had tweeted or put on Truth Social, it's a great time to buy. That was April 9th. And I remember that because that day pretty much made my entire week, and that gave me the confidence to think like, all right, this is a self-induced correction. I think this is going to be the bottom is coming sooner than later, and it was. I mean, like I said, this was. You can zoom in here, see that these lows. This was April 4th. Here's April 7th and 8th. I mean, if you look at a chart how this correlates to the S&P, you had a fantastic buy signal. Granted, was it the exact bottom? No, but probably within 3 to 5% of the lows. After a 20% correction, getting that thing within 3 to 5% of the lows is pretty accurate, right? And then, of course, the rip all the way back up here. I mean, you could have enjoyed that run from bottom in April all the way to literally November, December, which made for a pretty good year, right? Here we are, in the middle. Deteriorating market breadth, not a good sign. 34% of stocks below 34% of stocks above the 50-day, which means we have 66% of stocks below that. Go to the 200-day moving average. It's not much better. We're right at the 50% mark. So 50% of the S&P stocks are right at that threshold of a buy or sell zone, 200-day moving average. So what happens if market breadth gets worse? Bigger corrections coming? Maybe. Short-term pain for long-term gain, maybe. Right now, I guess I'll just ask the audience here. We always have a good crowd here for A1 Trading. How many of you think that the market is going to finish the year lower than where it started? Let's go to SPX. Let's look at the yearly chart. Okay, we're down for the year. Here's the 12-month candle. S&P is down for the year. Okay, the open, 68.47. So my question is, will S&P be higher than 6847? What do you think? Type in higher in the chat. Type in lower in the chat if you think it's going to be lower. I mean, it's been a bit of a battle already this year. And, it feels like a freaking bear market. That's what's so crazy. It feels way worse than it actually is. I mean, year to date, I think we're down. You see if my sector performance shows S&P year to date. S&P year to date, I think we're down 3-4%. So S&P change year to date. It shows down 1.5%. Is that right? Yeah, I guess if we start, that's right. That's right. Because we started at 68.47. So we're down less than 2%, But yes, we've had about a 6% correction from the recent all-time highs. We're down about 1.5%, 2% for the entire year. But my gosh, it feels way worse than that, doesn't it? So anyway, what do we have? Higher, higher, lower, lower, higher. PPI green as a leprechaun. For now, lower. Yep. I just think the bulls have a lot of fighting. I think now that we're getting, more time in the markets, more lower highs, lower lows in this recent spell, the last maybe 3, 4, 5 weeks. Since we hit a top here in the end of January, this market has had lower highs and lower lows. Okay. So what I'm saying is I think the bulls are going to have to work a lot harder to get this market back into 6850 to 7,000 plus territory. Now, what also causes these reflexive rallies? Bounces, pullbacks, corrections, right? All of the frothiness of, think about how many people started out 2026 as a bull. I'm bullish, I'm bullish, I'm bullish. Even though I hated this chart going into 2026, you want to see what the power of these markets are. Look at this reflexive rally. Let me change the color here. Look at the power of this reflexive rally from Liberation Day to all-time highs, right? And then, I'm drawing like a really solid textbook rising wedge. We break right to that. This is why I don't think the rising wedge pattern is the real deal. I thought it was for a second, but I've never seen a rising wedge pattern take this long. So I'm just going to go ahead and say that the market is using this area right now, technically, as distribution. Okay. One thing I need traders to be cautious of, or at least mindful of in 2026 is this does not mean that it is a top. Okay. This market, famous saying, can remain irrational longer than traders can remain solvent. I could totally see this market using this area to get this dispersion trade over with, take away some of the frothiness, sentiment climbs higher where the bears are in control as far as sentiment goes. data under the surface is looking worse and worse and worse, but yet the market won't break, right? And so could I see the market, testing and going back up? Sure. Can I see the market going gangbusters higher? Not necessarily, but if we do, here's what I would think. If we bounce off of this low, a couple of ways I see this price action playing out. We bounce off this low, we head back up for a lower high. If we have a flush lower here, then I'm a bit more concerned, because that means, are we going to bounce off this level, or are we going to have another lower high and lower low? And then we're talking about key support in here. We're talking about 15 to 20% corrections from these recent highs. This level, if you break below 5,400, if you've maybe heard the phrase fourth turning, that's going to be your catalyst slash maybe narrative around why stocks are so bad. This is going to get way worse. This would be, retesting April 2025 lows. There's your, 30+% correction in the indexes. Now, look, all that being said, if you have the cash or the dry powder to scoop up some discounts down here, it's not going to be fun. It's going to be painful. It's going to suck to see the market down that hard. Okay. But the big picture of building a position here, going back to these highs eventually, I'm not saying instantly, I'm saying eventually, it offers a pretty good reward on risk, right? Could it get uglier? Sure. But my point is, for right now, things seem to be pretty well contained. I do think there's some interest in here. I just don't know what catalyst the bulls need outside of end this stuff in Iran, see data come back. We have to kind of sprinkle in the optimism again in the markets, which isn't happening. But watching this support level closely, lower high, lower low, like I said, concerned about that. If this area doesn't offer strong, like very strong support to get us back to highs, I have my concerns. Okay. Before we put in a major top, by the way, I would not be surprised if this market finds a way to look at this kind of organized correction, breaking the structure. If the market rallies back up, it wouldn't surprise me if we do this inefficiently, even going higher than people think, only to have another distribution and a rollover. One thing that happens in stocks and indexes is typically when they form tops take a lot longer to play out. Individual stocks, maybe not so much, but typically in indexes, a lot longer to play out for tops. I mean, this top took 3 months. Okay. These corrections were short-lived, but they were corrections. This one, July to October, July, August, September, October, 3-4 months to play out for a rollover, right? This correction, I mean, we're talking, even though this was, high to low, pullback, high to low, pullback, lower highs and lower lows for 10 months, took a while. That peak to trough was like 25 to 30% in 2022. Okay. COVID, a little bit more of an exogenous shock to the market. Even though COVID was known about in December of 2019, the market used it as the excuse with a lot of other stuff to be bearish and kind of wrap that into like a 60-day window. That was definitely more of a shock. Anyway, Volmageddon event, that's very short-lived. So where are we at? Well, cautiously bullish. We still haven't had breakout levels hit. We're sitting around that 200-day moving average. Take a look at the indexes here. Here's opening bell, closing bell, 9:30 to 4 p.m. Have we hit the 200-day moving average yet? Not yet. It's around 6,600. Could I see us hitting it? Sure. To me, this is a pretty ripe target. If we have these lows as well as that 200-day moving average, I could see the price coming down to find that, which is why I'm pretty aggressive, like day to day, trying just to short the market. And I'm doing it, day by day. I'm using brokers' expected moves. I'm not trying to be a hero here. It's like I'm not trying to get in here and short every single day, because obviously this week the market's been up and gapping higher and then chop, up and gapping higher and chop. So what I'm looking for is, this is why I trade options so much, because all I have to do is establish a line in the sand. When the market opened yesterday, I sold calls right up here. Did price ever threaten my calls? No. What happened the day before? Price gapped up. I sold calls. Did I get threatened? No. Over here, market gapped up. I sold calls. Did I get threatened? No. It's been a really nice trade almost every single day. Okay. Even here, market gapped lower. I sold calls. Market gapped higher. I sold calls. Market gapped nowhere. I sold calls, right? It's like I just stay out of the way. So it's been pretty solid, pretty consistent. The one thing I'm looking at this morning is we are higher on the VIX. So give or take, I mean, it's an FOMC day. This should be a bit of a nothing burger FOMC because everyone knows nothing's going to happen. There's actually nothing expected to change from the future side in the watch tool until literally the end of the year. And we still have to deal with Powell. Like, he's going to be the press conference guy today. War steps in May. I don't know. I almost feel like the Fed is on the back burner for Donald Trump right now. Maybe it's not. Maybe it'll be important today because it's Fed day. It's important in May if we have a new Fed chair. But the probabilities here, all pauses. And this goes into October. If there's a cut right now, the highest probability of cut is once, and it's December. Okay. And then what? They cut once and then don't do anything for the entire year 2027. So, is it subject to change? Yes, obviously. We've seen the Fed fluctuate a lot these last couple of years with how many cuts they're supposed to have. And if they're not going to, when are they going to cut? Inflation. Here we go. Nothing's expected. Nothing for March, nothing for April, nothing for June. I mean, these probabilities are very high that nothing would change. At oil prices at $95 a barrel, I would imagine it's silly to cut rates right now. Okay. But does that mean we have to raise rates? Not necessarily. We can just hold, I guess. And that's what it looks like we're doing. So, I mean, the Fed kind of gets boring in this standpoint, but it is always one of those days where there could be added volatility. One thing to keep an eye on for today, VIX is 2369. Could it go up for the day? Sure. If the VIX goes up, that means prices are probably going down in the S&P. 23.7. I'm just going to go 2375 divided by 16. I'm going to put it out there. This is a forecast for this morning based on a 2377 VIX. Okay, 2375 VIX. A 1.5% swing today. Now that should be on the extreme. Okay, I have an indicator that I built here that basically this yellow box represents the VIX rule of 16, which is you take the VIX value, which is right now going higher. It's actually going higher this morning. And we're down 0.55%. So we're going to have a gap lower this morning. But you take the VIX value divided by 16. That should give you a good estimation of the extreme of the day. The hard thing to do is when the VIX is going up. If the VIX is going up on the day, it's hard to call the bottom. Okay. But that also means it's a good opportunity to sell calls. It's a good opportunity to fade. I mean, fade whatever move we have. So we're going to gap lower. Let's see what happens. My gamma levels are going to be all over the place. We're going to be opening up in negative gamma this morning. Look left on your charts. We did poke some fresh lows around 66.24. We had previous lows before that. Same thing, right around 66.37. So a couple of lows getting poked. Could we revisit that today? Maybe. Do we pull back and wait for the Fed? Maybe. Do we have some gaps? Sure. I mean, there's a gap here to be filled. There's a gap here from Monday to be filled. Right? If I go plus minus 1.5% from yesterday's close, okay, that gap fill is about 0.9. That gap fill is about 0.1 or 1.2. So we go 1.5. That's my extreme VIX. Could we break fresh lows today? Possibly. So, that's the hard part about, I mean, it's not the hard part. It's just you prep, you plan. This is what I do every single day. If I'm going to take a trade today, I've got to have a pretty good idea of where prices can go. Okay, so we're going to open up softer when the S&P kicks in at 9:30. We'll open up softer. Futures are down. It typically isn't a front run the Fed type move. Futures down. Let's see what the market actually gives us from opening bell. But most of the volatility today is going to be wrapped up in 2 p.m. to 4 p.m. So I've got a plus minus here on 53.6. That's what the broker's showing as an expected move. With the VIX going up today, I would suspect this is very possible we go higher. We've had a VIX kind of, I'm not going to say, we've had a retreating VIX. We haven't had a reset. A 35 VIX is legit, right? Like that's a pretty high VIX. I sold a lot of premium in the 30s, sold it up here towards the 33 handle as well. And again, a lot of my trading has been selling premium all the way down to April 2025 lows in the S&P, the Nasdaq, the Dow, the Russell. You've seen that in my alerts so far this year. Individual stocks, same thing. I take the April lows. I'm looking way left on the charts, going way out of the money and creating some nice steady income trades. I'm hoping that the market just maintains some level of resiliency, doesn't just crumble. And if it does that, we should be in good shape. So, all right, let's take a quick look at oil, gold, silver, and then I'll let you go for my segment, and then we'll turn it over to your next host for the day. Oil is up 97 and change. We're up on the day about 1.3%. Take a look at the smaller time frame here. Okay, so let's, this is the same thing I saw happening in gold. You had that big shakeout. If you have low, high, higher low, higher high, could we put in some type of topping pattern? Technically, this could be a nice little Gartley pattern. I wouldn't be shocked to see, if this is the case, I wouldn't be shocked to see oil get back up to, let's say, 110, 115, fail to take out the high. But if it does that, that could be a decent spot to put in a top, is not taking out the high, fading oil back down. But I would not do this with bravery. I would do this with defined risk. Don't try to be a hero. I wouldn't bet the farm on oil. Who knows what this is going to do? Could this blow through the tops and go to 130, 140, 150? Sure. So, define risk. Do not take a massive stake in oil. This is not the type of oil behavior that most people see. This is, I would say, a pretty historical year of something that's this is going to be on the talking points for all of 2026. Remember what happened? Yep, oil went up 70+%, right? Actually, more than that. If you look at oil where it was, oil is up. There's a run of 115%. That's crazy. Okay, here's gold and silver. Gold is falling. This is why I said the technicals. This was on my chart, a month before it happened. End of March, gold showing signs of correction towards the 200-day moving average. Looks like I'm getting it. We put in not only this major impulsive move, but we had that measured low, high, higher, low, higher, high. I put here Gartley symmetry, nice little turning point to short gold, and it's heading lower. Am I short gold? No, I'm just waiting to buy lower, right? I'm waiting to buy lower in here. I like gold in the big picture, but I hope that it comes back technically, finds my levels, establishes some, honestly, I love the idea of 1, 2, 3, 5 year position on gold. If I could start this at a nice, 30% correction, I'd love it. Silver, they're just going to follow hand in hand. I think if gold makes some equal lows, silver's probably going to do the same thing. I like buying silver in the, sub 60, love it at $50+. And we'll see. Does silver hit 50 and go back to 120? That'd be a hell of a trade. If it is, awesome. If it's not, okay, but I'm still going to buy it. Even if we go from 50 back to 90, 50 back to 85, 50 back, I'll still buy it. But I like gold. So hopefully I'm right in this technical stuff. It was very hard to be patient through this, but hopefully that patience will pay off here from the technical side. All right, good stuff. Let's wish Nick a speedy recovery. Are we wrapping up here for my segment? I'm not sure who the next host is for the day, but take a look at live stream schedule. James, I'll turn it over to you, and I'll be back this afternoon for a little FOMC preview. We have FOMC today at 2 p.m. Again, rate decision is supposed to be a pause, but we do have a press conference. Watch volatility. Futures down about 0.5%. We'll see where that goes. French Bulldog there, Vampire Doggo. He's a Frenchie hanging out in the lap. All right, James, you take it away. I'm going to pop over to my next session, and I'll see you back here this afternoon in a little bit. It's a cat. Now, he behaves like one.
Hey guys, I just wanted to jump in for a second and let you know a little bit about today's live stream sponsor, DNA Funded. DNA Funded has very generous profit sharing, up to 90%, and 3 different unique challenge types. For those looking to get funded, they also have speedy payouts, unlimited trading days on the first and second phase of their challenges, a very wide list of different things you can trade with over 800 different assets tradable, and maybe the most important component, a very experienced team behind the whole operation. So if you're interested in learning more about DNA Funded, click the link, check it out, see if it's right for you, and make sure to do your own due diligence to see if what they have to offer fits your trading style. For 20% off, you can use code A1T20. Again, that will be 20% off any of their challenges you'd like to check out. Thank you again to DNA Funded for sponsoring today's live stream. Now back to the show.
Hello everyone, welcome to my segment. You'll be seeing a lot of me today because unfortunately Nick has a fever. So I'm gonna jump in 2 times and then I'll do the Fed commentary as well. Okay, let me just check at what time, if we go to Gemini, what time EST does the Fed press conference start today? Just for me to check the schedule. So I know according to my time, it is at 19:30. That is going to be 2:30 p.m. EST. Okay, sure. So before we get started here, giveaway time. So if you want to participate in the DNA funded giveaway, where's my form? Here it is. If you want to participate, fill out this form, okay? And you will get entered into a DNA giveaway. Now, I'll be doing a giveaway in probably like 10 or 15 minutes. Alan will also be joining my segment in 10 to 15 minutes, so stay tuned for that. Now, jumping on to the markets. So, I have a small position on the Euro Swiss, which is just around break even. This is basically a bet on a possible intervention out of the SNB, which is of course, the Swiss Central Bank, Swiss National Bank. And I just took a position on US oil. I know I copied Nick, but essentially I think this is a pretty good position, so I wanted to be in as well. My stop loss is a bit bigger, so a bit larger than what Nick is using. Main reasons to take the position are the edge finder, which is bullish. Okay, so the edge finder is bullish. Then you also have the conflict between US and Iran, which is not slowing down. What I'm seeing is just sort of an escalation or a stagnation. There's definitely no de-escalation. So as long as the Strait of Hormuz remains closed, as long as there's no de-escalation, oil prices will just keep on going higher. And here is a projection that I found. So this is from Andrew Campbell's Substack. He's a pretty good macro analyst. He used to work for Ray Dalio, I think, under his hedge fund. So he posted this in his latest article, which is the estimates from Bloomberg. So the Strait of Hormuz being closed for 3 months would get crude oil up to 164. So you can see the pre-war path was pretty flat. Then you have Hormuz closed for 1 month, 2 months, and 3 months. So you can see we should definitely get back above the 100 level. So we should definitely see oil get to 104, 108 maybe. And then if it's 2 months, if it's 3 months, you get the idea. You know, we can go to 160. The median sort of would be kind of maybe 1 month and a half, 2 months before they reach some sort of an agreement. I don't think it's going to be like 3 or 4 or 5 months of just straight closure of the strait. I think they're going to find a way to reopen it and let some ships through. Before they do, oil, I'm betting that oil could go up. So I don't have a fixed take profit set. Entry is at 939. Stop loss 837. Take profit not yet in place. So pretty much trailing the stop loss and betting that we could hit this sort of high right there. It's not, I don't think it's the all-time high. No, it's not the all-time high, but it is sort of the session high for this chart. I mean, on this daily chart in the last couple of months, this is the absolute high. So if we have a pretty big trade, so 2.4 reward to risk, which is pretty nice. Okay. So, too much following, Marco analysis paralysis, all trash. Anybody can write stupid articles. Yeah, I mean, well, you have to filter. You know, you have to filter. First, Ballot, thank you very much for the kind words on this morning. But you have to filter through it. There's a lot of crap on Twitter. There's a lot of crap online. So you have to look at the credentials of the people that are actually writing the stuff. Where have they worked? What people do they know? what are their resources, what are their sources, what is the track record, so have they had pretty good success in the past. I mean, the internet, pretty much every single piece of data you can find on the internet if you look hard enough. So if you can filter the people that you look at, you can get some pretty good ideas about possible positions. Nick is one of them. I mean, that's why you guys are joining these live streams, because Nick is one of them, and following his positions, maybe getting your own trade ideas according to his positions, is what can make you some pretty decent profits. So that's the name of the game. It makes things a lot easier if you have a couple of analysts and investors that you follow, so that you can get an idea what to do in your own portfolio. For example, just to give you a list, I follow 4 people closely. So Nick, trader Nick, then you have Brent Donnelly, then you have Andrew Campbell, then you have Vukovic. Okay. Whoop. So all of these guys have a Twitter presence. You can find them on Twitter, and then all of their social media links and everything that they have is going to be on Twitter. If anyone wants to take a look, the best success that I found, if 2 of these guys are risk on and 2 of them are risk off, you should stay out of the market. But if 3 out of 4 of them, or if all 4 are risk on or risk off, it's pretty good to follow them, okay? So essentially, you're looking at what is the majority of these 4 traders doing. Are they risk on, risk off, buying oil, selling oil, escalation, de-escalation? That is the approach that I personally have. And those are the signals that you get in the A1 Discord. So if you want to join the A1 Discord, get all of my trades, there's a link in the description, and you can use the code Marco to get 25% off. So check it out. Those are the 2 trades I have. Euro Swiss, by the way, was not a signal because it's more of an experimental position with small risk. You can re-enter it if you want. So you can enter if you want. Of course, this is not financial advice, but price is still pretty close to the break even. The main theory behind this position is just the possible intervention from the SNB, which is the Swiss Central Bank. My bet was that they're going to defend the 0.9 level. Okay, so 0.9 level, pretty important level, round number. There's a lot of people at the SNB looking at that level and possibly saying we don't want to see the Euro Swiss go below it. Then I have gold, which is falling off of a cliff. So gold looks pretty bearish at the moment, looks to be selling off quite aggressively. I'm looking to buy. So the current sort of view I have on gold is long-term gold bullish, absolutely bullish. Even with the war, I mean, the war should be risk off, should be bullish for gold. Short-term, though, seems bearish. War started 3rd of March. We sold off. Now we're selling off again. There's an inverse correlation between oil and gold. There's sort of a direct correlation between the price of the S&P 500 and gold, which is pretty funny to see. So I'm being patient for now. Personally, I'm waiting for a bullish reading on gold. Right now it's neutral. I'm waiting for this to flip bullish. But, you know, we are below the 20 MA. This is a pretty fat red candle, so I'm not sure. I'm not sure. I didn't expect such a large move down, especially today. USD JPY is approaching the intervention level. So USD JPY is getting pretty close to the 160 level. That's a key level. Possible intervention could happen at 160. So we will see how that will work out. Of course, if I take a position, you will be notified in the A1 trading Discord. My game plan is if we hit 160, probably going to sell. Stop loss above 163. Target to, let's say, these lows to support. Okay, that's a positive reward to risk. 2.3 to 1. It's nice. I know we already got some talk about a possible intervention, and now we are approaching the sort of the key level. I can see that Alan has joined. So before we put in Alan, I want to put the link to the giveaway form one more time. So in the comment section, you can find the link to the form, fill it out, and you'll get entered into a DNA funded giveaway. I have a one phase 10K account. Okay, one phase 10K account. And if you want to get funded, definitely do check out DNA Funded. We have a 25% discount code. So A1 Live gets you 25% off any DNA funded challenge. A1 Live, 25% off any DNA funded challenge. This is my personal 25K two-phase account, currently in drawdown, as you can see. Current equity is around 24.747. I passed the phase one recently, so it took me a month and a half. Now on to phase two, and it is not working as great as, let's say, the phase one. But again, part of the game. I just started. I think the start date was the 10th of March, so only 8 days so far. We're gonna just have to leave it and see how it goes. But I had a great experience so far. This is a great prop firm. There's a big broker behind them. And with the code A1 Live, you get 25% off, which is a pretty massive discount. Okay. So 2 more minutes before Alan joins us. What else do I want to touch on in this solo segment? Well, just the stock market, getting crushed today. So the theme for this week has been Monday risk on, Tuesday risk on, pause, switch to risk off. I did look at the breaking news. So I did look at Financial Juice for any clues to find any sort of thing that escalates the conflict. I didn't see much. There is some back and forth between Trump and Iran. We bombed this, they bombed that. We sent rockets here, they sent rockets there. Other than that, I didn't see any major point of escalation. But for this risk off to continue, you don't even need an escalation. You just need a prolonged conflict. Again, if you just remember this chart right here, Hormuz closed for 1 month, 2 months, 3 months. Price can just go up and up and up. And this is from Bloomberg. So this is not just something that you find on Twitter. This is an actual pretty good source. Okay, time for Alan to join. Oh, hello, Alan. I didn't see you there.
How you doing, man? How's everything going?
I'm doing pretty well. How are you?
Pretty good. Busy morning that we got going on here. Coming off strong. So,
Yep.
We had inflation. Inflation ticked up here in the U.S. That was obviously not good for rate cut stories. I think the big thing will be the dot plot, right? What they think as far as, are we still going to get that one rate cut that markets are bracing on for, or none, right? And I think this is Powell's last conference. So, good for him. If I were him, I would want to retire in this environment too. This is too much if I were him. But we did see some geopolitical things on the headline front. Iran took several phases out of South Pars, which is a gas, infrastructure. They were not happy with that. Iran said they will hit enemy sites, and they will retaliate against energy infrastructure. So just a lot of things. Iran's Revolutionary Guards issue evacuation warnings for several energy facilities across the Gulf. So you see a lot of that going on here. So oil's picking up. You have U.S. yields picking up as well. And you have the VIX up as well. So $2 getting firmed up there. So what I did was I booked my profits on all the Aussie pairs just for now, because I do want to go ahead and jump in on dollar long. So I went ahead and shorted the euro dollar. So we
nice. You're fast.
Sorry?
You're fast.
Yeah, I'm very quick. Like we said, things can shift at any moment, especially in time like this. And right now the trade that makes a lot of sense is dollar safe haven, of course. So we got things that confirmed it, right? We had oil higher, yields higher, Obviously talks of nothing coming to a resolution, more sites being hit. So that's obviously bad. And then you also do have to add on top of that, you had CPI come in, or not CPI, PPI come in higher than forecasted, higher inflation. So yeah, that's one of those examples where you go ahead and you flip really, really quick, and you have to be mindful of what's happening in the world. So not to say that I'm completely done with the Aussie dollar story, not the case. If anything, the more it dips, the more I'm looking to just re-enter it and just milk that trade for as long as I can, because it does seem like whenever you do get a dip in the Aussie dollar, it does go ahead and get scooped up there. So I'm happy to go ahead and do that.
Interesting. And sorry, could you bring back the news that you mentioned because I didn't see your screen?
Sure.
Maybe I missed something on my financial juice. So you talked about, okay, so this is it.
So this one was following the interest rates or the inflation numbers. Traders they paired bets on interest rate cut in 2026. And then they said Iran to retaliate against energy infrastructure. Iran will hit enemy sites previously thought to be safe. And before that too, Iran takes several phases of South Pars gas field offline. So there's a lot of those headlines about taking that field offline. Here it is. Part of the South Pars gas field was attacked. And so you saw oil higher on top of that. So you saw a little bit of that. And then the government itself, they did say something like, you need to evacuate. Yeah. So Iran's Revolutionary Guards, they issued that evacuation warnings for several energy facilities across the Gulf. Yeah.
Damn, I missed it. I missed that. Maybe I need the pro version because I don't see it on my.
Maybe, or it could be the settings too, Marco. I'll send them to you after the stream. Maybe that's what it is. But yeah, when I got this thing, it was like on huge sale for like $100 for the lifetime. So it made a lot of sense. But I think the only difference is like a 15-second data delay. But yeah, I'll send you the settings. But I would imagine your oil trade is doing good on this.
Yeah, it's doing pretty well. Nick entered it a few days ago, I think, 1 or 2 days ago. I looked at the situation, read a couple of articles, read this post right here, which basically tells you that as long as the strait remains closed, the price should go up, and decided to take a stab at it because I think there's just not going to be any sort of a resolution anytime soon. There doesn't have to be an escalation, but as long as they're not negotiating or talking about a possible closure, I saw some posts from the new cardboard Ayatollah that he is not interested in like any sort of a resolution, that he wants the US to pay. And Iran is probably playing the long game, meaning they are waiting for other countries to put the pressure on the US to end the conflict, because China is hurting, India is hurting, EU is hurting, pretty much most countries are hurting except the US, because the US has their own oil. So Iran is betting on a prolonged conflict, which puts pressure on neighboring countries and the US to end the war, and so that they can maybe get better terms. Is that a good strategy? I'm not sure. So what I read, what the US could do is, since they control the sea, they basically have a lot of aircraft carriers. They can seize Iran tankers and basically resell the oil from those tankers, and maybe gain some profit, gain some money, to then send Starlink terminals into Iran, which could then again force the people in Iran to revolt against the government. Because why the last revolt failed is because the Iranian government actually turned off the internet. So essentially they could no longer coordinate uprisings, and then the whole thing stopped after massacring like 30,000 people. But if they get Starlinks, then maybe something could happen again on that front. Then the Iranian government would need to first fight the war, and second fight the uprisings in their cities. So that's one option. But again, I'm not an expert. I'm just reading stuff online. What I'm personally betting on is no de-escalation, unfortunately, prolonged conflict, strait remains closed, oil price goes up. Yeah.
Makes a lot of sense, though, that strategy. Gold, Marco. Gold has been something that we've kind of talked about back and forth here. And it has fallen off a cliff, literally, quite literally. Looks like an ugly chart here. And to those that don't understand why, it may be very confusing. Do you have a specific level in mind as far as scooping up gold, or is that something that you're just going to stay away from? Me personally, I think that as long as the dollar stays firm, gold is not in play. It'll probably stay to the downside. I wouldn't short gold just because this is just one of those assets that goes higher over time. But do you have something or a game plan in place for gold at the moment, Marco?
I was looking for buy setups. Now with this recent sell-off, especially today, it's creating some problems for my personal entry strategy. Edge Finder is still neutral, so I'm still not getting a bullish reading. The way I see gold is short-term bearish as people sell everything and go into the USD as a safe haven, but long-term absolutely bullish. Long-term risk-off conflict should be bullish for gold. Gold should catch a bid. The problem is, how can you get in with a tight stop loss without getting crushed before the move up actually happens? Because if I entered around the 20 MA, let's say, I would probably be already out of the position. So the game plan for now is to just pause, to stay a bit flat. You know, the oil position I have is not a lot of risk. When the Edge Finder turns bullish, and when we get some bullish price action on gold, then it's going to be game time to get in. But at the moment, being patient on it. And I just wanted to mention that I love your approach with being fast in exiting and entering new positions, because this is the exact sort of market environment where being fast pays. If you can flip risk on, risk off as the market quickly flips, then you can make some quite nice percentage just be following the risk on, risk off scenarios. So I think so you flip basically from risk on to risk off today, right?
Correct. Yeah.
And I think that was a pretty good time to do it, because as far as I can see, if we look at let's say the S&P, Monday risk on, Tuesday risk on, but starting to fall apart, and now possibly Wednesday risk off, kind of the perfect time to flip your positions. And I just wanted to do the giveaway now because I won't get time to do it later. So let me just quickly do that. Let me grab all of the names. Today is the 18th of March. So let's just scroll lower on my list. Okay, let me copy the names. Put them into my little wheel. You want to participate, Alan? Should we put your name in there?
No, I don't want. Let's give them as much of a chance they got.
Okay. I put you under an alias, so we'll see.
Oh, okay, awesome.
Okay. Tino M, congrats on being the winner. I hope I'm not butchering your name. I don't want to pronounce the whole thing. After my segment, I'll send you the code to the free 10K one-phase account. Again, congratulations again. If you guys want to participate in these giveaways, just join me once per day. I'm doing a giveaway. And if you want to get funded, consider using the code A1Live. So the code is A1Live. Gets you 25% off any DNA funded challenge. All of the information is in the comment section and in the description of the stream. So getting back to our segment, USDN approaching the level. What do you think?
Yeah, I was actually looking at that chart as you were doing the giveaway stuff. It is getting close to that 160. Again, I might just take that experimental position just for the funds of it. Very low size that it won't affect me really because the downside opportunity is quite large, so it'll make up for it within the actual move in itself, not so much the size of the trade. Yeah, I mean, I have the alert at 160, so once we get to that 160 level, I might entertain that idea. How about you? Are you looking to entertain it?
Absolutely. I'm looking to get in. We are approaching the level, so pretty much. Again, the dollar is catching a bid, safe haven. We had that news out of the BOJ. I'm not sure if we had anything new. If I quickly filter for Katayama, yeah, I'm going to need to have a read through this. But I think the last news we got was on March 16th. So basically on Monday that they're prepared to take decisive steps. 160, good level. Stop loss, I would probably do above 163 and aiming for these lows right here. If it's a big crash, if they actually participate in the intervention, maybe I'll even use a trailing stop loss. What I know so far is there is very little buyers in this market. So, I mean, this was just some rumors about a Fed rate check and the market crashed. What was it? Let me see. Like almost 4%. And it was not even an intervention. So I think there's a lot of fuel for this thing to go down. There's not a lot of buyers and could be a pretty nice position. And then Bitcoin is actually selling off here, which is a bit weird. I was expecting Bitcoin to keep on following what it has been doing for the last couple of days. Since the conflict started here on the 2nd of March, we went up, pulled back, but then we started to pump higher again. And today we are selling off. So what do you think of this? Is there any sort of a decisive kind of reason for the movement of Bitcoin, or is it just a mess?
I would say, from my understanding of it, I'm no crypto expert by any means, but the most recent leg, that big one that we saw in crypto, was because of the Bank of Japan, elevated yields, looking to hike interest rates. And a lot of people do what is called the carry trade, where they arbitrage a very low interest rate, essentially cheap money in the Bank of Japan, and they park it into higher yielding assets, whether it be the dollar yen, or Bitcoin, which is a very high risky, high volatile, but a very high yielding asset when it does work out. And so I think those ideas of the Bank of Japan hike was unwinding some of those trades. Now that you are seeing out of the US that inflation number coming hot, these escalations, oil prices higher, that would probably promote a lot of other central banks to go ahead and hike as well. So you do have that like global rate hike effect. Maybe that's what's pushing Bitcoin lower. Again, I'm not an expert, but to me, that's what makes the most sense. I thought, though, that most of the leverage positions did go ahead and get taken out by this point here. But again, humans are very, how can I say it? It's very hard for humans to sometimes get the lesson. So you don't know if they or re-leveraged up over here. But I think that's what's pretty much happening, is that you're starting to see yields on the rise again. I'm just looking at the 2-year yield for the US here, up 1%, 1.14%, basically wiping out 2 days worth of losses right there, almost to those highs. So yeah, I think that's what's happening, is kind of that global rate hike story. Bitcoin is not loving that.
Yeah. I mean, I thought it was going to go up. I thought it was a bullish story, especially because it was acting completely different than, let's say, it was acting like a safe haven, which is pretty weird. So kind of acting completely different than the stock market and even different than gold. But looks like it's a nothing burger so far. I think if we can't break out of the range, it's just not going to be that interesting. I do think Edgefinder is bullish. Let me check. So Edgefinder is bullish, but I need a breakout. I need a breakout, and then it would be game on to look for buys on that. So anything else that you're watching for today before I leave you for your solo segment?
I'm just watching dollar index, yield, and oil. To go back on the Bitcoin story, I think still, like, if you want to treat this as, and this is up to everyone else's discretion, right? Like however you view a chart. But if you want to name this a kind of V-shaped recovery, where you have this bottom and now you're starting to have a slow grind higher here, putting the Fibonacci retracement level from that low to high, which is what I do all the time. It's still up in an uptrend, right? Like you've kind of respected this 38.2% retracement here. Even if you get down into like the 70,000, 60,000, 69,000. But yeah, I mean, it is going to be hurting a little bit if you start to see yields across the board start to rise. And because it's still a bullish reading, I still think it's not too ugly looking just yet. But if you start to kind of breach this level, like 66,000, if you start to revisit here, and it just trades below it, then yeah, most likely this thing rolls over to like 50,000 probably.
Yeah. I mean, interesting. Definitely interesting. Are you looking to trade it maybe in the future, or?
No, to be honest, no.
Okay.
But it's a
Fair.
chart worth
Okay,
mentioning. I
fair.
know there's a market for it, so that's why I talk about it. But no, I don't trade Bitcoin myself.
Yeah, fair play. Yeah, so maybe in our next segment we can talk more about the Fed and kind of preparing for the event. But yeah, before I leave you to the solo segment, is there anything that popped up on your watch list this week? Except I know you sold euro dollar. Or are you looking to play euro dollar for now and kind of be mostly flat, see how things develop, see how the Fed event goes, and yeah.
I'm gonna stay between the Aussie dollar long story and the euro dollar short.
Okay.
I'm pretty much gonna transition those as I see fit. Who knows? By the end of today, like if this thing drops a little bit and I take a quick hit on that and I reposition into the Aussie dollar, that is very much a possibility. Depending on what we see coming out today, especially on the dot plot. If the dot plot still shows like 2 rate cuts possibility for this year, that'll obviously cause some repricing in the dollar because the dollar right now is pricing in 1. If that, maybe half of 1. So that's something I'll look at for sure. We could definitely talk about how we can prep for that on the next one.
Absolutely, yeah, because the dot plot is coming out and it comes out 4 times per year, while the meetings are 8 times per year. So this meeting is even more important because of that. And I have a lot to say about Powell and the new guy that's coming. I think it's Warsh. So I'm looking forward to our next segment, but I'm going to leave you to it for now. I will see you guys in, I think, 1 or 2 hours. So good luck, Alan. And if anyone wants to get funded with DNA, I just want to remind you 25% off with the code A1Live. Great prop firm, so check it out. Yeah, that's it. See you in a bit.
Awesome, man. See you in a bit, man.
Yep, see you.
And to KDX, is the stream going to go throughout the FOMC event, or is it going to be ended prior to the event in Powell's speech? No, my friend, we are going all the way through from inflation this morning all the way until the FOMC. So you have a good chunk of us here. We're going to have people speaking throughout. Marco and I, after this or after my segment, we'll have about a 2-hour break, and then we'll hop back on here prior to the release. And then you will have Chris Pover, and I think also too, Marco will be joining that FOMC actually and reacting to it live. So we'll be covering the market the whole way through. If you have any questions, because I know a lot of people like to trade around these events or they want to understand the events, any questions that we can give you or answer to kind of help you through this, definitely go ahead and drop those into the comments. I see a lot of requests here. So Aussie, I'm seeing a lot of Aussie pairs. USD CAT, Mr. Mar, I got you right there. Aussie Yen, Aussie Swiss. I will go ahead and address all of those there for you guys. So let's go ahead and go down the list here. So like you said, today's an action day. Today is absolutely an action day. I'm already liquidated off 3 trades, and I'm now entering into a 4th trade. So definitely a very busy day today. Let's go ahead and start with the Aussie pairs because we do have Aussie Yen, Aussie Swiss as a request. Aussie Yen here. I'm sure all the Aussie pairs are pretty much down in the day. Actually, before I go into the currency pairs here, let me go ahead and show you guys this. Basically, let's get a gauge for what the market's doing. You see here that there is a clear appetite for risk off today. This orange bar here is the US dollar, so the highest one today. And the lowest one today is going to be the Aussie dollar and the New Zealand dollar here. So, and then in the middle, you have the Swiss franc, pound, dollar, all that good stuff. So, just to understand, right, what's strong and what's weak for today. You did see some headlines about the conflict possibly escalating, some more oil infrastructure being hit. That's obviously not good. And so you're seeing oil and yields higher. And so what that ultimately does is drive the dollar higher. So just knowing that, now we can go ahead and start looking at the pairs as we requested. Aussie Yen here taking a little bit of a hit, but overall in a very strong uptrend. I did exit my Aussie dollar positions, the Aussie basket, but that doesn't mean I ditched the idea entirely. All I'm doing is I'm going to ride the dollar safe haven story until it no longer makes sense, right? And I'm basically flip-flopping around between the two. Any dips so far in the Aussie dollar or any Aussie dollar or any Aussie currency does get bought up here. So I'm looking for, if I'll even put this, I'll put an alert here. Somewhere around here. If this thing gets tagged, then I'm most likely to go ahead and jump in just because of the relative strength that we've seen in the Aussie dollar. So let's go back to Aussie Yen as your request goes. from my understanding, you do have, yes, getting a bullish reading here on Edge Finder, which is very, very good to see. As far as an entry opportunity, what I would look for would be something like a shallow pullback, because I don't think we will get anything super, super deep unless something ultimately changes in a significant way. But maybe something like right here is a pullback that I would go ahead and look for to the long side here. So 111,600 essentially is what that pullback will look like. That is what a decent sized pullback for me for Aussie yen goes. The other request that we had was Aussie Swiss, I believe. Let me verify. Where is it? Aussie Swiss. Perfect. Yeah. Aussie Swiss was one that I actually took. So Aussie Swiss, I like to trade a lot. It's showing a lot of relative strength here. We have rejected this level here before, this little level of resistance. If I go to a 4-hour time frame, you can see that here. Every time we get here, we reject it. But I love this pair. The Swiss basket as a whole has been getting weakening. I can show you guys this here. If we go to the Eco Surprise Index, you can see basically all of the major currency pairs weighed up against each other. You have the Aussie dollar, which is 83%, which basically means 83% of the data releases have been coming out in favor of the Aussie dollar. And right next to it, the Swiss franc, you can see that 33% have actually missed expectations. Like it's significantly worse than the Aussie dollar, if that makes sense. So Aussie Swiss, I'm definitely looking to go ahead and scoop that thing right back up if we get a meaningful pullback. I entered here at 55 to 300. However, anything below that, if you get a flip in sentiment or a flip in pricing as far as dollar and yields, then I'm definitely going ahead and pick this back up. So this is something definitely on my watch list. I like the Aussie Swiss a lot. So and you also had the Swiss National Bank saying that essentially they were looking to intervene to weaken the Swiss franc because it was getting super strong there, and they do not want that. So that was another added layer of confluence for Aussie Swiss. So very, very good pair there. Econ maxing, I would definitely go ahead and watch out for that one. Humble request for USD CAD. Let's go ahead and look at USD CAD. USD CAD here has been trading in a range between 1.37400 and 135,400. So not the prettiest environment, right? If history repeats itself, then most likely than not, you get some kind of a maybe a rejection from this range here. This one's tricky because you have the dollar, which is strong off of the safe haven appetite. But then you also have the Canadian dollar, which is somewhat pegged to oil. And oil is thriving off of this environment as well. So you're essentially trading two strong currency pairs against each other. And so that causes that range-bound action versus something like pound dollar, where the pound has been weakening and the dollar has been increasing. You get like a more clean move to the downside. So that's the only dilemma with dollar CAD. Now, there is a possibility that this thing breaks out here and trades to the upside. But again, I think if you want to trade the dollar, there's better pairs out there to do. For example, euro dollar and pound dollar. I would recommend trading those instead, just because you're trading those weaker currencies against the stronger dollar. That is my personal opinion, though. Let's go ahead and see the other ones here. CAD is so correlated to USD lately now about, something's messing up here. Aussie Kiwi. Aussie Kiwi was a trade I really, really liked, especially considering that, I in this environment, what I do typically as I start my day is I just look up that currency strength index chart here just to see which one's strong, which one's weaker throughout the day or throughout the night. Because obviously I'm asleep. And I've noticed that the Kiwi dollar has been a lot less stronger than the Aussie dollar. The only thing is that this thing has not given an opportunity for a pullback. So I like the pair. You're completely right on that sense as far as going to the upside. I love the idea. However, just looking at this chart here, there is no sign of pullback. So it's hard for me to enter. But if we were to somehow get an opportunity to get a deeper pullback of about 100 plus pips, I'll probably take that. But for now, it's a good idea, but not the right time, I would say. If US yields fall, CAD could go higher. Yeah, so if US yields fall, then for sure dollar index follows suit with that, and then the Canadian dollar can catch a little bit of a bid. That would be the unique situation that we would need for dollar CAD to go ahead and pop higher out of this level of resistance. But because those two currency pairs are both equally strong, or not equally strong, but very strong, a little bit somewhat to each other, that's why we've been getting this like sideways price action versus something like euro dollar, boom, to the downside, pound dollar to the downside. So I mean, unless you want to trade the range, a lot of people actually do that. I used to do that. So like for me on a higher time frame, I like trading the ranges, like especially like this right here. Like for me, I would trade this thing to the upside, but you know, the environment doesn't suit that at the moment, because you have an opportunity for the dollar to go higher as it becomes a safe haven, as things escalate further. That's why I'm not doing that this time. But yeah, that's definitely a possibility. Some people like to trade the ranges in Forex, especially because Forex are mean reverting assets over the long period of time. CAD Swiss long. CAD Swiss, I would imagine, is a good trade to take as well, just because oil is higher, Canadian dollar's higher. Look at that. Okay, so let's look at the edge finder first, because I haven't yet looked at the Canadian basket as a whole. So let's go ahead and do that here real quick. So what you do on your edge finder, you just go to the top side of this page, and then you hit CAD. What is going on? Maybe I have to do all caps. There it is, all caps CAD. So every single CAD pair is neutral. So not the best, but you are seeing Canadian Swiss at the very top of it, but it's still a neutral score. What I would do if I were looking to trade it, I would wait for a pullback, maybe into something like this is what I would do. And if I measure a fib from this recent leg higher, that looks like a 50% retracement level right there. So that is what I would look for CAD Swiss. Good idea. Something I will have to keep on the radar. However, I like Aussie Swiss better. Euro CAD. Let's go ahead and look at Euro CAD here. Okay. Euro CAD is getting a neutral reading to the downside. Euro CAD would be a short opportunity, most likely. And okay, look at this clean price action here to the downside. This is the daily time frame. Let's measure this recent leg. Okay, you did tag that 38.2% retracement level. This is something that I would, let's see, I would probably prefer something. Let me just look left here. What could I do left? Okay, not bad. If you want to hit the shallow pullback, not bad at all. A possible thing. The reading is somewhat weak. It's a -4 reading, so it's not a bearish reading officially. But this seems like a decent trade. So if you're in the trade, congrats. That's a possibility, especially if oil continues higher there. The Canadian dollar will start to firm up, and this trade will pretty much work. DXY down, range trading. Ballot says no. DXY 99 to 100 ascending. Okay. Someone said they're waiting for Bitcoin to bottom out and maybe cross bullish on MACD. Yeah, Bitcoin is a good opportunity, I would say. It looks somewhat promising here. It's been holding up its weight. It is falling down here today, -2%, so not the best thing to see. But it is getting a bullish reading here on the edge finder. And if it's, holds up these recent lows here, then maybe Bitcoin to the upside is a somewhat okay idea, I would say. Ball has been very persistent with any strength will be faded to 50. I like 50 as well, ball out. I'm not a Bitcoin trader. I'm not a crypto expert. But always, as this thing was happening, I was kind of thinking like, man, 50 would be a good solid support level, in my opinion. Will we get there? No idea. But that's pretty much my opinion there. All right. This is a really good question. Because I'm sure a lot of people have this question too. What's the way forward for indices like the Nasdaq and the Nikkei? Well, right now, they are trading softer. So let's just go ahead and understand the dynamics, right? All markets are interconnected in some way, shape, or form. At the moment, what is moving markets right now is obviously what's going on in the US and Iran. They are experiencing the prospect of elevated inflation. So if the Strait of Hormuz continues to stay closed, that passageway where the ship tankers go accounts for 20 to 25% of the world's oil supply, right? Also, too, Asian countries in that side of the world, you think of China, Taiwan, Japan, the Koreas, for them, that is 70% of their oil comes through that passageway. And so if that passageway gets disrupted, that makes oil go up higher because there's a risk premium attached to it. And a lot of the things that are used, as far as like in the US specifically, I can talk for, when you go to your grocery store, eggs, milk, your meats, all that good stuff, right? All of that is pretty much transported when it gets to the grocery store via a truck. And so if oil prices go higher, then the gas prices for those trucks go higher as well. And so that added cost, that increase, gets passed on to the consumer. So you have eggs from going, from example, for $1, they go up to $3, right? And that's just not eggs. That's pretty much every single food that is in the grocery store gets increased in price. And so that is inflationary. And so what that happens is, the way central banks go ahead and fight inflation is by hiking interest rates. And so what does that mean for stock indexes or and stuff like that, right? Well, most companies, some larger than others, but the medium to smaller size companies require borrowing to go ahead and grow and operate. Um, the big companies like the Nvidia or the Apples, where they're super cash heavy, maybe they're not so much affected, but you do see the medium to smaller ones definitely affected, right? Those smaller companies, they use borrowed money to buy more warehouse space, for payroll purposes, for technology, for investing in AI and things like that, right? And so if the cost of doing that becomes increasingly harder, they do less of that, and so that's why those companies start to hurt. So something as something far away as a ship canal in oil can trickle all the way into global companies there, especially thinking of the Nikkei here. 70 to 80% of that oil for Japan passes through that strait. So if I pull up that Nikkei chart, I would imagine that it is lower on the day significantly. Well, I would say not significantly here, but from the recent high, let's see how low it is. It's down 13%. So if you see the prospect of global inflation, oil prices elevated for a long time, that can definitely hurt companies. And that's where you have that risk of these things really starting to roll over. So to answer your question here very briefly, what do I think about it? Well, for Nasdaq and stuff like that, if you see oil prices above, my number is 90. I would say 90 to 95. If oil prices are above 90 to 95 for 2-3 months on end, then that really starts to trickle into the economy and these things really start to roll over. I think Nasdaq breaks 24,000, and 22,000 on the Nasdaq is a very realistic possibility, in my opinion. For the S&P 500, if you start to roll over here from that 6,500 level, I think 6,100 is a very real possibility. For the Dow Jones, if you breach this 45, I think honestly 37,000 all the way down here is a very real possibility. That is about a 26% drop from the highs. So yeah, that's my thought process there on indices and stuff like that. Okay, Offmain has an interesting take here. Super long term idea: be prepared for Trump to lash out with tariffs on NATO countries after the war because they wouldn't send help. Yeah, so Offmain, don't know if you saw my yesterday's chart market post on the Telegram channel. And by the way, join the Telegram channel if you want to stay up to date with what's going on, especially the very interesting things that are happening around the world, especially right now. But essentially, right, we remember over the weekend that Trump called on NATO countries for help, additional help in the Middle East, and no one stepped forward. And so yesterday you had, I think it was Cali. Let me verify the name here. I read this yesterday. I think it was Cali, yeah. Callis. Callis went ahead and said that, they didn't ask for this. They weren't briefed by the U.S. before the attacks, and that they're trying to find a way to essentially go around the U.S. to continue allow their boats passing through the Strait of Hormuz, because they have a inflation crisis, a potential inflation crisis, at a food and energy crisis. So not good. And so, yeah, that is a very interesting take where you have these countries that are like hurting because of what's going on. The U.S. not so much, because we're more energy dependent than others. You know, we can grow our own food for the most part, things like that. And so, yeah, that is definitely a good take there, Othman. Othman, you always read them. Awesome, man. Thank you so much. Small cap would be affected with rate changes. Oh yeah, for sure. Mortgage companies. You have your banks, like your financials. Those will hurt. Car dealerships, all that good stuff. Those will hurt, right? Business slows down when rates are high because people are not going to want to sign up for a car note that with a really, really high interest rate versus a very low interest rate, right? So those companies right there, those smaller companies that are maybe not super cash heavy, that rely on debt to operate, or as far as for cash flow purposes and all that good stuff, those will start to hurt for sure. KDX said, can you check out the Russell, as it most likely hit the idea that there are possibly less than one rate cut? Yeah, Russell. I think Russell here, let's see how much it's down from the highs here so far. Here we are down about 8%. Now looking left on the chart here for the Russell index, let me go to the weekly time frame here. Okay, Russell index, I have a couple areas in mind. This level right here looks good, and I'm gonna turn this green so you guys can see that this is a potential level of support. And then right after this, guys, I do hand the show off over to, I believe Mr. Miko is on here after me. So we do have the Russell here. That is a potential level of support there as well. Something even down here, but this is kind of far of a stretch. So the first target I would say here for the Russell, if you start to see it roll over, would be that 2300 level. That's that next level of support. If you break that, then of course we reevaluate from there and see where it can go lower. But for now, that's kind of my idea for Russell. 6.5 to 6.4 XPX forecasted. 6.4. I mean, if it rolls over, man, I really think 6.1 would be that next level where you have buyers step in. So someone said they want to know, I'm a swing trader who entered the daily time frame. So how any pair and asset I added to most. I am a swing trader who enters on the daily time frame. I think the question is your entries. I'm a swing trader as well, swing trader to position trader. Occasionally, I would do the intraday trade. However, if you're talking about entries here, I personally use the daily time frame and the 4-hour time frame for my entries. So I hope I answered your question there, Sahil. And we do have Mr. Miko here in the background here, so we'll go ahead and transition and throw the show over to him. Again, guys, stick around. We are trading throughout the whole event here from the morning all the way into the afternoon. So we will have market coverage throughout the whole thing. Again, any questions or anything, feel free to drop those into the comments section, and we will do our best to go ahead and answer those for you. But thank you, guys. I will take a little bit break here, and then I will be back here later in the afternoon. You have Miko here, so have a good one. Bye-bye.
Hey stream viewers, if you're outside of the United States, I have a cool offer I want to tell you guys about thanks to our partnered broker, 8cap. 8cap is currently offering the ability for new depositors to get access to our premium tool, the Edge Finder, completely for free. Now, how this works is basically you create an account and deposit a certain amount of money into that account, and they will essentially buy the Edge Finder on your behalf. So it's a win-win-win. They get a new client for a reputable brokerage, you get access to the Edge Finder and a great brokerage to trade with, and you'll be supporting the show by signing up with 8cap. Now, here are the steps if you want to find out more about this specific offer, but make sure to follow them specifically as we list them out on the screen here. Step 1, navigate to a1trading.com/8cap. That's a1trading.com/8cap. Step 2 is to follow the instructions and to make sure you use the specific link on that screen to sign up for your new 8cap account. Step 3, complete the required deposit amounts and contact their team as instructed on the page. So if you're interested in finding out more about this offer, head over to a1trading.com/8cap, and we'll also be dropping the link to this down below in the live stream chat as we speak. Like I said, make sure to follow those instructions specifically if you'd like to get access to a free copy copy of the Edge Finder if you meet the deposit requirements as listed on the website. Full information, like I said, can be found a1trading.com/8cap. Now back to the stream.
Okay, what's up, people? I hope everyone is doing good. Glad to be back. As always, guys, if there's any markets, any questions or particular time frames you want me to take a look at, feel free to drop it in the chat. More than happy to take a look at pretty much anything. So let us know. But I will start with what I am interested in, what I'm focused on this week. There is a particular pair, but there's some other markets which I'm keeping an eye on. Importantly, I want to see what happens today before I really do cement some biases on different markets. But importantly, pound USD does look very, very clean, especially in terms of the technicals. Now, my focus has been USD markets for the past week or so, and it still is. I still like pound USD to the downside. I'm very short biased on this one. Out of all the USD pairs, this one is the cleanest to me, and a USD pair which still looks like there's room to the downside. And I've been looking at the DXY, and it looks like there's still room to the upside as well. But of course, we'll see how that does progress. But yeah, in terms of the technicals, we saw a very clean close for last week's candle. Minimal wick to the downside and very aggressive wick to the upside. Basically describing how we started off bullish, didn't really maintain that momentum, and we flipped and closed really aggressively bearish. So I'm looking for a push back to 1.31 over the next week or two or three. Now, the plan is to see basically what this momentum has, basically if this momentum is going to sustain for this week or not. Because of course we've started bullish. Now, this could just be a temporary move, a temporary pullback of last week's price action, and potentially might look to roll back over. Or maybe we do sustain momentum here. We'll see if the data that comes out today does support that, and potentially we do continue to push up for the rest of the week on Thursday, Friday. Now, if we can hold resistance here, basically I'm looking at the 50% of last week's candle. If we can hold that area, which so far we're doing, I am looking for shorts. I am looking for a push back to last week's close and eventually back to support here at 1.31. So I'm pretty bearish on pound USD. Looking for a setup to take a trade, but I won't take any entries until tomorrow. Probably tomorrow London or New York tomorrow. I will let today's price action breathe, see what happens later today, see how price reacts with that, and see importantly how today's candle closes. But it looks like momentum is starting to shift. We've been bullish for the first half of the week, and we're seeing a pretty aggressive close there in the last 4-hour candle. If we can hold this as resistance, I quite like the idea of some sales for the rest of the week back to this low, maybe some nice intraday positions, Thursday, Friday looking to short that, and eventually looking to target that low, but again, doesn't necessarily have to hit this week. So pound USD, I quite like price action. High time frames look very well aligned. USD still looks pretty bullish. If we take a quick look at the DXY, that closed very aggressively bullish last week, although it did close into some resistance. So that's kind of the awkward situation we're in is, okay, USD's been super, super bullish. We've seen a lot of momentum, but we've just smashed directly into some resistance. So is it the best time to be going long USD? Well, it depends on your time horizon. Can you stomach a bit of a pullback? Are you looking to be a bit more precise? If you're looking for precision, then I'll either wait for price to actually break through this area with some more force and some more distance, and then we can talk about breakout opportunities and following momentum, or we look for a much deeper pullback, because effectively DXY has just been in a range. We've got the equal highs and the equal lows in this area. So typically you want to be a buyer down here, and typically you want to be a seller down here. But based on how price has been moving, based on how aggressive these rejections have been in the past few months, it looks like we've had a very bearish USD throughout 2025, and that's just not looking compatible anymore. It looks like price is trying to continue but failing. And fundamentally USD is quite bullish as well. So if the technicals can show some signs of breakouts above 100, 100.5, I do think there's a lot of room to the upside for USD to travel into for a good part of 2026. I'm looking at around 104 area, and that could be some really nice trading opportunities going forward. So I'm looking for breakouts or deeper corrections. Roughly this area could be interesting, and then some longs, but of course we're not quite there yet. So yeah, I'm looking to see maybe if we get the breakout this week or not, or next week. just seeing how USD basically reacts with that level. But I do expect to see a breakout one way or another, whether we do it pretty quickly or we pull back first and then see some follow through later on. That's currently my bias with USD. So pretty bullish on USD. Pound USD looks like one of the better pairs from shorts. I was looking at euro dollar, but it was just a bit too bearish last week, and we've broken through some key structural levels, which I don't want to continue selling. I'm always looking to see how much selling have we seen, and if it is quite large, if the displacement is quite large, if prices had a big run, I don't really want to be looking to sell continuously on top of that. If the market's already had a big move, I'm waiting for the breather, or I'm looking to maybe look for mean reversion opportunities, especially in FX, because FX historically just going to mean revert most of the time. So I don't want to be selling low. I don't want to be selling. I don't want to be buying high. And in Euro USD's case, we've kind of already done that situation. We've had a big push, broken support. I'm not looking for breakout opportunities until I see some more force. Otherwise, I'm looking for a bit of a pullback, then a drop. And that kind of lines up pretty well with the DXY analysis. I can take a look at silver. I haven't really been a big fan of the metals. Price action has been quite choppy. Haven't really seen much dominance from either participants, buyers or sellers. Everything's been quite equal. Gold's been pretty flat. Silver even more so. So I've just been trying to stay away from silver. To be completely honest, because we formed a really nice range and price is just trading in between that very, very well. So you can see this 90 area, we'll call it 90.91 and 70 roughly there. Prices has found some really key resistance and support those two levels. We tried to successfully break out, didn't work out. Price closed back below. Since then, we've just been ranging. So I don't want to be finding opportunities inside of here. Unless I'm looking for a very quick mean reversion intraday trade, yes, I can understand the logic there, but I'm not looking to position a trade which I want to hold for a few days or go into the following week, just because I don't believe I'm positioned very well for that. The only areas where I could justify that would be at 70 or around 90, around those areas, looking for breakouts or failed breakouts. Anything in here, I'm going to just call it fluctuation, noise, maybe intraday trading. You can find some short-term plays here for the day or for the session, but I wouldn't be looking at anything more meaningful than that. Participation is 250-50 at this point in time, and gold slightly better, but still very rangy at this moment in time as well. So I'll be very careful. I mean, I like the support level we're interacting with right now. It looks like price is struggling to break through this. We've got the current 4-hour candle. Still has about 3 hours left before it does close, so I wouldn't read too much into that. But let's say if it can close bullish back above that low, that's a pretty aggressive rejection. Likely to see a bit of a pop to the upside. Would I be looking for a pushback here? Absolutely not. I don't really have any evidence to suggest that. A short-term buy makes sense. We failed a breakout. Naturally, price is more likely to push higher. So I can see logic. I can see sense there. And those are the opportunities, if I had to, is what I would be looking for. Then of course I'll be looking at the extremes of the range as well, 1970. But not a big fan of silver, to be completely honest. Gold slightly better. There's more of a trend here, but again it's been quite flat as well. We've had a very noisy day today, very aggressive push. Broke out some support, testing another level there, and again I just want to see how price interacts. There's not really an overall direction right now for gold. You could argue the past maybe week or two been bearish, but past week or two before that we were bullish. So it's kind of mixed signals right now with gold as well. So yeah, I don't really have too much edge here, so I want to stay put. I want to stay away. Again, a big part in my trading is making sure I choose the best conditions to deploy my strategy. If the conditions aren't aligned, then it's in my best interest to stay away. If I can see clear dominance from one side, buyers or sellers, then I can try and take advantage of that, or depending on where we're positioned. But if it looks 50-50, unless we're at range extremes, then I try to stay away, because I don't see much opportunity there. Potentially. I mean, yes, we could. I mean, I'm more focused to see what we do in terms of the bigger picture, in terms of what happens post interest rate decision, how the sentiment is positioned beyond that. That's kind of really where my focus is, because in terms of risk on and risk off, you can measure that in different time scales. You can measure that intraday and you can measure that on a weekly basis as well. So I kind of want to make my trading judgments a bit more objective. So I try not to focus too much on the fluctuations of risk on, risk off, and just focus on what's the dominant risk. Is it dominantly risk on, dominantly risk off, and then focus on that, because that's going to weaken and then strengthen throughout each day. Maybe something happens and then something switches. And I want to make my trading almost as objective as I can. And trying to fluctuate too much just creates more confusion, more noise. So I try to focus on the bigger picture, the more macro points to focus on, and then we might fluctuate intraday, so be it, sort of thing. Because if I try and monitor too heavily, I could get lost very quickly. We'll focus. I'll take a look at some of the indices. I'm actually gone through the indices yet. CAD CHF, absolutely, we can take a look at as well. Do you not trade during the press conference like today? Not really, because I want to see what the outcome of the conference is. So I'm not looking to necessarily trade it. And again, the main takeaway from the press conference is not necessarily what happens at that particular time, it's what potentially could happen for the foreseeable future. And that's really where the opportunity does lie, not necessarily the event itself. So I'm not looking to trade the interest rate decision, not looking to trade the press conference. I'm not really looking to trade today, to be honest. I'm looking to see what happens and then look to see what the reaction is on Thursday, Friday. So those are the days I'm actually looking to see if I can actually trade. Today is more of a noisy day. I'm not expecting anything crucial between now and before the press conference later, and then I'm going to justify if my bias is correct, or I need to change it, or if I should stay out for the rest of the week. So yeah, I'm not looking to trade the news events at all. It's just what the sentiment after, that's useful. So in terms of Nasdaq, and then I can have a look at CAD Swiss. Haven't been keeping up to date with CAD Swiss, to be honest, so it's going to be interesting to see what's going on there. Nasdaq has been horrendous, to be honest. So yeah, price action not great for the past 2, 3, 4, 5 weeks now. It's just backwards, up and down. I mean, I haven't really been focusing on the Nasdaq either, to be honest. US 30 has been a bit more interesting, but yeah, Nasdaq completely awkward. So again, if you're looking to trade these conditions, certain edges will appear, certain edges won't be. If you're looking for any momentum plays, any continuation plays, pullback plays, that's going to get eaten up heavily in these conditions. So you want to be staying far away from those trading strategies and styles. If that's your main style, that's completely fine, but now's not the best time to deploy that. Either you want to look elsewhere or be very patient and wait for this consolidation to run its course. No necessarily right or wrong answer, but it's just not optimal for that. But if you're looking for mean reversion plays, looking to fade extremes, fade fake outs, that's something's useful, because that's exactly how the market's operating right now. But I would also add, positioning is very important as well, where you position your entries, your stop losses, and your targets, of course, because you could be looking for mean reversion, but you're going to get much better opportunities in these locations than anything in here as well. Not that you can't find anything here, but it has to be very short term, and it has to be kind of aggressive as well. Just because the fluctuation is very aggressive itself. We're not really seeing sustained moves. Prices reverting very quickly. This is pretty much just noise. What I would classify as just noise. It's not price action, which I would look to try and understand and try and see if I can base a trading opportunity off it. This is kind of what I'll just section off and just focus purely on the lows of the highs. So yeah, Nasdaq, I think, is just a very awkward market to trade, unless, like I said, you're looking at shorting or buying the extremes. Other than that, I would stay very far away. Very, very far away. Too noisy. Way too noisy. But I have been keeping up to date with well, not this level actually, this level here. This is the level I'm looking for opportunities on. If we can see a push to 24K, I absolutely will be looking for some longs. Of course, depending how we react there, but that seems to be a very crucial level for the Nasdaq. We've had the first test, the second, the third, and the fourth. So it's definitely an area where price is paying a lot of attention to. Should we get there again and react well, I'll be happy to find some longs. Anything above that here, not really doing it for me, to be honest. Okay, I'll quickly go through CAD CHF. Okay, we can have a look at gold on the 4 hour as well. You kind of bearish on, yeah. Yeah, I'm not really bearish either. Just to be completely honest, I'm just looking at 24K. Because throughout my trading career, I've tried to invent opportunities where there aren't really opportunities to be traded. That's been my main battle with my trading. Always making sure that I'm taking a trade because conditions are rewarding that style. You could try and find trending opportunities here. Try and find a short. You could potentially win that trade. But it's just, okay, if you're going to trade this 100 times, the results are probably not going to be very attractive. So because of that, it's not really worth your time. So yeah, we might have a bearish sentiment today, but I personally just won't look too much into it. I'm just particularly glued on 24K. That's my focus. In terms of CAD CHF, so CAD Swiss, like I said, not really been focused too much on this market. So you have a brief overview, see what's doing on the higher time frames. Okay, so it looks like we found a little bit of a bottom here. 0.56 failed to break through twice. Now pushing back into some resistance. Let me just have a quick look on the monthly chart. Yeah, momentum is still pretty bearish, so I think shorts somewhere around here, 0.58, do look good. But we're probably still far away from trading there just yet. Anyway, so in terms of CAD CHF, very choppy price action. Let me drop to the 4 hour chart. Yeah, very choppy, very, very choppy. Not a big fan of price action at all. So I would be looking for some shorts near the highs here. Market is extremely corrective, but every time we do sweep a high, you can see it's short-lived. We formed a high over there, took out the high, created a new high, of course, but we rolled back over pretty aggressively. Repeat that same pattern again. I'll be looking to see if we can get some rejections around here, so wicks, failed breakouts, and then looking for some mean reversion back down again. I wouldn't be looking for anything sustained. I would just be looking for a short-term push. If this is going to be the move that gets us there, I would say I'll draw a fib from that low to that level, and that midpoint becomes a good healthy target. And then if things go very well, you can target the low. But that's if things go well. This would be your safer bet, the more higher chance of us getting there. So yeah, CAD CHF, yes, we're trending up, but everything's very, very choppy, and we're still quite bearish on higher time frames. So I still quite like the bearish bias, but I wouldn't be looking for anything aggressive. 0.578, depending how we react there, because of course, if we get a solid close above, then yeah, I wouldn't take that. If it's some nice wicks, absolutely that makes sense for a short. So very, very conditional, but in terms of location, there's a clear level that could be interesting later on. At the moment, I don't really see much. So hopefully that makes sense. We'll quickly go through the 4 hour chart on gold, because I was looking at the daily, wasn't I, on gold. So yeah, in terms of the 4 hour chart, the thing is, I had a stream this morning on my channel discussing this support level here, because we were respecting this level Monday, Tuesday. This is Monday's candle. This is Tuesday's candle. So you can see some really nice piercing wicks below. So I said it's going to be interesting to see how Wednesday's close, especially with all the fundamentals today, and see whether we add another wick. So potentially we see a wick lower and then we close bullish, or maybe we break out. Of course, the day is still not over yet, but yeah, we've already smashed through that level and we're testing the next one as well. So yeah, in terms of gold, I wouldn't be looking to do too much right now. I wouldn't be shorting, absolutely not. Would I be looking to buy? Yes, I would be looking to buy, but it's too soon for two reasons. One reason is we just had a very aggressive expansion lower. This could easily still persist. And number two, we've still got big economic data coming out later, and that will have its say on gold prices as well. So we got two kind of big uncertainties right there. So I would be very, very cautious about doing anything on gold. The reason why I wouldn't sell it is because we've already had a big move. Like I said earlier, I don't want to be selling near lows. And secondly, we're interacting with some support right now, so sells are off the table for me. In terms of buys, that would be my approach. Try and see if I can claw back some of this pullback. Not necessarily anything crazy, but potentially halfway of this. That could be a nice short-term play. If things go better, maybe even a push back to that zone. So the buys make sense based on where we're located and based on where we're trading. But momentum is still active. This candle still hasn't closed yet. Still has 2.5 hours. That could close very aggressively bearish and break support. And of course, fundamentals later on will have its say too. So this could be an interesting idea to revisit maybe tomorrow, London, tomorrow, New York, to see what price is doing. Are we still respecting this area? Are we still firing some wicks? Okay, now the buy makes sense. If by tomorrow we're trading down here, well, of course, the buys do not make sense anymore. At that point, might be worth being a bit patient and looking for some pullbacks or maybe some more downside the following week. So yeah, interesting level. Keep an eye on it. Just too much uncertainty to say, yeah, we're about to bounce. It would be a bit too aggressive to say that. Need a bit more information. So yeah, hopefully that made sense. Okay, cool. No problem. But yeah, gold, I'm just not the biggest fan. I'm not the biggest fan of the metals right now. Pound USD is by far my favorite pair right now. I say favorite, it just fits my criteria the best, not necessarily my favorite. So I like what I'm seeing with Pound USD. Momentum's picking up pretty aggressively as well. So the question I'm asking Pound USD right now is, how do we close today? Of course, I'm not going to take too much into account. Still have 6.5 hours left, but it looks like we're rejecting the midpoint of last week's price action. So if I quickly go to the weekly chart, this is the fib I drew from the high to the low. We start off pretty bullish, of course. Monday, Tuesday, come back to interact with the midpoint. We've rejected that pretty well. Now the question is, if we can hold this, can we get a continuation? That is a very poorly drawn arrow, but I'm sure you guys get the point. And then targets become this next support level. And on a weekly chart, this seems like a small range, but it's a pretty big range. You know, that's a pretty big drop there. And that could still take us a couple of weeks, 3 weeks potentially for us to get to that support level. So it's a meaningful move, and most likely I won't take advantage of that with just one trade. It'll probably be multiple positions, especially if I can find something intraday. But I will look for a big swing as well, which I can just hold, but then trade intraday too. But yeah, that's the main question. Is this 50 going to hold? And if it does, well, that does dramatically increase the chances we can push back to 1.32, which is the prior low. And then we'll see if we can break through that as well. But it looks like we've got a solid rejection. So price is pointing that way. Now can we just maintain it through the economic data coming out later today? So Pound USD is my main focus. Euro probably sees similar price action, but I like Pound USD a little bit better. I've been keeping up with some of the yen pairs as well. I do like dollar yen to the upside. Similar reasons, another USD pair. USD still looks pretty bullish. Yen still looks as weak as anything right now. I'm pretty sure everything is up against the yen. So buys against the yen makes the most sense. High time frame looks good. And in terms of dollar yen in the higher time frame, we still got levels which we could come back and retest. 161. We haven't come back to test that since we left that area. And it looks like we're getting a break of highs here. So I quite like the buys, but I don't want to necessarily double up on dollar yen. on USD, sorry, because if I'm really looking for shorts and pound, I want to kind of see that through. I don't mind if the bias was opposite, because then it could act like as a hedge or manage risk sort of situation. But my bias is the same, which is looking to favor dollar strength. I don't want to do that on two similar markets, because again, they're probably both going to fail or both going to work. So if anything, might as well just double your risk on one. But I'm going to focus on pound USD, but I have a similar bias on dollar yen. Still looking for more upside. It looks like we've had a really nice bullish leg. This looks like a healthy correction. I do think we're likely to see expansion higher. But again, all of this analysis is all very contextual. It will be, especially before we have big releases like we have coming later today. It's always best to kind of treat these days as event days, as the price action prior is not necessarily very trustworthy, because again, buyers and sellers will have different reasons for buying and selling a market, and post news they will have even more different information or different reasons for buying and selling a particular market as well. So that's going to categorically change after we have the press conference today. So all the price action you see now is based on what buyers and sellers believe now, and that could change post the press conference. So you're being very, very contextual right now. Any price action you see could very much be erased this time tomorrow, and then your buyers could absolutely flip as well. So if pound USD doesn't hold the 50 area, let's say for whatever reason pound USD rallies by the end of the day and we close bullish above this, well, I won't be looking for those sells. So even though I've had that bearish bias on pound USD and I'm looking for the push to support, if pound USD does break above 50 there, doesn't mean we can't sell. We still can. Maybe price wants to test the high, then sells off, but it just reduces the probability and I won't be as aggressive. I'll have to wait for some more development before I can choose to sell again. So yeah, being very, very patient, not trying to judge, not trying to make any premature judgments. Yes, you can have your hypothesis and your expectations, but be fluid, be able to adapt. And that's really the main takeaway. And like I said, especially for the indices as well, they're going to be interesting to see what happens after the news as well. But US 30 has been probably the most interesting out of the US indices, because we're seeing a lot of momentum here. Nasdaq very flat, the S&P pretty flat as well. US 30 has actually had a relatively nice bearish trend here, which is quite interesting. But yeah, I can't. It's not really the best location for me to look for any meaningful sells. The market's pretty bearish, and I think shorts are still the best play. But as we approach this low, I'm being especially cautious about any shorts. Not that we can't break through, we absolutely can. It's just I don't really want to be a seller of US 30, just generally speaking. And secondly, we're coming into the prior low, which started this last up leg here. So because of that, I don't think I'm positioned well for any sustained shorts. And quite frankly, I want to see how we react here, especially if you can put in a bit of a reversal. That would interest me a lot. I quite like the buys after that, but again, we're probably still a week or two away from that. So yeah, indices I'm not really too interested in right now. I'm not selling US 30, and the Nasdaq and the SP are too choppy for me. So pound, USD, euros, where we kind of seen momentum recently. So those are the markets which I want to look to get involved. 1.3324 to 1. Wow, that's a very, very, very tight cap there, Anton. Anyway, guys, we have come to the end of my segment. I do appreciate each and every one of you tuning in and listening to my analysis. If you have found it useful, feel free to check out my channel. The team have dropped my link there. Feel free to check it out if you want to. But thanks once again to the team for allowing me here to stream. Hopefully we'll be back again next week as well. But guys, really appreciate it. Have a great day. Stay safe in the markets with the news later. Take care. I'll see you in the next one.
This next segment of the live stream is proudly sponsored by the one and only Ola Prime. Ola Prime is easily one of the most impressive prop firms that I've come across, with an incredibly professional team. They offer fast payouts within 1 hour, up to 95% profit splits. They have the largest number of trading platforms. I mean, just take a look at this list. They have MetaTrader 4, MetaTrader 5, TradeLocker, DXTrade, MatchTrader, and CTrader all available to their traders. And that's just for the Forex side. On the futures side, they have DX Futures currently with Tradeovate and NinjaTrader coming soon. Ola Prime has one of the widest selections for challenges and funded accounts that I've come across, with a wide range of account balances you can choose from, like 5 all the way to 200K. And just take a look at the variety of different challenges you can choose from to fit your trading style. They have a 1-step or 2-step pro accounts. They have the 1-step prime, 2-step prime, direct accounts, Ola Prime, 1 challenge. I mean, you have a wide selection here. And the reason this is so important is that you as a trader have a unique style. Everyone does. And finding the right challenge to meet your criteria is very important. If you go through their website, which I encourage you to do so using the link dropped in the live stream chat right now, you can explore in full transparency all of the different account types, all of the rules, etc. They also offer news trading and weekend holding, and they have direct and challenge accounts available. For a limited time, stream viewers get extra discounts using the promo code that you see on your screen right now, and also through the link and promo code being shared in the live stream chat. Take your trading to the next level with Ola Prime. Now back to the live stream.
Hello, hello. How is everyone doing? Happy Wednesday. Sorry for the delay. Unfortunately, the time change got to me. I didn't realize what time it was. Anyway, how is everyone? Hope you're all well. Anyway, markets. They've been interesting. We've had a little bit of volatility on the US dollar pairs. Overall, still in the green on the short positions on euro dollar and pound dollar. Nothing really to say, to be perfectly honest. I remain bullish on the US dollar. I don't think FOMC tonight is really going to be very interesting. I mean, what can Powell do? I think it's just a case of hold rates. It is what it is. Pound Australian decided to pull back to entry. However, we've seen another rejection here. I'm not really too concerned about Pound Australia or any of the positions. Actually, I'm still very, very happy with all of them. Also in the Aussie yen to the long side, a little bit of an early entry here. The entry was taken on this 50% retracement and then actually executed on the bullish H4 candle close here. Of course, a little bit of downside, however, still respected this fib zone and then very quickly came into some profit, which is quite nice. Pretty smooth trade. And we're now also in a Swiss yen position as well, which is pretty much just around entry. So yeah, not really anything to discuss there. In terms of looking for new trades, I'm relatively flat. Unfortunately, missed the Aussie Swiss. I was looking at this on Monday, but of course, didn't get an entry. So this was at market close or market open. It was one of those spiking candles. So obviously couldn't really get in on that one. Aussie New Zealand's just providing absolutely no pullbacks. Can't get into this one technically speaking. We'll go over some of the fundamentals and edge finder readings in a moment, and we can sort of zoom into potential trade ideas. Dollar yen remains relatively interesting, but unfortunately there is no meaningful pullbacks here for me to get into, so I'm just kind of sat on the sidelines a bit like a cook. Euro Aussie, also not really that interested because I'm already in the pound Aussie trade. The New Zealand dollar, I'll get rid of the fib, it doesn't work in this one. New Zealand US dollar, also not overly interested. I think we could continue to see downside in this market. The reason I'm not that bothered, as I said, I'm already in the euro dollar and pound dollar shorts, so I don't want to get overly exposed there. Gold is taking a hit today, which is quite interesting. I mean, we're not in an environment at all for gold to be really supported in any way. I suppose you could argue the risk off sentiment, but that's not really a factor right now. So gold is down almost 4% just today, which is interesting. So I think in terms of levels for gold, we've got a couple of different supports here where we could potentially see a bounce. However, I wouldn't really be looking to be a buyer of gold. Actually, let's just see what the edge finder is saying, because it was bearish for a short period. So gold's not getting a reading bullish or bearish at the moment. So in this case, because I don't think we're in an environment for gold to rally, obviously we've got yields up, we've got inflation up in relation to oil. So I think it's more a case of central banks are holding. There is just better opportunities outside of gold for investors. So with that said, I think really the best approach is actually just selling pullbacks on lower timeframes. If you are long-term bullish on gold, which I am as well, I think obviously these could be areas for potential accumulation. But for sort of intraday trades or short-term swing trades, it could be more of an idea of just selling pullbacks and then sell breaks and any retests that we get to continue lower. I think that's quite a nice idea. But again, selling gold is a little bit of a tricky task to undertake. Sluggy, hello. Wiggler, nice setup, thank you. James TP for Aussie yen. Well, there isn't really a hard take profit. That's why I've not got them set. So it's more a case of just let this market run or let this trade run. When it comes to yen pairs, it's, you could have been saying the same down here. Like if I was buying here, what's the target? Well, it's I mean, it's simple in terms of just buy dips, let the market go, and then just trail stops. It's not really a case of something like euro dollar or pound dollar where they can be a little bit more volatile. Obviously, the trends can change pretty quickly. Whereas when it comes to yen pairs, really yen is just going to remain a funding currency, at least for this sort of near-term future, sort of like the next 6, 12, maybe even 18 months. So I'm not really interested in trying to cap it, to be honest with you. Next on the agenda is oil. Now, oil is having a fantastic recovery. So we got obviously the spike open. Was this last weekend? I think it was. Very, very quick decline and sort of recovery, correction, whatever you want to call it. However, the bullish trend is still very healthy. We have seen a very quick recovery from the previous recovery or correction. Again, it doesn't really matter what you want to call it. Bounce off the 50 moving average, and now it seems like we are heading higher. So something with oil. What I'm looking at on lower timeframes is sort of the left side at this top here. I would love to see this get corrected And then, I don't really care what happens after sort of 120. I know people are calling for $200 a barrel. Some people are saying 150. All sorts of different levels being thrown around. It doesn't matter too much. Unfortunately, didn't take any positions. So I'm, again, sort of sat on the sidelines with oil, sadly. Okay, so Edgefinder readings. I've just realized I'm on for a little bit longer today, so I don't have to speed run through things like normal. We can take a bit of a deeper dive on certain things if any of you would like to. Today was risk off day, clearly. Yeah, I mean, yeah, I suppose so. I think really the only outlier would be gold, really, in that case. So pound dollar is still getting a bearish reading. So let's go back and have another quick look at pound dollar. I didn't scale into this one. I decided to add into euro dollar. I prefer euro dollar. It's just sort of my thing. I like to DCA on euro dollar. However, my initial swing position on the pound dollar is still very, very healthy. And to be honest, in hindsight, yes, maybe a little scaling would have been warranted here. I mean, look at the fib here. Who can tell you that fibs don't work? I mean, we've got the bearish leg here, fib drawn from the high, bottom of the leg here, and that was the entry in this fib zone. And now we've got the new high here, a new bearish leg, and the low. And look at that fib rejection. So if anyone tells you fibs don't work, tell them they're lying, because James told you they do. Anyway, right, moving on. I think in terms of targets for pound dollar, there's lots of different areas. It really depends on what your time horizon is. I know a lot of you are in pound dollar shorts. Some of you guys are in my free Discord, some are in the private Discord. I've just seen some of you on social media shorting pound dollar. So I know it's quite maybe an exposed market. Maybe that's not the right way of saying it, but either way, I know a lot of people are in it. So in terms of targets, again, I don't really have a set hard level where I'm 100% going to take profit. It's more a case of I might trim the position very slightly. I don't really like to do partials typically. It really depends how this runs. But the plan so far, I know I've kind of drifted off from targets to management, but we'll go back to targets in a minute. Now we've seen a rejection of this level, and it looks like we're now creating or have created this lower high. The next real management move is to just trail the stop slightly further to this high we just created. The only thing stopping me at the moment is just this 200 moving average. I want to really allow a bit more room for any pullbacks and spikes we might get, especially with FOMC today. So I'm not looking to be overly aggressive with management, but trailing stops is the sort of current idea I'm going with. Target wise, we've got a level down here towards, let's say, 1.3. I think that's a completely reasonable target. It's kind of the target one, if you will, if you use different take profit levels. The second one would be this previous low over here. So this would be, let's just say 1.27, again, just for the ease of round numbers. Final take profit, if we really get some supportive data, everything goes in the way of shorts, then I guess we would say around here, let's just say 1.2, again, for the ease of round numbers. So we'll see how this one goes. Exactly the same logic applies to the euro dollar short. Ignore all the annotations. I was doing a lesson this morning. Actually, let me get rid of some of this stuff. Let's just get rid of all of it. Again, though, it's a great example of fibs being your friend. Exactly the same as pound dollar. You can see we've got the high bearish leg right here, low, pull back to fib. Again, same thing, exactly again. So let's just get rid of all of that. So that's my US dollar positioning. I got stopped at break even on the Nikkei, so I'm not really bothered about this one. I've been in and out of this a couple of different times over the past few weeks. We actually started going long here. So I stopped out once, took a small profit once, stopped out break even again. So yeah, a little bit of a messy, choppy market. Pound Australian, what's this getting at the moment? So we're still getting a bearish reading of -7, but my concerns are still there. So the concern I've got with this market is it's just very, very extended. So the weekly, I know it's a little bit small, so it might be hard for some of you to see, but the weekly RSI here, oversold. The monthly RSI, oversold. The daily RSI is actually okay, but if we then also go and have a look at the idea that we're very deviated from this 200 daily moving average, it's starting to plant some seeds in my mind that a mean reversion is absolutely coming. I've been saying this for the past, 1 to 2 weeks. And it's one of those things. It's like, I know it's coming at some point, but I don't know when. So it's kind of useless information. But it is something I'm a little bit, on the sidelines about. So if it comes, in terms of, if this position gets stopped out, we start seeing the daily time frame start to run higher. We see the weekly start to show signs of reversal. That will be the trade scrapped. I'm not willing to have multiple attempts on this trade, if that makes sense. So what else do we have? Dollar yen's getting a nice bullish reading. I've just realized I've completely forgotten about the chart. I do apologize, guys. I'm not trying to ignore all of you. Unfortunately, the start of the price action happened when I was asleep. Which one are you talking about? Fibs work, but not 100% of the time. No, I mean, nothing works 100% of the time. It's about obviously layering it on with other confluences. With the edge thing, no, I wouldn't agree. Is it live? Yes, it is live. No, when it comes to having an edge, I'm a big believer that retail traders don't have one. I really do not think it's possible for any retail trader, unless you are super high IQ, to have an edge. I know some people completely disagree, but if you think about what an edge in trading actually is, it's basically information that you can profit from that either no one else has or a very, very small amount of other traders have. Unless you are trading some sort of quant level with probability statistics, then you don't have an edge. Like, for example, the edge that I would assume you guys have, and me, and many other sort of macro traders, is not really an edge. We're just eating off other people's market footprints, So, for example, when a trend starts due to whatever it may be, central bank policy, differentials, whatever, we can see that, but that's not proprietary information. It's not an edge. That's not something that we found that no one else knows about. We find it and we're like, okay, we've got this information. We expect institutions to have the same sentiment, so we're going to go short, expecting them to also trade the same idea. So no, there is no edge for retail, generally speaking, of course. So what are we trading today? We're going full margin on US 30. We're probably going to go short US 30, minimum 50 lots, because Powell is very likely to hold rates. That's all. 100% joke, by the way. Please don't do that. Adds to the edge. Yeah, maybe. I had a plan to short gold if it fell under 49.70. Was asleep, sadly. Yeah, it's unfortunate. What you're saying is not an edge, it's inefficiency. What you are saying is not an edge, it's inefficiency. What do you mean? What did I say? It's inefficiency. Anyway, right. So silver's getting a bearish reading. I wouldn't be interested in going short silver, to be honest. I think silver, in my view, is still a very valuable commodity. It will continue to be. So the way I'm seeing silver at the moment is more of a signal to not start buying rather than a signal to short, if that makes sense. So it's a case of, regardless of really what silver does, if it's reading on the edge finder, I'm not doing it. Sorry, if it's reading bearish on the edge finder, I'm not going to do anything. But when silver does flip bullish, okay, that's my signal to start buying these lower prices, because we're starting to see a little bit of a discount in my view. I mean, silver was, what, 120, 125 at one point. We're now down at 76. This is quite a large discount in terms of the peak value. The daily is still bullish. The fundamental, when I say fundamentals, I don't mean the edge finder type fundamentals. I mean the use case of silver, the supply and the demand, the AI side of silver, or the AI usage side of silver. I still think it's completely fine. So yeah, I'd be happy to be a buyer, but again, not yet. Full margin, indeed. I'm using Python to trade. Very interesting. I use algo trade such as Monte Carlo and Kelly, GME, all that, but execute manually. Okay. Yeah, to be honest, Monte Carlo tests are very, very good to give you perspective on reasonable results. I did a reel a couple of weeks ago now where I showed a Monte Carlo test where I think it was just a 1 to 2 with a 50% win rate. I can't remember exactly what I did, but I showed the results. If you did that over, I think it was 50 accounts and 100 different trades, the results are really good. But of course, when you sat there actually trading and you take a 1 to 2 on a $500 account, not, what you're going to get, $10 back. So it puts into perspective sort of the longevity aspect of being a trader and letting capital compound and letting your strategy play its role and allowing for variance. Quants are finding an inefficiency that is not yet balanced by the market or not noticed by other firms and arbitraged out. It's called inefficiency edge. Is you having a method. Edge is you having a method. No, I disagree. I think from what I have studied, what I know about the more complex side of trading. When I say complex, I'm talking about quants, algos, those types of things. Again, edge, we don't have an edge. Can you name an edge that you have? It's like, well, no. I mean, I can't name an edge I have. It's like I look at some data and put together an idea and really, to be honest, expect other people to see the same thing and move the markets for me. That's in no case any skill of mine. The only skill really that I showed, or any edge, was maybe, again, looking at the edge finders readings. So I wouldn't consider that an edge. But that's, again, it's all opinion based in the way that I think about it. So Aussie Swiss completely fumbled the bag on this one. I really like it. I mean, it's getting a really good bullish reading. The RBA is still the most dominant central bank in terms of driving the Australian dollar bullish. We don't really have that with another currency. Sure, the dollar is doing very well as well. But the Australian dollar, in my opinion, is fundamentally bullish, not just bullish from the oil situation and obviously the war. So in terms of actually getting in, I find it very tricky to find an entry. If you were more of a day trader, intraday trader, I actually really like this pullback here, pullback into the 100 moving average. Very simple sort of buy the dip idea here. I don't do that. It's not really my style. I like to trade in the H4, the daily time frames, so a little bit too short term for me. But if that is your cup of tea, I think it's a reasonable argument. Shirls, hello. I'm not sure if I said hello earlier, but hope you're well. Using coding in trading is the best decision I have taken. Yeah, I mean, I don't really use code at all. I used it again for that Monte Carlo test. I do it to run some simulation. When I say I do it, I get ChatGPT to do it. But yeah, no, it's cool. But to be honest, even if I had an algo or some sort of automated system, I just don't know if I would trust it. You know what I mean? It's like I saw a horror story on X the other day. When I say the other day, it might have been a few months ago now. Someone had an algo and it was very diversified. It was very impressive actually, but it just went completely haywire. And I don't know why, but it did, and it lost a lot of money. So it's like, I just don't know if I'm intelligent enough to look at a load of code and be 100% satisfied that it could never go wrong. Anyway, we're getting really off topic here, I think. So I don't think there's anything here that is really very interesting to me. So the Russell position I was in got stopped with a trailing stop. So I didn't really get anything from that trade. And I'm not sure really if I will be willing to go back into shorts on the US markets just yet. I really like this. Actually, I've just noticed the behavior on the Nasdaq rejecting this 200 moving average continuously, I think, is really, really clean. Obviously missed this entry, unfortunately, but there's a potential idea there where it's basically selling these types of pullbacks. However, in the grand scheme of things, we are still not doing anything in these markets. We're still stuck in this sideways range. And this has been going since, sort of October, November period last year. So we've had a significant amount of time and just nothing is happening. We've got no directional movement really. I guess short term, yes, slightly bearish, but overall there is just nothing here. So in terms of the Russell with the edge finder reading, I suppose this low over here, so where would this be? Right here towards 2300 is quite nice. So if we could get into a short position, I think that is probably the main target I would go for. But again, I don't really like to be a short seller. And there isn't really a setup here for me just yet. So I'd need to see, how would we go about this? I don't really think there is anything. I was going to try and sort of force some sort of technical idea here, but I really don't think I can, because here it's kind of just range bound. So I'd need to see sort of a break of this range, then look for a pullback. But yeah, right now it's just consolidating. You're right about AlgoBot can mess up. That's why I've used manual for execution. Yeah, I think if you had something for some sort of algo or some sort of bot to work from, maybe the best idea, and this is, again, sort of from my point of view, being a bit uncomfortable letting a bot do everything for me, would be to turn it into an indicator. So at least then you're notified when there is a potential entry, then you can make that discretional decision on if you actually want to go for it. Obviously, that wouldn't work if you're trading the 1 minute time frame or something. But anyway, so oil continuing to run higher, almost at $100 a barrel again. So that will be interesting to see if we can break through. If we can break through this previous high here, I think we're pretty much set to revisit this next, or the previous sort of all-time high, this previous high here of, let's say 120 again for the ease of round numbers. I think that's a reasonable target to have. I don't know if there's really too much else going on here. I'll tell you what I've not done, actually. I've not seen what COT data is saying from the previous release. So Nasdaq's getting some bullish interest, which is strange, considering the Russell's really bullish. They sold off the Russell as well last week. Interesting that they decided to add to the Nas and sell the Russell. And the reason I'm saying that's interesting is just because there's no clear sort of narrative there. It's not a case of, oh, sell the US or sell equities across the board. It was clearly a targeted thing, or maybe it's specifically on the tech side, maybe it's specifically sort of the small cap side. I don't know. I don't really keep up to date with stocks specifically, but that kind of tells me I'm not really sure I want to be shorting the US markets just yet, because when I do go short, or if I do go short, I'd need to see a very clear sort of regime where it's obvious smart money's doing one thing or seeing one thing. The fundamentals are telling us the same thing. The technicals are also saying the same thing. In that case, or in this case, I just don't really get that enough to warrant going short. The Canadian dollar is getting a bid. Well, I'm saying getting a bid. Added long positions here as well, which again isn't a huge surprise given the oil, the strength of oil recently. The yen's getting sold, which also isn't a huge surprise. The pound, again, not a surprise with that one. So yeah, actually kind of expected, regardless of the Nasdaq and the Russell. Check Euro Swiss. Where's Euro Swiss? Here. Okay. Wow. Yeah, strong. I've got no idea what's going on in this market specifically. Is it on the Edge Finder? No, it's not. Okay. So automatically, no interest in actually being involved in this market. But given the trend, it might be an opportunity to sell. And I'm saying that as obviously a trend follower. Every time we come up to these moving averages, it's just a case of selling these tops, looking for continuation to the downside. Maybe that's a similar idea. If we can come up to this 200, look for a short position and just look to continue riding this trend. However, as I said, the Edge Finder is not giving us any bullish or bearish readings, so I wouldn't really be overly interested. Wished it bounced off 93 like I thought it would. Got stopped out when it went lower. Yeah, I mean, that's what every trader says. I wish it bounced at something. I wish it bounced at X level. Otherwise, I might have been in profit. Okay. So what else do we have going on here? US dollar is getting a bullish reading, of course. Let's see what's going on over here. Yields are on the move again. Nothing overly interesting here. The VIX seems to be picking up a little bit. So we were at sort of 25, dropped off. We're now seeing a little bit of upside here on the VIX. Nothing overly crazy, however. So let's see what the US dollar is doing. Sort of slap bang in the middle at the moment. Not a huge amount of sort of relative strength, if you will. Yeah, okay. So I know this might be a little bit confusing. All this is a currency index. So it's got the New Zealand, yen, Australian, Canadian, dollar, euro, and the British pound. So that's what all these lines are if you can't see these here. So it's just a way to sort of gauge the strength of a currency versus another currency without looking at the pair specifically. But yeah, I mean, the US dollar seems to be respecting its decade-long trend line. And yeah, so continuing higher. Nothing really that interesting either with the dollar right now, in terms of technicals anyway. AUD USD. Yeah, also not a huge fan of that one. I'm bullish on the Australian dollar and the US dollar. So it's a case really of I'm caught in the middle with the Aussie dollar. It seems the market's also got the same idea. Look at this sideways print. So we've got good fundamentals for Australia. The RBA is hawkish. We've got elevated oil prices, knock on inflation, central banks on hold. The US dollar fundamentals are also pretty good. So yeah, I mean, what would justify being involved in this market? In my opinion, there isn't really anything. I can't sit here and say Aussie dollar is bullish because of X or it's bearish because of X, because it weighs on both sides. Does that make sense? So in this market, you're kind of doing the opposite of what traders want to do typically, which is trading strong versus weak. You would really be trading strong versus strong right now. Could gold dump more, for example, to 4,800? Let's see. Yes, if it breaks this low, I think it's very reasonable to expect gold to start heading down. Yeah, maybe towards, let's say 47.50, maybe towards 46.30 potentially. But it really depends on if this support level holds over here. And also, don't forget, we do have news tonight or later today, depending on where you are. So I wouldn't really be looking to get involved with any markets right now. I'd rather wait for the news later, and then you can start positioning according to what happens or what is said. So oil's still getting a bullish reading. As we've already looked, oil is doing phenomenally well. Aussie yen, already in Aussie yen. The dollar yen, interesting. I think, as I said earlier, it's still a case of just buying dips, really, if you can find them. However, the fact that the dollar yen is still coming up to the previous all-time high, which is, let's just say 162 again for the ease of round numbers. I'm starting to get a little bit concerned that the intervention or an intervention could be on the way. Now, when I say concerned, I don't mean immediately concerned. I don't think we're going to get a MOF intervention here or even here. I think we really need to start breaking this previous all-time high and continuing higher. So let's say 162 to 165 would be kind of my danger zone of thinking, okay, maybe I either want to avoid this market or start trailing stops pretty aggressively, because in an intervention, you can't do anything. It's so quick, it's unannounced. It's a case of tough luck, or if you're short, then, you know, you got lucky. Okay. So we've got half an hour left. I'm just thinking, is there anything interesting? Let's take a look at Bitcoin, because Bitcoin has had a very rough start to the year. And I'm not sure if I'd be willing to get involved with Bitcoin just yet. Yeah, so what I've been saying about Bitcoin is I'm a little bit cautious, because when we look at these previous crashes in Bitcoin, they've been quite severe. So let's say 75, because this one was 74.6, this one was 80, almost 85. So let's just say 75 to be a little bit generous. So that would lead Bitcoin to a price of around 30,000. Let's just round up or round down. So the fact that we've not had a large bid off this level here, bearing in mind this is also a weekly 200 moving average level. So let's go to the weekly here. So you can see the same level is just not really having a huge reaction. I think if we were going to see Bitcoin bulls really step in and we were really going to see a bullish cycle, this was kind of that place it was going to happen. And the fact that we've not really seen any follow through, the daily's bearish, the H4 is bearish, kind of makes me want to go short. But I don't think I would do that. But if we break and retest and continue lower, it really wouldn't be a surprise to me. But as I always say, I need to put a disclaimer here. I don't trade crypto. I'm not a Bitcoin trader, so take that with a pinch of salt. But I'm definitely not optimistic here. Retail traders are 100%, 80% long on oil. Yeah, it's not a surprise. I mean, retail are always chasing the markets that are moving. I mean, traders chasing markets that move anyway. But yeah, I mean, in this case, I wouldn't really overthink retail positioning. I mean, clearly being long has been the best idea here. What about dollar card? Yeah, kind of same thing I said with the Aussie US dollar. It's not really a market that gives me any interest. And you've got to think about what's driving these currencies. So with the US dollar, we've got obviously a little bit of safe haven flow. We've got elevated oil prices, which are keeping sort of this global inflation idea alive. Central banks on hold, the Federal Reserve on hold, very likely. I don't think anyone is really expecting the Fed to pivot dovish or start cutting rates. That's helping to keep the US dollar elevated. Yields are up for the US as well, in fact, across the board. And then we look at Canada. Well, sure, the Canadian fundamentals may not be super strong, but obviously higher oil prices are benefiting the Canadian dollar. So again, it's kind of strong currency versus strong currency in this case. Yeah, I mean, what can you do? If you were looking to go long or short, you need to say, okay, why would I be bullish on the dollar? Why would it be bearish on the Canadian dollar? And you've got to be able to say what it is that is making you think either way. Does that make sense? Okay, so Australian dollar CAD's wiped out for exactly the same reasons. I'm bullish on both currencies. Australian dollar yen, long, already said that. US dollar, Nasdaq. So Nasdaq's getting bullish. I just realized the Russell's fallen off the bearish reading as well. So maybe Nasdaq is something we could look at. Being a buyer generally is going to be a lot easier than being a seller, just because the natural drift of these markets is to the upside, as we should all know. And I've just seen here the daily has bounced off this 200 moving average really, really nicely. So depending on what's said tonight, if it's not super, super hawkish, maybe there is an idea to be a buyer of the Nasdaq. However, this H4 trend is a little bit unconvincing. So yeah, I think, to be honest, the best idea, in my opinion, is just to stay away here. What else do we have? So let's see. So New Zealand dollar is getting a bearish reading. Australia, Euro, Australian. So yeah, I mean, there's a clear theme. So the theme here is buy Australian dollar, sell the pound and the euro, buy the US dollar. And that's kind of it. I mean, again, clear theme, clear market conditions. Well, sorry, not necessarily market conditions in terms of price action. I mean, clear as in the sort of the mechanics that we're in right now, the regime we're in, if you will. So let's just do a quick checkup. So a little bit of a pullback here on euro dollar. I would imagine same pound dollar, yes. And the pound Australians continuing to move a little bit lower, but I won't really be overly satisfied until we can start clearing this previous low here at around, what would that be, 1.868. The Aussie yen also continuing higher, which is nice, and Swiss yen is still pretty much break even, so really nothing of interest on that one. I think it's a little bit difficult because I think being a buyer of oil is still a fantastic idea, but it's like, do I really want to be a buyer? Technically speaking, not fundamentally. Fundamentally, yes, obviously. Technically, not really, because I just don't see a way in. So the way what I was wanting to see previously was this sort of action here, where it was just, bullish leg, pull back 50%, retest these previous highs, and then continue higher. Granted, maybe a little bit of an optimistic expectation or need or want or whatever you want to call it. But yeah, given the current price action, I can't justify getting in here. Gold seems to be respecting this low quite nicely as well. Now, unfortunately, as I said, gold isn't getting a reading on the hedge finder. If it was getting a bullish reading, absolutely, I'd be buying here, just because I think this is a really strong opportunity. Maybe it won't work, obviously, but I think the risk to reward might be worth it. But again, I'm not going to do it because it doesn't go in line with my rules. Let's take a look at the Canadian pairs here. So pound Canadian seems okay. Again, there's not really much of a technical setup here, but given the fact that the pound is getting a bearish reading on the edge finder, pound dollar, pound Australian, and obviously the Canadian dollar is strong by proxy of oil, maybe pound CAD could be a good short. Same thing with the euro CAD. Yeah, but again, in terms of technicals, it's not the most clear. I think EuroCAD has maybe some sort of idea like this. Again, not the best, not super clean, but maybe you could argue it. I appreciate the song, I think. Yeah, not sure what that is. I recognize the lyrics, I think. I don't recognize the lyrics. I'm lying. Anyway, let's move forwards. What else have we got going on? So seasonality, and I was thinking about this earlier. So when we have a look at the S&P, the bullish seasonality has started now. Let's go to the daily so we can see it a bit better right here. Yeah, so the bullish seasonality started. Let's see exactly on the Edge Finder. Seasonality scanners, annual seasonality. And the S&P. Yeah, so you can see here, we may have bottomed. Of course, this is purely accounting for seasonality, not the fundamentals or anything external. But maybe there is an opportunity. Bearing in mind, this is a 200 daily moving average. So if we can see some reason for the S&P to flip bullish, whether it be the Edge Finder, whether Powell says something, whatever it may be, I think it might be worth going in long, very small, of course, not a massive position, but yeah, just given the seasonality, the fact that we haven't done anything for a pretty significant time, maybe we're due for some sort of explosion to the upside or some break of this range to the upside. We'll see. Again, I'm not necessarily bullish fundamentally. I'm not necessarily bearish either at this time, but it's something to keep in mind. Okay, so let's go and have a look at the macro only scoring. So Australian dollar Swiss, well, Australian New Zealand, this has been a pain. I think I mentioned this when I came on, but yeah, it's just not giving anything. So every time we have a pullback, it's just not deep enough. So now it might be a case of actually just removing the previous fib and looking for something more like this, which I think is reasonable, but then it gives me a problem because I don't like this left side. This gives me a feeling that we need to see a little bit of a correction, or we could see a bit of a correction lower. So yeah, I'm just really unhappy with the price action here, but fundamentally still a fantastic trade. Australian CAD, oh, we spoke about this one earlier. Basically no trade on that one because both currencies are bullish in my opinion. Euro, Aussie, New Zealand, US dollar, pound, silver. Silver's getting a more bearish reading here. So let's have a look at silver. As I said, I'm not looking to actually go short on silver, but we can always have a little bit of a look-see and see what we can find. There isn't really anything, actually. I mean, we just flipped bearish. The moving average is now in a bearish trend from this very slightly bullish trend here. So there's a bit of a change in technicals, but again, I actually don't see anything here really. So maybe there's something like this. Even that's a little bit weak, but yeah, I think a lot of price action that we're getting at the moment, it's kind of just continuations in terms of, you know, Aussie, New Zealand, oil, pound dollar, euro dollar. A lot of it isn't really price action we can actually execute on right now because the moves have kind of already happened, which is a little bit disappointing, but it is what it is. What can we do? Yeah, Sluggy, I said that earlier. I'm not bullish necessarily on the Canadian dollar fundamentally, but if we've got oil prices heading back up to 120, I think it's a little bit silly to sit and say the Canadian dollar is bearish. I just don't think that doesn't work in my opinion. Ugly, hello, hope you're well. Happy Wednesday. So we've got about 15 minutes left. So if there's anything you want me to cover specifically, let me know. If not, I can continue yapping for a little bit. Although I don't think there's anything really I can yap about because I have kind of already done. I've just noticed New Zealand US dollar is getting a more bearish reading than it was. So let's go and take another look at that one because I kind of sidelined it because I've got max exposure right now with obviously euro dollar and pound dollar. But they are, well, pound dollar is risk free. So I could get into another position if I see a setup I don't want to miss. So I guess it would be something like this. So if just looking to the left here. So yeah, I think I would be quite happy with something like this. So if we come up to the, let's say the 61.8 roughly, I wouldn't mind having a position something along these lines, clear out some of this left side, and then yeah, just sort of continue lower. Again, the fundamentals are bearish on the Edge Finder quite nicely with the score of -9. We would allow some room for our moving averages here with our stop loss at the fib anchor or the high. got a little bit of previous structure in here. Yeah, I mean, to be honest, the technicals are fine. I actually quite like it. The only thing that I'm a little bit worried about is the fact that we tried to come down here and we're seeing a little bit of a pullback to the upside. But overall, I wouldn't mind taking an attempt here. C-Trader global issue. What do you mean, Max? Is there a problem? I re-entered New Zealand US dollar. Very nice sluggy. What do you think about pound yen long? Contrarian markets have overpriced Bank of England cuts, but oil prices will take inflation higher. Yeah, so I do agree with your sentiment. I think pound yen could be a fantastic trade, obviously with the idea that the yen is still a funding currency. Yeah, I mean, if you can find a dip to buy, I think it's, yeah, pretty simple. Look, just take the position. Yeah, so you got my support on pound yen. I think it's pretty solid. In terms of getting an entry, again, kind of difficult. As we said with the dollar yen, it's not the easiest in terms of actually trying to find a position. I think, yeah, unfortunately, I missed this. This would have been a fantastic opportunity. So it's a case really of just looking for the next high to get printed, draw the fib from the current low that we've just printed, wherever the next high may be, then pull back into the fib and then continuation higher. That's the only thing I can really sort of give you in terms of technicals right now. Do you hear about MicroStrategy buying a load of Bitcoin? Yeah, I think he's delusional. I think he is reckless with his risk. I'm not, I'm not someone that necessarily is bearish on Bitcoin or think it's useless or anything like that. I don't really know much about it, but from what I have seen, it's not good on like the back end side of like the finances and debts and all those types of things. Because the reason I say that is because I was looking to buy MicroStrategy as a stock and just hold it for a couple of years. I was like, wow, it's gone down massively. I'm not sure even how much it has gone down by. Let's see. I know it's had a real hit. What's measurement tool here? Oops. I mean, that's not even the peak. It was up here, wasn't it? So yeah, down what? Let's just say 70%. So I was thinking, okay, kind of a leveraged way into Bitcoin through a UK investment firm. It's down 70%, and Bitcoin, I don't think Bitcoin's really going anywhere. I think long term, sure, it could reach 200, 500 million. I don't know. I don't care really. But either way, I was thinking, yeah, maybe quite good. So I contacted one of my friends who works in investments and asset management and those types of things. And he told me to stay away. And that was when it was actually down about 50%. So since then, it's gone down an extra, 20, 30%. So yeah, overall, I'm not very impressed with it. I know that's a very long way around saying it. Can't manage any position on different firm / accountancy trader. That's not good. Yeah, it's really bad actually. Yeah, I don't know what to suggest on that one. If your platform is broken, maybe contact your broker. Your broker should be able to manage the position for you if the platform's not cooperating. I had to do that once, but it wasn't because of platform issues, because I couldn't get to a computer. So I had to call my account manager and ask him to close the position for me. Unfortunately, he didn't do it. he didn't do it, but it was all right in the end. But yeah, maybe call your broker. They might be able to help you. Bitcoin might do a liquidity sweep on Master. Oh, Master, MSTR. Maybe. Euro NOK short. Yeah, I mean the NOK is a good the NOK is a good way into sort of benefiting from the oil strength, if that's what you're looking for. We actually, you know what? Just bear with me for a second. I want to see what pound NOK's doing, because that's annoying. We were short on the pound NOK. I think it was somewhere around here. We went short and we just sat in sideways price action for so long. So we closed it actually not even breaking. I think we closed it for a small loss, and now it's obviously doing what we wanted. Anyway, sorry, let's go back to Euro NOK. So yeah, I mean, there's not much else for me to say. I think central banks sort of stances across the board is pretty much just holding. I don't think any of them really have a reason to do anything. Even the Bank of Japan, I don't think will hike their rates until they've fixed a few issues. So Yeah, Euro NOK. I'm just trying to think. I don't really know the NOK that well. It's not something I keep up to date with. But I mean, given the trend, given the oil strength, and the Euro's really not impressive right now, I think a case of looking for maybe something like this, which is just the next sort of fib, which could even be like this. So that would provide you obviously a previous level of structure here. Pull back, retest this level, pull back into sort of the fib, and then continue lower. I think that's quite reasonable. But again, it's not a market that I really trade at all. So do your own research as always. Yeah, expected to hike. I also heard that, but I wasn't confident enough to, or I didn't know enough about it to warrant saying it. Haven't left my chair today. Well, you're a true trader then. So yeah, I'm just thinking if there's anything else I want to go over with you. I don't think there is. Again, I think just buying oil on dips is relatively smart if you can find a dip. Obviously, don't go chasing. Gold, I wouldn't really want to do anything just yet on gold. It's not getting a reading either way. And the edge finder, gold's down, so I would stay away from that market personally. New Zealand US dollar, I would quite happily sell if we can get into this fib level. If not, I've got no interest. Euro Aussie, maybe I would. Yeah, I wouldn't mind selling it fundamentally, but I've got no reason to be involved. I'm already long on the Aussie yen, already short on pound Aussie. So again, I already have exposure there. Dollar yen, again, I would quite like to go long if we can get a pullback, which doesn't seem to be the case right now. Aussie New Zealand. Now, we already covered this one. I'm just doing a bit of a recap before I head off. But Aussie New Zealand, not providing really the pullbacks I would need to see to get in. There is this idea, obviously, with the fib from the low to the high. But the thing that puts me off that is, again, just this left side. I really don't feel comfortable buying after this. Just because typically these types of candles do get corrected. So that puts me off a little bit. I would still attempt it, but lower risk than normal. And the Aussie Swiss, very, very good position on the Aussie Swiss if you can get in long into a sort of a healthy pullback. But again, these H4 timeframes, daily timeframes providing nothing. The H4 pullback you're waiting for is also a weekly level on NU, is it? Wait, that's not the right market. Pullback I'm waiting for is a weekly level. I suppose maybe I need candlesticks. Oops. Here. Is it? Oh yeah, I suppose it is through here, isn't it? I didn't see that. Yeah, fair enough. Maybe that could be the play. Let me put my area chart back on. There we go. Okay, right. Let's see. Let's do another quick check on the open positions. Let's go down to the H4. So euro dollar really not doing much. Pound dollars, again, also not doing too much. Pound Aussie, not doing much. This one, Aussie yen's doing quite well. I really like this position, actually. I'm very, very happy with it. I'd quite happily scale in, actually, if we can start breaking this previous, if we can start breaking above this previous high. So let's say something like this and pull back. Maybe this would be a 50% retracement and then continue higher. I'd quite happily scale in and add to that position. I really, really like it. Same thing with the Swiss yen, actually. If we can get a clean move to the upside, I'd quite happily scale into this one as well. I really like being a seller of the yen at the moment. And yeah, that kind of wraps up everything I'm interested in, at least. Isn't the NOK economy worthless? Well, I think Euro NOK would disagree with that. if the NOK economy is worthless, then what's that make the euro or Europe? Of course, I understand that's not quite a one-to-one statement, but anyway. So Bitcoin, I've just seen, is getting a bullish reading. Actually, I didn't notice that earlier, so maybe that could change the idea. So now I'm looking with a potentially bullish idea. Now, again, I don't trade this market, so take it with a grain of salt. But what I'm seeing is, obviously, we've had a pretty large bearish move over the past, recent history. We've just seen the moving averages cross here. They look like they're about to cross here. Could this just be a pullback into a moving average cross and then bounce? Maybe it could be. So again, that could be maybe a buying opportunity if you see some sort of rejection and you're personally bullish on Bitcoin. Maybe that is an idea. But I think my point from earlier still stands. The fact that we've not seen a huge amount of follow through after touching this or rejecting this 200 weekly moving average is a little bit of a red flag to me. And this daily time frame is looking quite violent. I mean, I'm not sure I'd want to buy into this. So, yeah. Oh, wow. A1 team scaling up. They're now on Twitch. I noticed another platform as well. I'm no idea what it is, but Twitch, Kick, Facebook, YouTube, and I'm fairly sure on X as well. Crazy. They must have some good internet. NOK economy might be slow, but high nat gas and oil probably keep the currency higher. Yeah, that's exactly it. We also got, hawkish central bank by them as well. So that, there is arguments obviously to be bullish on the NOK, Canadian dollar, and basically by proxy of sort of the oil strength. US dollar, as I said, remains bullish. So I'm quite happy to, kick, quite happy to keep buying the US dollar. So I think really the idea that I've got is very straightforward. Hopefully you've all understood sort of my theme or my ideas from this stream. I'm just trying to see if there's anything else. I really don't think I've missed anything, but it has been a while since I've done a 1 hour stream. So I do apologize for just sort of rambled on this whole time. Let me see who's on next for you. I think it's Trade Like a Tiger. I think, but I have no idea. We'll see. Only saw Clav Guy on TikTok. Yeah, I don't know. I don't keep up with the social media stuff really. Okay, so I'm just trying to do a final quick check. So that's good to see. The pound is still getting a really bad reading. I'm not sure if any of you guys were in the webinar that was hosted back in November. So I was calling pound bearishness into this year, which has been pretty accurate, actually, I must say. Quite proud of that call. Australian dollar is obviously at the top, the most dominant currency right now, especially in developed markets. The US dollar is just slightly behind with 72%. So that's also a very nice sign. Swiss is getting a bearish reading. So dollar Swiss long, maybe. Let's just do a quick check on that before I head off. I've not paid any attention to dollar Swiss at all, but maybe I've been overlooking. Yeah, actually, maybe not. This is a bit of a concerning level, although it does look like we're about to break it. So the fact that we came up, this maybe would have been sort of the rejection zone if we were going to continue lower. That's kind of what I would expect. The fact that we failed to break out and we're immediately retesting makes me think we might see some sort of break and retest to the upside here. I'm not going to trade that, not really my style, but I think it's not out of the question that we could continue to see dollar Swiss continue higher from here. Obviously, we've got the bullish US dollar. Swiss is getting a bearish reading. It's clearly not catching much of a risk-off flow in the current market, so I think that's quite a nice idea. Do you think AI could realistically support trading education, like reviewing trade journals between coaching sessions, or is that too unreliable? Yes, AI, I don't really have time to cover this. I'll do it very quickly. AI can be absolutely fantastic in trading, but only if you already know what you're doing. There's a fantastic example, but I don't think I can speak about it here. AI is very, very bad at giving you analysis unless you provide it with the analysis already made. So for example, if you give it 20 bank reports, or you give it all of the Edge Finder data, all the economic data, the top setups, yields, all that sort of stuff, then maybe it can do an okay job. But if you just say, analyze the US dollar or analyze the UK economy, it's going to be outdated, very likely, and it's just going to be awful. So you either need to provide it with all the information, or you need to be knowledgeable enough to know what is right and what is wrong, because AI is fantastic, but it does give you a lot of bad information, especially on current topics that it doesn't have access to. Anyway, right, I'm going to head off, ladies and gentlemen. My time has come. I think it's Trade Like a Tiger that's coming on, so don't go anywhere. You're in great hands with him, and I'll see you all later. Stay safe. Good luck for the news. Don't gamble. Stay safe, and don't get margin called.
If you are a swing trader and you are looking to get funded, then check out today's video sponsor, Ola Prime. Ola Prime has a challenge built deliberately for swing traders. Check this out. The Prime Challenge offers the ideal setup for swing traders with leverage up to 30 times. They also allow news trading. Weekend holding is also allowed. They offer up to 95% in rewards, and they have a 100% challenge fee refund available if you are able to complete the challenge. I know that a lot of people who watch these live streams tend to be more swing trader focused. So when looking for a partner to sponsor today's show, Ola Prime stood out as a perfect candidate. If you'd like to check out Ola Prime for yourself and get a live stream discount, then check this out. Simply use the promo code A1Live, that's A1Live, for 35% off any of their challenges. As always, make sure to do your own due diligence to see that this is in fact the right firm for you if you are looking to get funded. All the information will be now dropped in the live stream chat or in the description down below. Now back to the stream.
What's going on, everybody? Happy hump day, rather. Sorry, I'm about a day behind. Happy hump day. Happy Wednesday. My gosh, I've been busy the last couple days, losing track of the time. Hope everybody's doing well. We have had already our Canada rate statement come out. They did maintain 2.25%. I do think it was 2.5 on the bank rate and 2.2 on the other rate. I can't remember off the top of my head. What was it? Deposit rate. Okay, there you go. So yeah, just more mumbo jumbo on their speech as far as the Middle East issues going on. What else did they put on here? Talking about oil and natural gas rising as far as the prices there. They did expand 2.4% rather in the third quarter last year, but they contracted 0.6% in the fourth quarter. So they did definitely want to point that out. The domestic demand grew by 2% due to the strength in the consumer and government spending. And what else did they put on here? Inflation, CPI, eased 1.8% in February, which was down from 2.3 in January. What else did they put? Yeah, they obviously maintained the 2.25 policy rate there. So there you go. Dollar CAD, just taking a look at that, really hasn't moved a ton. Canada has shown a little bit of strength. If we go take a quick peek over here, dollar CAD, and that was an 945 rather candle that I need to be looking at, which is up here. So there you go. A little bit of dollar weakness, a little bit of Canada strength so far. So that is your up to the minute look on dollar CAD. I'm not in a trade at the moment, guys. I've been quite focused. On my other projects. So I thought I just might mention this to you, and then I'll take a look at whatever chart you guys want me to look at. I'll be on until I do believe Marco is coming on after me. So if you guys have anything, I see you, Swiss Yen, Joseph. We'll definitely take a peek at that. But yeah, just real quick, guys, this is a new project I've got going on. If you guys have heard of FX Empire, they got about 130K subscribers, not quite Trader Nick level, but hey, they're growing. But I'm on here creating content with them now and doing some analysis, some financial analysis. So definitely, if you guys want to go, piddle around on here, take a look at some stuff. I've already put on a couple videos. I threw a couple shorts on. I kind of got a goofy face on it, so I'll have to play around with that. But anyway, guys, it's just bite-sized, analysis, geopolitics type stuff. Covering primarily the commodities markets, but I do obviously dip into the FX market as well, since it is called FX Empire. So that's another project I'm going. It's not taking me away at all from A1, guys. I'm just actually having to move my personal live stream, off to the either later part of the morning or maybe even the early afternoon. I haven't figured it out yet. I'll figure that out, and I'll get you guys some more info on that. But having said all that, let's take a look at the top setups real quick just to get an updated look. Guys, not a whole lot has changed. Aussie is still showing our strength over here. If we look at the Aussie, still at the very top, dollar's right behind it. And then you got the pound still in the cellar. I mean, those percentages have not changed on the pound nor the Swiss franc as far as the weakest of the currencies. So pretty much the same thing. Buy Aussie, sell pound. Pound dollar did come into, I know that's on our top setups as one of our bearish items down here. It came into a supply zone the last day or so, but I just wasn't quite feeling it. I'm kind of glad I stayed out of it. Let me see here. Turn on my drawings, see where I'm at. Yeah, right here. So we did bounce into this 4-hour, 1-hour supply zone confluence, and we did kind of peek through the top of the zone. So as far as I'm concerned, that liquidates the unfilled orders. In other words, it didn't start moving until it pierced through the rest of that zone. So I don't know. I'm a little iffy on this. When we did finally break out of this little consolidation point here, we had an okay amount of volume spread analysis activity, but not enough to really get me too excited about it. I don't know. I'm just staying away from it. I know a couple other guys have been getting into it, but I just personally didn't really like the picture on that. More so the 2-hour zone. If you guys remember, I drew up this 2-hour candle. Showed you guys that yesterday. It just chewed around in there. I mean, you had a fight between the buyers and the sellers at the upper end of that supply zone. So, yeah, we did get a nice breakout. It looks good on a 2-hour time frame, I have to admit, as far as the volume spread analysis goes. But bouncing into a very close by demand zone, I don't know. That's just a little too much. I would have preferred to see, the nearest demand zone much further down, kind of like what we bounced into previously with this, higher time frame zone that I drew up way back in December 2nd. So I don't know. It still might be a good opportunity, possibility of looking at maybe a second chance opportunity on it. Second chance meaning it's already kind of made its initial move, but perhaps we retrace into a smaller time frame supply like we got up here in the 133.5 area. I don't know, possibly, but there's a lot of candles to the left for my taste. So I may just let this one very well slide by. You had pointed out Swiss yen. And before I do forget, guys, definitely check out olaprime.com if you guys are looking for other type of a challenge firm. Okay. Nick does get a 35% off for all the viewers. A1 Live is the code to punch in manually, or you can simply whip out your cell phone, your smartphone, and click the QR code to get it. So let's look at Swiss yen for you real quick. And I do believe, yeah, we're still pretty well neutral on Swiss yen, but we'll have a look at the technicals for you. Okay, we still have on the daily, we've got our 8 above our 21 EMA. I do like that. We have kind of broken this structure over here with these most recent, I guess you could call it a double top set of candles over here and wicks, but we really didn't close. So because we didn't close, we just left a wick in its wake and came back and retraced. It's just a little too congestion-y for me. I don't know if that's a word or not, but hey, I created that. So we are in that master pattern orange box that you see drawing up there. Again, that's just more consolidation, especially on a daily time frame. I really like to start looking at trades after it leaves that box. So, but if we look over here on the left side at our 4-hour, you guys see I did draw up a daily 4-hour demand zone, which is underneath the breakout. But really the kind of the cool thing about this and with master patterns is when you get these boxes, what it'll do is it'll spit out a median line, a zero line, if you will. It's basically the 50%, middle of the box. And that often in itself acts as a kind of a dynamic support and resistance line. So it just so happens to be going through this daily 4-hour demand zone confluence. So I kind of like that, I got to say. At some point, price will leave the box, test liquidity on both sides. So perhaps it wants to test it underneath, scoop up the liquidity, scoop up the unfilled orders from both of these sets of eyeballs over here and look for a push up. So that's something I would keep my eye on. I just would love to see the Edge Finder give us a bullish signal on that. So I hope that helps on that. Your long dollar yen up to 160. Yeah, hey, 160, guys. That's that yen intervention area. Okay, my little play on words there. So we definitely want to be careful up there. It is quite a premium price, if you ask me. And not to mention over here on the daily, hey, just keep in mind we do have some supply zone, some higher time frame supply zone confluences up a little higher. I mean, you still got 100. You've still got 100 pips or so to start worrying about that. This is a weekly supply, which is the orange box. And then right here is our daily supply. It's a little higher up. So still quite a ways away. Might have some good, if you're not afraid of the weekly supply, I would definitely keep an eye out if it gets up here to the daily, because that's where we have the daily zone traders sitting there waiting for, possible push back down, because there will be unfilled orders up here, guys. So yeah, I think you got some room to run on that. We did bounce off of some demand zones over here. Let's have a look. Now, it hit in the middle of the night while I was asleep, dreaming about waking up and being on Trader Nick's stream today, guys. So I missed out on that trade. If we take a look, we do have kind of a 1 hour demand zone, but you see a couple dashed lines there. I think I actually dropped into was it a 15 minute confluence? Yeah, here we go, guys. So we got a couple 15-minute candles here. I just basically put a confluence line above the first candle and then the last red candle before the spike up. So, but nevertheless, we dropped into it, collected those unfilled orders, and made the push. There you go. Now, for me, if I would have gotten into this trade, I would have definitely been probably out by the time we reached this 1 hour supply, because that 1 hour supply ended up, looking fairly decently strong there for a while. It broke some structures over here to the left, a double bottom. So it broke a double bottom and closed, collected that liquidity, these stop losses, and made another push up into that supply zone, where that supply zone did what? Pushed it down to the demand zone. It just barely wicked in. But for me, the reason I didn't get in over here was because, again, I was waiting on the 15-minute confluence, and it just barely missed it. And this was 8 a.m. yesterday when it hit. 8 a.m. my time, guys. I'm here in Kansas City, as always. I'm always an hour behind Nick. So anytime you hear me refer to times, I try to translate it, but sometimes I forget. So because it did not hit that confluence, though, that's why I personally just waited. And you know what? Sometimes it only takes one zone. In this case, the 1 hour caught enough of a bid to push it up, but not enough to push it to the profit target. It ended up taking that 15-minute set of eyeballs to catch the bid to push it to the take profits. So just be careful with where price is at the moment. It very easily could take away all your unrealized gains back to the downside. But if you chew through that, think you're golden. Take it to 161. Why the heck not? Nicholas, yeah, I'm doing wonderful, my guy. Yeah, like I said, guys, sorry I've been absent on my personal stream. I got my new position, so I'm playing around with my schedule. So I don't yet know what I want to do. Do I want to do an afternoon show? Do I want to do an early evening show? I used to do that when I was with Ola Prime. I used to do a 2 hour block from 9 to 11 Eastern time, and I liked it. We had a pretty decent group of people on there, but I don't know. You guys tell me, would it make sense for me to add in a late, early afternoon or late afternoon show? If I get a decent sized group, I'll do it, because I'm basically spending 6 hours with FX Empire, and I got the whole evening to myself. So you guys tell me what you'd like. If you'd like it, just let me know, and I could possibly just test out an hour or so. So anyway, that's dollar yen. Hope that helps on you, my friend. Intervention. Yeah, you like my play on words there, KDX? Yeah, I was on Ola Prime's team. Yeah, we started up the live stream there. They basically gave us a 6-month budget, if you will, but they didn't quite get the viewership they were expecting, so they ended up closing it out after the 6 months. But nevertheless, they did say we could potentially add it again in the future. We'll see. I've kind of got another job now, so I don't know if I'll be able to, but I think I saw a New Zealand one. Yeah, New Zealand dollar, Biggie Dub. Yeah, let's have a look, because I do believe we are still getting a bearish signal. Yeah, -6 on that. So Kiwi dollar. Let's see if we can sell the Kiwi dollar. Make you holla. Okay. So keep in mind on the Kiwi dollar, we are getting close to a 4 hour daily demand zone confluence. Okay. So we got the yellow, which is our daily. Why did I draw that up like that? Let me zoom in real quick. Maybe that was a weekly. I must have drawn that up as a weekly. No, I didn't. I don't know what I was doing or what I was on, or I haven't had any drinks recently, so I know I wasn't drunk. Daily demand zone would look better like this right here, actually. Yeah, because this is a pretty efficient market down here. Guys, on a daily time frame, there's really no gaps. The first gap we see is from the proximal line here to the bottom of this here. So we always skip the leg out candle when we're identifying a strong demand zone. We have to have our basing structure. Oh, that's why I did it, because I was just incorporating the wick. Okay, that makes more sense. So yeah, I do want to do that, because I was kind of looking at this red candle as a little bit of the kind of the leg in, and then really 3 basing candles. Okay, I see what I did. But anyway, the gap on that thing, guys, is from here to here. So that shows our inefficiency in the market for this particular time. And that is the closest gap on a daily time frame to the origin of this overall strong move up. So that's always the basis for where I start, drawing up my demand and supply zones. But dropping into the 4 hour, just to show you that confluence point again real quick. We were basically looking at, what was I looking at? From here to here. Okay. So I was basically incorporating that skinny doji candle along with the legs out. So that's really where I would suspect the 4 hour traders are sitting there waiting, licking their chops for price to come down. And as you can see, we actually flirted with the daily zone, but we did not touch it. So it's unmitigated, guys. So, again, we got to push up. This supply zone here kind of slowed things down. And, currently it's just trying to decide if it wants to go up or down. So if it comes down, though, just be careful. Just be careful, because you've got your 8 EMA way below our 21 EMA. So that's a clear downtrend, along with the, needless to say, the lower lows and highs. As far as a profit target goes. Now we're trying to sell this thing. But yeah, this supply zone, even though it was, kind of matching up with some former support, and not to mention the blue line you see, if I go further to the left, you'll see a major one. But it was just kind of hanging out in that 50% retracement area. I personally like the top third, guys. You hear me blabber all the time about the curve analysis. So, I would say that blue line there is probably about the start of the 66% line. So that's what I would want to short it at. But there's just too many ugly wicks up here. There's no clear-cut zones. There's no clear-cut basing action with gaps down in here. That's efficient. Banks don't care about efficiencies. They care about inefficiencies, right? That's where the liquidity is. That's where the unfilled orders are. So I don't know. I don't like it. I think it needs either a big retracement, but honestly, I would prefer to see it just break through the demand zone all the way down here, close, and then retrace maybe into a new supply zone that forms around this former support. So that's kind of my outlook on it. Not really any trade for my taste at the moment. Let's see what else we got up here, ladies and gents. What else did I have? I did draw up a couple things here. So yeah, we had that. So the Nasdaq actually dropped into a demand zone earlier, but it was right just before the Canada release came out. Now it's Canada, but just because it's not a U.S. report, I still want to be a little careful around that time. Where's my there we go. Nasdaq. Let's go have a look at this. Okay, so I had drawn up over here, and speaking of Nasdaq, it was giving us a +9 score over here on Edge Finder. But the challenge with this is our EMAs aren't helping us out. Taking a look at the daily, okay, we got an 8 below the 21. You guys can clearly see that that's going down. Now, had a big spike down, but then it's just done nothing but go sideways with a bunch of ugly wicks, guys. I look at that as, here, let me reset my chart. Again, it's just consolidation. It's a bunch of retail chop, guys. This is where people are getting chopped to pieces. So the trend ain't helping at all. Now, one thing I was looking at is this zone down here, because we did base and we did have a really strong push up. It did kind of break this structure here and close, but not the main one. So I don't know. I was keeping an eye on that. I may just ignore that. But we did, coming in a little closer, bounce into a 1 hour zone where we did get a reaction. But it's I don't know. You would have to look at this on the smaller time frame and say, okay, we broke this double top. Okay, we broke this structure here, but we didn't close there. Okay, this demand zone, although those two expanded range candles leaving the zone look nice, it did not break and it broke, but it did not close above this recent swing high. So I didn't have any interest in this demand zone. I did for a minute, but when I saw that it didn't break and close, that's where I kind of lost interest. And you can see there for what, 6 or 8 hours, it just kind of based during the end of New York, early middle part of Asia session. It just got boring, guys, before the liquidity, the volume spread analysis activity dried up. So when it did end up getting this push up, when it got this push up, it was basically on nothing. So anyway, we got the retracement with some volume. We're in there now. I would really need a strong 1 hour candle close coming out of that because we do have an oversold on the RSI. And we do have our 50 EMA climbing above our 200. So I don't know. It's probably a little too thin of a zone for me, so I'll probably just skip it. That was the one thing I had written down. What time is it? 10:30. Oh, okay. I was just making sure I wasn't going past my time. Okay, I got 9 minutes. So yeah, no real interest in that. I wrote down one other thing. I wrote down Aussie Swiss. Master pattern liquidity sweeps and no demand zones. Yeah. So let's have a look at Aussie Swiss, guys. It's up there along with all the other Aussie pairs. And I do believe I was looking at this one. Yeah. So I was kind of interested in this one here, but I didn't know that I wanted to trust a 3-minute demand zone. But for starters, 8 above our 21, higher highs and lows. So bullish. Edge Finder obviously giving us permission to buy. Permission to time, not permission to buy. Remember, that's just permission to go time it on a chart. So I was kind of getting a little creative here, looking at my consolidation box right here, my master pattern. Well, what I noticed was we did have price leave to the bottom, sweep liquidity, leave to the top, sweep liquidity, and then now come to the bottom and sweep liquidity again and bounced right into this demand zone, which is a very tiny one. It's a 3-minute demand zone. I don't really get into the small time frames like that very often, but if we just kind of take a step back and look at this thing, okay, you guys can see we got our last red candle before a big spike up, and it ended up moving a lot. But what I disliked was the fact it did not break structure. So the point of demand zones is to make sure they create an impulse leg. An impulse leg has to break a previous structure, whether it's the upside or the downside. If it does not break structure like it did not do here, to me, it's not an impulse leg. And if it's not an impulse leg, then that tells me that the demand zone or the supply zone may not be that strong. Because if it's strong, it will break a structure, either a structure or an overhead supply zone in this example, right? So we did none of that. Okay, we did none of that. Now we came all the way back, but guess what? It doesn't care what Tiger thinks because it still bounced into that little tiny dinky 3-minute demand zone, and it's caught a bid and it's pushed up. So I skipped it because of the aforementioned, odds enhancers I wasn't really seeking or wasn't really getting. But sometimes these zones work out, even though I dislike them. Just goes to show you how picky I am. What we got? Gold and FOMC and Bitcoin. Yeah, let's have a look at that. So gold, pretty well being hemmed in, if you ask me. Okay, obviously they are neutral over on the Edge Finder. But the cool thing with gold is it's breaking out of our consolidation zone, guys. Over here on the right, this is our daily chart. So obviously sweeping that liquidity down here, but it's got to remember we got a 4-hour zone that it's getting close to touching. But as good as that candle looks, did that candle close? Did that candle create a impulse leg? No. It swept the liquidity up here, but it didn't close. And then it just got lazy and fell off to the side, sideways action again. So I drew it up, but I'm not excited at all about this demand zone. In fact, I need to color it light green. If it's a zone I don't like that much, I usually put it a lighter shade of either green or red. So I don't like it. You can see we did already kind of bust through a demand zone here, a little dinky tiny one that I wasn't too interested in. It's just gold and silver, guys. To me, we are getting a downtrend ever since the March 2nd. So for the last 16 days, okay, we had a big drop. We had a week-long sideways saga there, a little sweep up top, and then just straight down. So what is our edge finder giving us exactly, actually? I know they're neutral, but or I think they're neutral still. Wait for my screen to load for you. Gold is a -4, silver is a -3. Okay. I think that's pretty much what we had yesterday, last time I looked. So we are getting, if anything, a bearish signal, but it's not yet. It just needs one more piece of dollar strength. So yeah, the question was, how's that going to react with the, with the rate statement coming out? Well, how much is it priced in, right? The way I see it, we're in a downtrend, but typically when it comes to these zones and supply and demand zones, typically what high impact news releases do is basically speeds up what was going to happen anyway. When it comes to the zone bounces, the expansion legs, when we're talking about the master pattern, okay, it's really breaks down to those three phases I've showed before. We get the basing action, and then we get the push up, push down, higher push up, higher push down. Okay. Sometimes it'll just do a couple expansion legs. Sometimes it'll go 6, 7, 8 expansion legs. I've seen them go crazy. Talking about the megaphone pattern. I know I showed you guys the tool on here before, but I just would be careful. I don't think this demand zone, though, is going to be strong enough to hold it because it's not even really an impulse leg. It did eventually break structure, but it took a couple weeks. Okay. And from there, we would have to make the argument that maybe this was the stronger of the points to break the structure. So I don't know how much excitement I have in that. Obviously, it is -4. So again, one more, if we get, we very well could have a different reading on gold as soon as that release happens. But we do have a 99% chance of, according to the CME tool, guys, a 99% chance. Where yet? There you go. 99% chance that we're going to remain the same. Okay, 98.9, so it dropped. So probably not going to have anything happen. In fact, the first one that I saw was December 9th, where we actually have a different number, a 25% basis point cut likely. So I know that you guys have probably seen on the news that there's a lot of, there's plenty of people talking about pricing in 2 rate cuts. Well, CME tool, as of right now, doesn't seem to agree. Now, obviously, guys, this is very dynamic and changes by the minute. But one of these groups of people is going to be wrong. But that's further down the line. I'm not too interested in that. All I care about is the here and now. Gold and silver downtrend, but starting to come into some demand zones. So just be careful on that. Bitcoin, and I got like 1 minute left. Yeah, Bitcoin. So we did finally swing up over the last week and a half to where our 8 is above our 21 EMA, and not to mention higher highs and higher lows over here. So that's good. Edge Finder still giving us that +7 score over here. I was watching a demand zone up here. I did not like it because I didn't really get a bullish candle, a bullish engulfing candle or anything. It just chewed right through it like a knife through butter, guys. So I can delete that now. And as far as the next potential bounce, this zone has been mitigated. I don't like it. This zone has been mitigated. I don't like it. Remember, zones, when they get touched, guys, it's not like a support or resistance line. A lot of people think supply and demand zones are the same thing as support and resistance. It's not. Absolutely not. Because zones come with that potential unfilled order grouping inside of it. The Q line, guys. Somebody starts a group of banks, one bank, one big order, put in that initial small order, hoping that they don't spook the market, and they spook the market and they get the big gap. Well, they didn't finish their order, and they don't want to pay the expensive prices, so they want price to come back down. So do the other supply and demand zone novice traders out there. So with it being touched, with these zones being touched, to me, that's mitigated. Those unfilled orders potentially got dried up. So yeah, maybe just a further push all the way to the bottom, but I don't really see any good demand zones, guys, on that. So we'll see how this looks tomorrow. But with that, guys, I do believe we have Marco coming up right after me. So stay tuned. Have a wonderful day, guys, and I'll see you tomorrow.
Hey guys, I just wanted to jump in for a second and let you know a little bit about today's live stream sponsor, DNA Funded. DNA Funded has very generous profit sharing, up to 90%, and 3 different unique challenge types. For those looking to get funded, they also have speedy payouts, unlimited trading days on the first and second phase of their challenges, a very wide list of different things you can trade with over 800 different assets tradable, and maybe the most important component, a very experienced team behind the whole operation. So if you're interested in learning more about DNA Funded, click the link, check it out, see if it's right for you, and make sure to do your own due diligence to see if what they have to offer fits your trading style. For 20% off, you can use code A1T20. Again, that will be 20% off any of their challenges you'd like to check out. Thank you again to DNA Funded for sponsoring today's live stream. Now back to the show.
Hello, I'm back. Back for another round. So we should get Alan join me in, I think, 20 minutes. Before that happens, quick market update. Has anything happened in the markets in terms of movement? Well, not much. So Euro Swiss is moving up, which is pretty strange if I'm being honest. So Euro Swiss, you would expect this to be a risk-off currency. So essentially, or you would expect Euro Swiss to go down because of the current market environment with the US, Iran, and the war and the conflict. It's actually going higher on the day, which is weird to see, but hey, good for this position. Oil pulling back a bit. USD JPY close to the 160 level. I'm actually thinking about just getting in after the Fed. So I want to sell USD JPY, possible intervention coming at the 160 level. I'm pretty happy to exploit that, but I may wait for the Fed event. I'm not sure how much volatility will there be in the Fed event. I don't think there will be much volatility. Let's take a look at essentially, yeah, I think it's going to be kind of a nothing burger or a non-event. But you never know what's going to happen. We may get some sort of a reaction on USD JPY. So, of course, if I do decide to take a position, you will be notified in the A1 Trading Discord. I just want to remind you of that. If you want to join the A1 Discord, get all of my positions, all of my trades, the link is in the description, and you can use the code Marco. Code Marco. To get 25% off. So, if you guys have any questions, I have my chat open on the side. Perfect time to ask questions because I've ran through most of the things on the watch list. So now we can focus on the chat, focus on the questions. First one I can see, hey, can I invest at the age of 17? Do you mean to trade or to invest? If you mean trading, well, you can do both, but it all depends on can you open an account at the age of 17. I'm not sure what the regulation on that is. I know most reputable brokers, yes, you can go with an unreputable broker, which I would highly advise against. But with a reputable broker, you may need to be 18 or above to get access, okay? What you can do is you can do prop firms. But again, when it comes to the payout stage, will they pay you out? You know, that is the question. Will the prop firms actually pay you out when the payout stage comes? Because if you don't know about it, essentially, you don't need any identification to buy the challenge. You can just buy it. Then when you get to the funded stage and you request a payout, they ask you for your ID, proof of this, proof of that. They check all sorts of things. So you may get denied as far as the payout goes if you're under 18. That's the tricky thing. Okay, that could basically be a problem. So if you're 17, you're going to be 18 pretty soon. And if you're just a beginner, you have no business buying prop firm challenges. Absolutely not. You also don't have any sort of business trading a huge amount of money. So I would say just learn to trade on demo. There's the FTMO demo account, which is an option. So focus on that. Once you're 18, maybe even 19, you get some experience, you get some education, and then you may start to get into the game. Okay, Joshua says, what's up, Marco? I went long on USD JPY at today's lows, riding it up to 160, stops at break even. Okay. So USD JPY, that's probably a very, very short-term play. I mean, 160 is pretty close. If you went long on today's lows, you probably went long around 158.6, something like that. And you're targeting 160, not bad. I mean, you're probably counting on the Fed decision to push the price to 160, if I'm not mistaken. Will that happen? It all depends on the commentary. One thing with the Fed, so you have Powell, who's pretty much, he'll soon be out of the Fed. He'll be replaced by, who is it? Kevin Warsh, I believe. So Powell is no longer such a key player in the Fed, so he may not want to talk a lot about the future. He may just stay completely flat, completely neutral, which is going to make very little movement in the markets. That's what I think is going to happen. We're going to get Alan. We're going to get Alan in the room in a bit, so we're going to see what he has to say about it. But that's kind of my general opinion. Unrelated, but when are you streaming on your channel again? I'm not going to be streaming anytime soon. I tried it. Personally, I didn't like it that much. What I like a lot more is producing actual videos. So long form, short form, especially short form. It's more entertaining. It's faster paced. The live streams are not my thing. You know, I love doing this stream on Trader Nick's channel because the audience is absolutely huge. So you have comments coming in all of the time. But with my small channel, there's very little people, very little comments, very little questions. So it's just me blabbing on with the camera for 1 hour, which is not the best 1 hour to spend, in my opinion, for growing my YouTube channel. But hey, they may start again in the future. For now, I enjoy doing long form and especially short form a lot more than actual streams. The Shiny Yellow Metal says, hi, Marco, how are you? Gold plans and levels to watch for buyers. Well, that is an interesting question. Let's see. Gold selling off today pretty drastically. So this is the weekly. Let's go to the daily. So gold looking pretty bearish at the moment. Yeah, it looks pretty bad, pretty bearish. Short-term bearish, long-term bullish. That's kind of, for example, Andrew Campbell, who I follow on, I follow his newsletter. He says short-term bearish, long-term bullish. The reason for the short-term bearishness is probably some dollar buying. So the gold is quoted in dollars, which means if the dollar gains value, gold drops in value, right? So you can see that on the DXY. As the DXY appreciates, gold actually goes down. Gold actually loses value on that. Okay. Levels to watch. Let me think about it. Let's see. Maybe these lows, but I don't think we're gonna hit these lows. Yeah, I don't think that's gonna happen. What we can do is we can do a fib. Okay, fib to the 618 level, something like that, 0.5, 618. That's an okay level. This box right here. What I'm personally waiting for, that's kind of the best thing I can tell you. So what am I personally waiting for? Well, I'm interested in buy setups. So I want to buy gold. And personally, I would wait for a bullish reading on the edge finder. So here to print bullish. And I would wait for gold to cross the 20 MA. So you have this 20 MA running. I would wait to see the price actually cross it back above, or at least for some sort of bullish price action to have some sort of bullishness here. That would be nice. Okay, so that's what I'm looking for on gold. Legally, you're not allowed to trade under 18. Okay, so just use someone else's ID. Don't do that, because you won't be able to withdraw their money. That's a really bad advice. I think this is just someone trolling, but wait. Okay, wait. You're probably a total beginner. You have no business buying challenges. You have no business trading live money. Start the learning process. Start on demo. Learn the game. Because for me, it took years. For most people, it takes years to learn it. So you don't even need to have any live accounts at 17. Hello, Sluggy. Are you still funded with the 5%ers? I've never had a challenge with the 5%ers. So the firms that I recommend are FTMO, 5%ers, and DNA funded. By the way, for DNA funded, just a reminder, we have the code A1 Live, which gets you 25% off. Okay, so A1 Live gets you 25% off on any DNA funded challenge. So check it out if you want. FTMO, had a few accounts with them. 5%ers, never had a challenge with them. DNA funded, here is how I'm doing on that front. Did something get closed? I had a position open. Okay, something got closed. What's the equity like? Equity 24.7. Okay, so looks like I'm in some drawdown at the moment. Yeah, balance 24.6. Anyway, with DNA, I got to the funded stage on a 50K, then blew to 50K, bought a 25K 2-phase, past phase 1. Now I'm at phase 2. So doing pretty well so far. 5%ers, my friend Griff is with them. He has had some payouts. Actually, he has had a good number of payouts, and he had some good experience with them. So 5%ers is pretty good. Rip Powell, the homie. Yeah, Powell is out, getting replaced by, I think it's Kevin Warsh. I think this guy. Yeah, I think so. Thank you for gold, Marco. How about the 20 MA on weekly, which acts as a huge support so far? Could we consider to buy on the reactions there? Let's see, weekly. Well, you are correct. You are correct to say that in sort of the last few data points from 2024, we have been respecting the 20 MA. Personally, I would not place so much importance on a EMA. So I would not guarantee that a bounce will happen, but that's the good level. So if I go back to the daily and I put the 618 here, so let's highlight that one with a box. And then the weekly, it's right at the 20 MA. So that's an okay level. That's an okay level to get. But personally, I would not be a buyer. If we hit that level, I would not be a buyer, because Edgefinder would probably still be neutral. And yeah, that's basically the main thing. And we would be below the 20 MA on the daily chart. Okay, as you can see right there. I'll be honest, DNA rules are ass. If you're a swing trader, this is not for you. I mean, I'm using a swing trading approach on DNA, and I didn't have I didn't have issues so far. What's your chart of the week? Chart of the day? Chart of the week? Oil. Because I just took a position on it. So if I had to give you a chart of the day, it would be oil. Just got in a long position. I think this thing goes up. These are the projections that I showed. When did I show this? Basically in my previous segment today. And it tells you what will happen if the Strait of Hormuz remains closed for 1 month, 2 months, or 3 months. As you can see, the pre-war path, the flat line. Then you have the 1 month, 2 months, 3 months right there. Look at the price. You know, it's not so unheard of, or it's not so, let's say, crazy to say that the strait remains closed for 2 months. So this sort of scenario, we cross 120, we may go 130, 140. We will at least hit this high, which gives me a nice profit target. Marco, I use quant method to trade. I don't know what a quant method is, but if you can write more about it in the comments. How much percent do you risk on evals on props? 1%. So on the challenge phase, 1% per trade. That's the best recipe I have found. Yes, you can drop it down in the funded stage, but I just go 1% full on. So yeah. Kevin ain't washing the Fed, he's washing it. We'll see. Kevin, supposedly he was a hawk before, so he was down for higher interest rates and possibly curbing inflation. We'll see what will happen. Now. Marco, look at NU, looks good for shorts. Is it USD? Let's take a look. Is it USD? Very bearish. Personally, I don't know much about the New Zealand dollar. It's not on my radar. Like the traders that I'm following are not really talking about it. Dollar is kind of catching a bid, let's say. Okay, so that may push NU lower. Edgefinder is very bearish, so that's great. Let me see what else do we have that's very bearish. So if we do this and we put in very bearish, okay. So only NU is very bearish. Interesting. Let's go back to everything. Should we just do this? Yeah, okay. I found that if a conversation with AI is too long, then it could get confused and mistake all information as new info. So maybe start a new chat after a few signals. If you mean for my ChatGPT trading challenge, because this one right here, so all of these accounts are traded purely by ChatGPT, which is a challenge I'm doing on my YouTube channel. You can watch the whole thing. My channel is Marco's Trading Journey. Okay, so search that on YouTube. You'll find the challenge. And on ChatGPT, I have everything under one chat. I can even show you. I mean, if we open up ChatGPT, and you're going to see how slow it's responding because everything is in one chat. Here it is. So ChatGPT trades. And this goes back, I think it's 9 or 10 months now. And ChatGPT is up around 40%. So in the last 9 to 10 months, ChatGPT made around 40%, passed a couple of prop firms, but never got a payout. So this is it. Essentially, for today, this was my prompt for today. So you're still in USD CHF, you're still in gold, you're still in SPX current price, and then free trades are active and reacting. Let's manage them, and then it gives out all of the instructions. Okay. I'm keeping it as it is. I'm getting a lot of recommendations left and right to how I can maybe make it more efficient. So and also people tell me to try and use Claude or Google Gemini or some sort of another bot. For me personally, I'm seeing that it's working at the moment. So 40% profit in 9 to 10 months is pretty good. I don't want to change anything at the moment. If it's working, why mess with it? So my game plan, just leave it as it is and see how the thing progresses. I would love to show you the equity I have in my Notion, but I can't share the screen. I mean, I can share the screen of my Notion, but I didn't prepare it, so I can maybe do a screenshot or something later. Is Alan coming on? Yeah, Alan is coming on. He sent me a message that he is just grabbing some coffee and he will be back, or he will be at the stream in like 2 to 3 minutes. Thank you for an analysis. Appreciate your time. No worries. So quant method is using Python, and systemic trading approach using math and coding. That sounds very interesting. If you have some back-tested results, if it works in backtesting, if it works in forward testing, always, any strategy that you develop, not you, Aizen, but I'm talking like to most people watching this, any strategy that you develop, don't just backtest it, but also do some forward testing as well. Forward testing basically means trading it day to day with very small risk or minimum lot size. Don't fix it if it ain't broken. Exactly. I don't want to mess with it. If it's making profits, if it's making money, I don't want to mess with it. Where can I find the Edge Finder giveaway entry link? Personally, I'm not sure, but maybe our producer James, who's in the background, can put the link in the chat. I'm not sure where exactly you can find it. Okay, great. We have Alan joining us. So let's see if we can put Alan in the room. Okay, let me go through this last thing. Oh, here he is.
Sorry, man. I'm a little bit late here.
Yeah, no worries.
Coffee downstairs.
No problem. How are you doing?
We're good, man. We got the coffee flowing consistently.
Yeah. Okay. Cool.
So we are all here, gravy, good to go.
Awesome.
How about you?
I'm doing pretty well. Today is kind of the stream day. I'm getting ready, trying to stay as present as I can for the whole thing. But the thing I wanted to comment on is what's your expectation of the Fed today? And is it going to be a nothing burger? Is there going to be any movement? What do you think about Powell? So that topic, that's something I wanted to cover.
Yeah. So equities are bleeding today. And I think a lot of it was because the inflation report that we saw this morning basically indicates that there was already some pre-existing inflation, or that inflation was trending up prior to this event, which is not a good thing. So the prospect of additional inflation adding to the U.S. on top of that, I think that's a real possibility, especially if if oil stays elevated for a long period of time. So I think that's what markets are pretty much hurting today. What I'm expecting definitely a neutral to hawkish stance. That's a no-brainer. I'm leaning a little bit more on the hawkish side, especially now because the Fed, they will have this new set of data with them right now. Like before they go on talk on the podium and stuff, they have this new incoming data, and that will probably be another added variable to whatever decision they make, or the dot plot and all that good stuff. So I expect a lower revision on GDP, most likely. I expect maybe a half-point cut at all, like for the whole year 2026. So maybe instead of one cut, maybe half of a cut. Yeah, definitely like some more hawkish stance. This is going to be most likely Powell's last time speaking too. I'm very interested to just watch it and see how it plays out. But as far as a new guy coming in, Warsh, if everything goes good, I know they have to vote him in and stuff like that, and there's like some weird things behind that, but like he is an inflation hawk. In the past, he's been an inflation hawk, and if he inherits an economy with a elevated inflation, I don't know if he's going to be as lenient on the inflation as Trump might want him to be. Perhaps
Yeah.
he goes back to old ways and hikes interest rates and stuff like that. But we'll see though. I mean, I'm interested to watch it, just from the standpoint of like, I'm gonna miss Powell. You know, Powell. Sluggy says one last ride for Papa Powell. Yeah, man,
Yeah.
great guy. You have to think about it, like he has probably one of the hardest jobs. You know, he
Absolutely.
has a lot of pull from either direction, and it's a tough business, and he's a spokesperson, so he's the one always in the podium and stuff. And yeah, it's gonna be I'm gonna miss Powell a lot. But how about you? Do you have any specific expectations that you think might happen? Market reactions? Is there something you're looking for?
I just wanted to say that Powell, he never gets a pat on the back. Like, no matter what he does, if he cuts, people are, bashing him for it. If he hikes, people are angry again. So it's kind of a lose-lose scenario, whatever he does. I've never heard anyone say, good job for the Fed. Like, you did a great job. You're a great spokesman for the Fed. I've always seen just people crapping on Powell, no matter what he does, if it's a hike or a cut. So, like, hardest job in economics, absolutely.
Personally, yeah, he's always like you said, no matter what he does, he's always criticized, from either one side or the other.
Yeah, because it's like 50-50. There's 50% of people wanting a hike and 50% want a cut. So someone is going to be angry no matter what happens.
Yeah.
And then both of them are angry if he just keeps the rate the same. So that's kind of the most heat that he can get. I think he's going to be at one more meeting after this one in April. Maybe I got that wrong, but if I go to, let's see, if I go to
the Fed probably has a calendar. Well, I know they have a calendar. Let me see.
I think it's April 29th.
The last day Powell speaks.
Yeah, so this meeting is March 18, and April 29th is another one. June 17 is the one after that. So maybe Kevin will step in June. But has Kevin already been voted in, or was he just recommended? That is also something I'm going to need to check.
From my understanding, the thing is up in the air because you have I forget who it is, but someone responsible for voting essentially said that they're going to reject the vote if the indictment on Powell is still active. Now, as of when did I make the post on A1 Trading? It was over the weekend. I remember doing it. Let me see. It was on 4 days ago. 4 days ago, the subpoenas were dropped essentially, and so then you open the door again for that possibility of Fed wash. But then there's also the thing where Powell is still on the board. So the idea is you get Warsh in there, and you have more votes as far as getting what you want as far as monetary policy goes. But then there's also the chance that Powell stays on the board, and so you don't have that extra vote, or it becomes a lot more difficult to achieve what Trump is wanting to do, which is basically a more control over the Fed. So there's a lot of moving pieces there. So maybe this is the last time Powell is the Fed chairman, or the last speech before he's a Fed chairman, because the subpoenas were dropped. But there's a chance too that he stays on the board and he's playing stuff in the background. But if I were Powell, this is just me speaking as a regular human being, man, I'd get out of there. I'd go enjoy retirement. And Powell's already loaded as it is. He was a very, very good investment banker before all of this, and he has his wealth. So if I were him, I would get out of that and just go right into the sunset.
Yeah, just the forces that are on the Fed chairman are extremely high. It's pretty tough to operate as an independent entity if you have the president like constantly badgering you in on the internet.
Yeah, man, I could only imagine.
Yeah. So I mean, Powell is an old guy. Why not just quit while you're ahead? That's it, and have Kevin be the new guy, because whoever is the new guy, he's gonna have to have Trump in his right ear all of the time. Kevin supposedly is a hawk, but maybe he'll follow like a more dovish approach because of Trump. we're going to have to see that. I think the toughest job right now for the central bankers is this conflict, US and Iran. So I think this is sort of the toughest thing, where inflation will spill over. I think the biggest catalyst for inflation is rising energy. So oil prices impacting the whole world, not just Asia, not just Europe, not just India, but pretty much the US as well. So, and the Fed is planning to cut this year. I think we already went down from 2 cuts to 1 cut, if I'm not mistaken. We can bring that up. If we go to Fed Watch tool.
So like he said, one last ride for Powell. Come on and hit us with a hike. That would be a hilarious way to go out.
Yeah.
That would be like, you know what, shove it in your face. I'm out of here. That'd probably be a good indication that
they need to vote on everything.
Yeah, that's true.
So it would be tough. Maybe he has a lot of popularity inside of the Fed, so maybe he could do it. But you would get the Governor Miran voting for 50 basis point cuts. I think that the Trump puppet. We're still priced for we're priced for 1 cut. 3.325 to 350, 350, 375 is the current rate. So yeah, that's one cut. We were priced for 2 cuts, and now it has moved up drastically. So we may even get no cut in by the end of 2026, which makes sense because of the US and Iran conflict and the spillover that may spike inflation. Really bad story for the stock market. Like it could be pretty bad for the stock market.
Yeah, right now there is a 40% chance that there's going to be a rate cut in December 9th. So that is literally, you can see right here in this the probabilities where we at right now in blue, and then it moves to the left once 12/9/2026. So yeah, that's essentially one cut or even less than a half cut going there. So I think the dot plot is going to be very interesting. The dot plot is going to definitely move the market if you see something less than that. If you see 0 cuts, then markets obviously have to price in that there's 0 cuts for 2026. And then that could be, maybe another added layer to the spillover that we're seeing in equities, dollar to the upside, things like that. So that's something I'm definitely watching. I'm also watching for that GDP forecast too. If you start to see GDP coming in lower than expected, then equities will definitely hurt that, and maybe that's what causes a rollover into the Nasdaq and the S&P and especially small caps too.
Yeah, absolutely. You want to jump on when the dot plot comes out to the stream? I'll be streaming like a solo segment, but if you have the time, you can jump on. We can comment on the dot plot. I think it comes out in hour and a half, something like that.
Yeah, I think it was. Yeah, if I can, I don't know if Chris Pulver, because I think it was Chris Pulver and Nick were going to do it originally. Let me see. Let me verify though. But yeah, if you have the availability,
I do have the schedule here. So if we jump onto the schedule, so after you, there's Chris, and then it should have been Nick, I'm guessing, with a solo segment. And I think that's 1 hour before the actual press conference starts. So
yeah,
if you have the time, if you want, just jump in. We can comment on the dot plot.
Definitely, I can definitely do that for sure.
Awesome. So yeah, what I wanted to ask you, is there something that's popping up on your screen that is sort of interest to you after the Fed passes? Because I know with a lot of events, especially Fed events, what traders like to do is they like to wait after the Fed decision to place their position. One thing that I'm waiting for personally, I'm waiting on USD JPY. So I did some research, did some reading. Like Brent Donnelly, he is pretty happy to look for sell setups after the Fed decision. So I'm wondering to maybe doing the same. Maybe we even hit the 160 level during the Fed event on some comments, possibly some, let's say, more hawkish comments than expected. So is there something similar that you're watching?
I would be open to participate in dollar yen, especially if you do get that hawkish commentary. This thing just flies higher. It'll be an attempt to fade it, but that would be the only other thing. I mean, I'm already positioned dollar long before this anyway.
Yep.
Euro dollar
Yep.
short. So I'm like, my bias is kind of leaning that way anyway to begin with. Like, I do want a hawkish Fed, maybe that's zero cuts. Maybe Powell's like, look, we're just gonna hold this thing into the remaining of the year because you don't know what's gonna happen when this thing's gonna resolve, whatever, and the market takes that as like zero cuts. That would definitely help my trade here. But as far as new positioning goes, if you do get a really good pop in dollar yen, then I would probably look to fade that very, very small. I probably wouldn't even recommend other people trying it because this is probably one of those trades where you can probably take 2, 3, 4 attempts at that before it really starts to move. So something that's on my radar. If you get a really good dip in the Aussie basket, then I would probably go ahead and add that again to my portfolio. But for now, I'm just going to ride that dollar bullishness trend. And it seems to be working out okay. So we're looking at yields are still high. Yields are still up on the day. The 10-year yield as well is up on the day as well. So yeah, I want to continue to see those 3 assets up: oil, yields, and the VIX up. And I think the dollar to the long side is one of those like obvious moves that I think markets are just expecting for.
Yep. Cool. Well, I'm gonna leave you to your segment, and then if you have the time, definitely join me for the dot plot. It should be fun. And after the dot plot, we of course have the press conference. So I'll be covering for Nick today. I'll put up the press conference on my screen. We can talk during the press conference in the chat. It gets very active during the press conference, so it should be fun. Yeah, thank you, Alan, for doing this joint stream with me, and good luck with the rest of your segment.
For sure, man. We'll talk soon in a little bit.
Talk soon. See you.
See ya. Alrighty, guys, this would be the perfect time if you guys have any chart recommendations, anything that you want me to go over. If you have any open trades before this FOMC release, if you're looking to open trades up after the release or before the release, this would be the time to go ahead and put them in the comments. We can go ahead and look at everything here together. I will be more than happy to go ahead and do some digging here with you guys. Potentially, you see some pockets in the market that I'm not looking at. So something definitely that I'm open to. So let's go ahead and see what we got here. Okay, so Al, I'm watching NU shorts, New Zealand dollar. I think that's a good trade. Relatively weaker compared to the Aussie dollar for sure. So just looking at the New Zealand US dollar chart, and then you look at that Aussie chart. So you are seeing some relative weakness there for the Kiwi. We have been trading in a range too. So if you do get that dollar bullishness, picking up NU or shorting it up into this level here, this 0.5500 will be fantastic in my opinion, or even just catching the bounce off of this level here. Like you can see in the past, 1, 2, 3, 4, potentially 5 times if we do reach this level, catching it to the upside. I think that's a great opportunity there, Sluggy. So let's look at let's go ahead and look at currency strength here on the day to see what markets are strong, which ones are not here. So dollar getting strong here again, which I love to see this orange bar here. And then you see in second place, you see the Canadian dollar, which makes a lot of sense because you do have oil up on the day. And then the other ones, you do have the risk assets like Aussie, Kiwi down, pound and euro down. And then the weakest link right now is Swiss franc. So good to see that. Okay, so now that we have an understanding as to what markets are looking at as far as strength-wise here, let's go ahead and look here. Okay, oil buys. I'm going to go ahead and down the list, guys. So I'll make sure to cover every single thing that you guys drop for as long as I'm on here. So let's go ahead and look in oil. I think oil makes a lot of sense. I'm sure you guys bought, if you did buy at this like recent pullback, which I love to see this, oil was kind of bouncing off of here. So trading it to the upside. If we do get here from a trade management standpoint, if we do get a break above this level here, maybe the 102, 101, and it holds, then maybe we can trail stops here up into that 100 handle and then just let it ride higher and higher and higher. Good trade there. So fantastic if you got into that trade. Awesome. Especially if you continue to see the headlines like the geopolitical headlines that we've been seeing this morning, like the oil infrastructure. I saw something brand new too while I was on the break. It was something with Saudi Arabia. I think they were pulling out of something. Qatar. Installations are being evacuating following Iran's threat to attack the Gulf. So, those are things that are working in your favor. So as long as you continue to see that, the trade is good and alive. You have the VIX up, dollar up there, yields higher. So, if you're an oil trader, I would definitely head and just pay attention to VIX and dollar and yields, for confirmation on the trade. All right, let's go ahead and go down the list here. Bitcoin buys, Alan. You know what? I made a video yesterday. I didn't publish it because I the whole time the mic was not on, so I got pissed off. But I essentially recorded a video, and the idea was like Bitcoin, I think is a good opportunity to take an attempt, right? Am I saying that this is a bottom for sure? Absolutely not, because I don't have the confidence or the expert knowledge on cryptos. But from a technical standpoint, you are getting what looks like to be a short-term V-shaped recovery. You do have the fundamentals in your favor as well. From my understanding, let me verify this real quick. Let's look at BTC. From my understanding, Bitcoin, let's just go to asset scorecard. Bitcoin was getting a bullish reading. So let's verify Bitcoin. Yeah, it's getting a 7 reading, which is good. You're getting technical score in line, sentiment and fundamentals in line as well. So I say, why not, right? I think this is a decent level to go ahead and take an attempt. You are getting a very small pullback here on the daily time frame. So we'll see. The only thing I will keep you mindful of, the person who requested this, is keep an eye on global yields, especially Japan too. So Japan yields are a little bit soft here on the day, but if you start to see global yields as a collective go ahead and rise, that could actually hurt the crypto story as you get a carry trade unwind develop. So one thing to mention, but you are getting a bullish reading on Edge Finder. What it would look like would be something like this. A market order here, a stop below right here, and then you probably target this little cluster that we've seen here, maybe at the 90,000 handle. Not financial advice, but and it's also not the best risk reward here, 1 to 1.4, but an opportunity nonetheless. All right, let's go down the list here. I have open sell trades, pound US dollar, and buy on USO. Awesome, man. Pound dollar is getting beat up here today too. It's down on the day, not significantly, but it is down on the day. So let's go ahead and see how I would manage this trade if I were you, my friend. So if I put a Fibonacci from the high to low here, just measuring out this move, we'll see how pound dollar is reacting. So okay, so from high to low, we go ahead and trade it back up into this value zone, 61.8 and 50% retracement level, and we are now starting to see it trade down lower. If you get a decisive close here below this 38.2% retracement level and we continue lower, then the trade I think is still in play. You can probably trade this thing down lower into something like, let's go ahead and see and look left, anywhere to 1.31800 or even 1.30500, right? So these two levels here that I have marked up, I think those are good trades there. So congratulations on the sale order, my friend. Let's go ahead and see Forex scorecard, pound dollar. Let's go ahead and verify. I'm pretty sure it's getting a bearish reading. Yeah, -8. Yeah, so you're good. You're good. However you want to manage this as far as trailing stops or whatnot, do what you do, but that's a good trade there. All right. Let's see. Eisen went long Aussie yen at 110. Let's go ahead and look at Aussie yen here. Look at that at 110 too. Oh, dude, that's a good trade. Yeah, I don't even have to advise you on this. The trade's working out. If you bought at 110, you're probably trading stops right here below this level, this pullback level, and you're just letting it ride. But nonetheless, it's a risk-free trade. From an edge finder standpoint, I think it is a very, very good bullish reading. It should be at the very top, if not the second highest reading there, or the third. Aussie yen bullish 8. So yeah, you're good. That's a really good trade. If I wish I was you. Slug is already in New Zealand dollar shorts, but you're looking to add. So how would I add to that position on New Zealand dollar? Let's go ahead and see. Let's go ahead and do the same thing. Fibonacci's. We pulled it into the 50 below. I would say if you get something looking like this here, So if NU breaks below this level, retests into this green line here and trades lower, then this will be a good trail stop. And then you can just target literally this whole move to the downside is possible if you get a really, really good bid into the dollar. This is about 200 pips or 190 pips away. I think that's a really good trade there. So that's how I would, do it. If I were you, I'd let the trade breathe and do its thing, especially with today. And that's the one thing too, like, just be mindful of trade size, especially right now before release, because you don't know what's going to happen, what Powell's going to say and what the forward guidance is going to look like. So definitely expect, some whipsaw, some volatility, let it breathe. And then, after the event, you have a net expectation or a net outcome of what it was, net hawkish, net dovish, net neutral, whatever. And then you can go ahead and trade from there. But yeah, that's a great trade. You're also in sale pound dollar. Fantastic. Okay, let's see. Highland was considering gold sales on a technical point of view, whether during or before the FOMC. Gold sales at 498, breakout level for sales down to the 4,800. So gold is, let's see, where's 4,800? So right here. So we got almost close to that 4,800 handle, which is going to line up right about there. So you got pretty close. Okay, from a pullback level, okay, so you were looking to sell at 498 or 4980, which is way up here. Oh wow. Oh, I see what you were doing. So you were basically doing a breakout of this little level here, and trading it to the downside. I mean, that looks good. I mean, I hope you got into it because you would be floating in some profit there. So fantastic. That's a good trade. And you're just letting it run you. And you had this big red candle here. The only thing I would say is gold does have the possibility of it really going down here, maybe into this 4680 handle, if you do get a strong dollar and yields higher. So, gold, non-yielding asset, it becomes more expensive to hold the trade as you have yields higher in the US or whatnot. So that could be some added fuel to the downside there. So just be mindful of that. So don't cut yourself short. Maybe if you're in the trade, targeting something like 4680 and just trailing stops along the way, that would probably be the way I would approach that. Selling gold is very tricky though, because gold is one of those assets that trends higher over a long period of stretch. So the moves down are very, very violent, very quick, and very lucrative, I would imagine. But just be always careful that once you hit these level of supports like the 4,700, the 4,600, you will most likely be met with buyers, and so that will that's just the thing with gold. I love the FOMC energy. It feels like Christmas. Yeah, just trades low size and wide stops, man, and you'll be fine. But it can turn into a very bad Christmas if you're trying to bet the farm and retire early. Awesome. That's the plan. Cool. GU sells after this. So GU sells what it would look like if you're not in a trade already. Okay, so if you're not in a trade already with GU, you kind of don't want to participate right here from scratch, because things can go either way. This level of what looks to be support here, if you go ahead and break this level of support, trade down lower and retest it, then you can go ahead and continue the momentum to the downside on GU. So that's what I would look like. But that's what that would look like. Leon, yes. So right now, oil is elevated, and because oil is elevated, you are getting a higher bond yield. So bond prices go lower, yields go higher, and the dollar goes higher as well. The reason being is because if oil stays elevated for too long, that can cause inflationary pressures. And the way a central bank targets or attacks inflation is by raising those interest rates or by not lowering them at all. So basically just keeping them where they are now, or possibility if inflation's too aggressive, they hike interest rates. And so that's why you're seeing yields and the dollar higher, because there is the chance that is going to be the case there. So especially this morning, you did see PPI come in hotter than expected by a wide margin. So that's basically showing that even before this conflict even started, you were seeing some elevated inflation into the U.S. economy. And so, now you include the conflict with U.S. and Iran, higher oil prices, then that's another added layer of inflation possible, right? So that's why oil up, yields up, dollar up. Hope that makes sense. John said, if rates are high and if rates are low, what would be the impact on stocks and gold? Okay, so if rates are elevated, then you would see dollar up, equities down. and gold down as well. If you see rates low for some reason, they are super dovish, right? Which I don't think is the case, but let's say they are dovish and they're still looking to deliver those rate cuts, then you will see yields lower, dollar down, equities up, and gold. If yields are low, then gold would probably catch a bid because you still need that safe haven necessity in this current time here. So that's what's keeping gold pressured down lower is higher yields. Okay. What's something to keep an eye on if you want to trade the Nikkei, not considering the war? Not considering the war. Let's see. Let's go ahead and look at the Edge Finder first here for confirmation of the Nikkei. Nikkei is getting a neutral reading. I mean, Nikkei would be a really good trade to the upside. I mean, right now, let's say there's no war, like you said, no war at all. If you see yields come lower, the Japanese 10-year yield come lower, I think Nikkei to the long side is really, really good. Right now, they're elevated, and they might stay elevated just because of what's going on here, which kind of causes the Nikkei to not be the best trade. But yeah, if you start to see yields go lower here in Japan side, then I think Nikkei to the upside is really, really good. But right now, the neutral reading on Edge Finder is not the best, so I would kind of stay away from that one. And I would recommend everyone, if you have the opportunity to get yourself a copy of the Edge Finder, or if not even, if you for some reason it's kind of too expensive for you at the moment, go ahead and join the Telegram channel. They're doing a giveaway for the Edge Finder, so you have an opportunity to go ahead and grab that for free, and that just helps in grabbing trade ideas, filtering stuff out, things like that. When you're trading, you want to make sure that you're getting the best asset that's in play at the moment. Like if we all remember, the whole like tariff thing and all this other stuff, right? Like, or just any uncertainty, but besides this current one, gold was very much in play, right? And so you had those like strong gold readings and stuff like that. Now that's not the case. So you can filter out the trades that are in play and save yourself unnecessary losses. So definitely go ahead and get yourself a copy of the Edge Finder. All right, let's go ahead. Someone said it's a cheat code. Definitely a cheat code. Okay. What time is FOMC? Should be in an hour from now. What do you think about USD CAD? Okay, let's go ahead and look at USD CAD. This is the thing with USD CAD. I talked about this earlier in the stream. I'll be more than happy to go over it again. USD CAD is trading within a range right now. The reason why I think that is because you have the dollar, which is strong, but then you also have the Canadian dollar, which is also strong. The reason the dollar is strong right now is because it is the current safe haven during this whole time. And the reason why the Canadian dollar is strong is because the Canadian dollar is somewhat pegged to oil. So if oil is doing well, the Canadian dollar is most likely going to do well, and vice versa. So if oil weakens, Canadian dollar weakens. So the dilemma with dollar CAD is you're buying two currencies against each other. So that's why you're getting that choppy price action there. So I think that might continue. Especially if dollar weakens and oil weakens as well, because of, things, there's a resolution or something like that, it might be choppy still. So I will kind of stay away from dollar CAD. I think if you want to trade the Canadian dollar with something, probably Euro CAD would be good, because right now the Euro dollar is pretty weak and the Canadian dollar is strong. So you can probably short Euro CAD. You did get a pullback into this level here and it seems to be rejecting quite well. So that's something that you could probably look at instead. And if we go to the Edge Finder and look at Euro CAD, where is Euro CAD? You are seeing New Zealand CAD, Euro. Let's see, Euro CAD. Let me just type it in here, guys. It's getting a neutral reading. I did see that New Zealand CAD, so maybe that's a better approach too, New Zealand CAD, because the New Zealand dollar, as we determined earlier, is getting a weak relative strength reading here today. So it's pulling back here a little bit. So, you don't want to chase the price by any means, but that's how I would trade the Canadian dollar. Is not with the dollar, but with something else that's also weak. So basically what you can do is just go to currency strength index here, see which currencies are weak. Like, for example, the Swiss franc is weak. So maybe if you look at Swiss CAD, that's probably trading low today. So Swiss versus the Canadian dollar, or it's going to be CAD Swiss. That's how you trade it. CAD Swiss to the upside. Yeah, look at that. Trading higher here today. So something I was trying to shoot for here. I got an alert and stuff like that, but it never got hit. But, that's just the part of the game there. But yeah, CAD Swiss to the upside is how I'd approach it. So don't trade the CAD with the dollar. Probably look for other ways to do it. All right, let's keep on going. What's your outlook on West Texas oil or oil in general? I think oil to the upside is the path of least resistance, as long as you still see escalations in the Middle East. You're long Aussie yen. Do you think the intervention will affect me? That's just something you have to be mindful of. That's why I didn't go long Aussie yen the initial time when I went long the Aussie basket, is because you do have that possibility there. But if you're already in the trade, I don't know what your entry is, or I don't remember what it is. Just trail stops. That's going to be your best bet, especially if you're already in profit. Don't risk the intervention affecting you and turn that into a complete loss. So just trail stops on Aussie yen if you can. And that is why gold is down too. Gold is down because yields are higher. And gold being a non-yielding asset, if yields are high, it becomes more costly to go ahead and hold that gold position. It makes it a lot less attractive. And investors would rather go into the dollar for safe haven just at this current time. So that's not usually the case. Usually when there's a time of war, things like that, people flock to gold because it's a safe haven. But because you have global yields on the rise, that's why you're seeing gold under pressure there. Will Nick share his thoughts on FOMC? Nick is sick at the moment, so he can't make it here today. Sluggy, this is a fantastic question. I love this question. So, Alan, could it be that the hawkishness is already priced in and we drop on hawkish commentary? Yes, that is a very strong possibility. Here's what I'm looking at specifically. You have at the moment, so the reason why there could be some more momentum into the dollar, you do have at the moment the possibility of a 40% chance of one cut in December, and which is at the end of the year, right? So essentially, you're very borderline close to no cuts at all for 2026 if something changes. So if you do get that chance where they say no cuts for 2026, you still need to price in that extra half a point or point that was already intended for 2026. You got to price that one out. And so that's why I think there's still some room to go to the upside when it comes to like the dollar and stuff like that. So great question. All right, let's keep going here. Alan, have you watched the industry? I watched I think it was the first season. I watched the first season. Yeah, it was I think they were mimicking a JP Morgan currency desk. Yeah, I made a post on the A1 Trading Instagram account whenever, what was it? Oh, whenever we had the initial flare up in oil and the VIX, and I basically referenced the what was it called? The backtesting tool from the Edge Finder to see what are the forward looking returns after a 20% increase in the VIX, 10% increase in the VIX, and stuff like that. The title that I got from it was actually from that one scene when the guy said buy the dip, short the VIX, F Bitcoin. So yeah, that was a really interesting show, but I just didn't sit through the whole thing. USD CHF, that's an interesting pair too. So the Swiss franc, the Swiss National Bank, did voice, that they were willing to go ahead and intervene into the market to weaken the Swiss franc because it was just very, very strong. And so now I think, as the dollar Swiss continues to go higher here, you have a lot less chance of that. We were trading in this range here for a very good amount of time here. We broke out, we retested the level. And so now, the question is, maybe we trade to the upper end of this channel here or continue off lower. The Swiss basket as a whole, has been weakening. So if you just look at the Eco Surprise Index here, you can see that is probably one of the weaker ones here, comparing the other ones at 33%. So it's very possible that if you do get a surge in the dollar, this thing can probably go ahead and trade and target these upper ends of the channel here. Yeah, the only thing that concerns me from a technical standpoint is that this could be one of those break, retest, and continue downward. In my opinion, that would probably happen most likely if you get a de-escalation. But as long as you have escalations and stuff going on in the Middle East, then I think the path of least resistance for the Swiss franc or dollar Swiss, for example, is to the upside. And then we do have Crisp over here taking the show over here. So whenever he does hop on, guys, I will go ahead and transition it to him. But I really appreciate, guys, all the engagement that you guys gave me here. A lot of charts that we went through. So I'm very happy with that. Again, if you guys have any, I'll be on here later today as well. So if you have any recommendations, any charts you want to go over, drop those into the chat. I'll be more than happy to go over them. But I very do much like when you guys are involved and dropping the comments in there. So very, very good. Okay, cool. Thank you, James. I just saw the message there. So okay, awesome. All right, guys. So I will pass over the show here to Chris. He is coming on. You guys are in fantastic hands here. I'm very interested to get his insights as to what he thinks could happen here for FOMC leading up to the event. So go ahead and stick around. We'll go ahead and pass that over to him. And thank you guys so much for having me once again. You guys are fantastic as always. All right, guys. Have a good one.
Hey everybody, thanks for tuning into today's A1 trading session. We love engaging with our audience, talking shop, taking requests, and sharing our favorite setups. It's about that time where we're going to review a bunch of indexes, stocks, currencies, gold, silver, Bitcoin, and pretty much anything else and share our insights. If you're wondering what trades I'm in, if you're wondering what trades I'm taking, and you'd like to see exactly how I'm trading everything, you can actually follow my trading signals. If that sounds like something you're interested in, we'll share a link in the chat and you can sign up. You can sign up directly with the link or speak to a support rep if you have any questions. If you're asking, what do I trade? Pretty much everything. Indexes, ETFs, stocks, options, futures, Forex, and crypto. Thoughtful analysis, active trading. Check it out. And now, back to the show.
What's happening, everybody? Nice to be back. We are T-minus 1 hour until FOMC. Markets are down a little bit. I am looking at a couple of profit trap scenarios. So here is my 15-minute time frame on the SPX. So trades that I took this morning are pretty safe as far as the expected move goes. We shouldn't really see price going too much lower than about 66.25. That was a recent low. We had the previous low at 66.36. We had this low here around 25, 66.25. My threat level is if price falls down through 6,600, I take on a little bit of heat, but not a ton because my break even is 65.85 and my break even is 65.60 on a couple of trades that are down here. These also offer some pretty nice profit traps anywhere between $1,000 to $1,500. So if price just kind of bounces back up, I would expect the 66.50 handle to be pretty important today. Typically, I don't expect a lot of surprises during FOMC. It's usually very much in line with what market makers set up for the day. We had a plus minus 54, but I'm curious to see if the markets will slide a little bit lower. So this box you see on the screen here, this is my expected move box. I pulled this from my broker platform this morning, 54.80. So I plug it into my indicator. As long as I'm selling calls above 67.71, as long as I'm selling puts below 66.36, that should be an expected move and kind of the market efficiency for the day. It's FOMC, so would I be terribly shocked to see the market do something like this, come down to the expected move, bounce back up? Not at all surprised that happens. I might be actually looking for a short-term trade to do that if I can get a low-risk, high-reward trade. One thing that could be very nice would be maybe looking at like a bounce around 66.50, a bounce around 66.40, or of course the expected move around 36. Previous lows, just again acknowledging that low around 66.25 or so. But if I can get the market to offer a bounce, and typically in FOMC, if you ever traded this before, 2 p.m. to 2:30 is where the market digests the rate decision. Now, this rate decision is expected to be unchanged. We're going to keep the rates paused at 3.5 to 3.75%. It's the press conference from 2:30 to maybe 3 o'clock with Powell. If he says anything, the market's going to be surprised by, but usually he is very vanilla and very by the book as far as the transcript. He barely changes anything as far as his statement and reading. It gets a little off topic, I guess, when he's doing his Q&A. But I would say in the last, the guy's been Fed chair for what, 4 years? It's going to be like finishing up his 4-year term. I can think of maybe 2 times that I was really surprised by what he said and how the market reacted, like 2 times in 4 years. So it's, like I said, very unlikely that we're going to see a big surprise today. Now, taking a look at the bigger market, here's SPX. Let me go to the bigger time frame here. This goes back to some of the clean technicals I've talked about the last couple of months, which is once we establish this like 14, 15 week range, that's what this box is right here. Couple things, rising wedge. So we're making higher lows, but the markets were making these slightly higher highs. It just kind of pinched at the top here. Once the market broke and retested and failed, I thought this could be a really nice setup for a follow through back down to 6,550 to 6,500. We're close. We're close. We're not there yet. Markets are a little bit red today. We'll see if this comes back down to retest. I would say right now, this is a pretty strong level of support to look for some near-term buys. Okay. I mean, would I be loading up the truck and buying like crazy at 6,550? Not necessarily, but I take a defined risk trade. I think that over a 1 or 2 week window could certainly get back to like 68. If I'm really surprised, we go all the way back to like 69 and change, maybe 7,000. But like I said earlier this morning, if we fall down, this measured move gets us down to about 65.50. Okay. These previous lows, October 10th, November 20th, I'm just pointing out like very important levels the market's seen the last couple of months, right around 6,500. Okay. This low was 6,500 on the dot. This low was the day after, 6,507. So measured move is 6,550. The October 10th and November 20th lows, 6,500 to 6,510. I'm saying that because I would like to buy the market for a defined risk trade to go back up to maybe 67, 67.50, 6,800. If I put on a simple option trade, I could do a debit spread, a credit spread, as long as price could stay above my needed level, my line in the sand. I can make money on that trade over a couple weeks, right? And we'll see. But I'm cautiously bullish. I think the market has plenty of structure to see some support. We're hanging out around that 200-day moving average. We still haven't hit it yet. This is what I was looking for by the end of the week, is maybe this market just can't help itself, but just get a little bit softer, a little bit weaker until we find this 200-day moving average. One thing you can look for this week in particular is if we hit the 200-day moving average and then we close back above it. So that could be in the sense of like a morning star where it's, bearish decision, indecision bottom, and then bullish decision. Or if we close below with a red candle and then scream back above with an engulfing candle or a piercing line, one of those kind of candlestick patterns where it looks like, okay, the bottom might be in for some follow through. I would look to see if price can respond to that. But price testing the 200-day moving average or price testing these previous lows, does the market give you a bounce and give you some confirmation to go after a trade? That's what I'm looking at in the near term. That's S&P. Let's go Nasdaq. Here's NDX. Nasdaq surprisingly, the Nasdaq surprisingly has not had nearly the same type of down follow through. However, it is off a little bit more percentages. I think percentage wise, we're like 8% off the highs. So this pullback was around 8.9%. That was back in November. And then this pullback recently from the same test of the highs but fail, down about 7.16%. So we have about a 6% slide in the S&P, 7+% slide on the Nasdaq. The Dow, I know Nick was short the Dow. It's still actually down near these recent lows. The Dow, I believe, is down over 6%. There's a 7.8% correction. There's only 30 stocks in the Dow, and they're big and they're weighted. And I think a lot of the weighting is, let me double check this one. I know Goldman Sachs is in there, and that's been getting beat up pretty badly. I think Goldman Sachs is down almost 20%. Goldman Sachs is down about 20%, recently peaked to trough. ExxonMobil, XOM is up to some fresh all-time highs. I own the shares. That's doing pretty well. CVX, I own the shares. Is doing pretty well. XLE, I own the sector. It's doing pretty well. I mean, this has been a lot of my highlights of 2026 has been long energy, long scarcity, long everything that reflects, if we're really all in on AI and looking for this big AI build out, getting long the physical side, I think is a pretty good trade. And so far, so good. Do I think these are going to crash and burn for 2026? Not necessarily. But I think the broader market has to perform pretty well. I did mention this morning, is my market breadth indicator does have me a little bit concerned that the market has had such a violent dispersion that we are now only seeing about 34% of stocks in the S&P above the 50-day moving average, and we're right at the 50-50 zone for the 200-day. So this could either get a lot worse, where a lot of stocks start crossing back below the 200-day moving average, which means this would be, I'd say, less than 50. Okay, less than 50 is going to be, I'm not going to say bear market, I'm going to say correction. If the market is seeing individual stocks of 500 stocks, if we see, more than 50% of them below the 200-day moving average, that's not a good sign for a buy zone. That's a sell zone, right? If we see 65% of stocks below the 50-day moving average, that's a correction. So, like I said, I'm not going to say bear market, but I'm going to say that we definitely have more stocks aligning in a correction zone. If this gets to, 47, 45, 43, that just shows that less and less a percentage of stocks are above the 200 moving average, right? And it would show that the majority of those 500 stocks are below the 200 moving average. So not good market breadth. That was my point this morning when we were live. Here's the same thing on the Nasdaq. We have 65% of Nasdaq stocks below the 50-day moving average, and we have 55% of stocks in the Nasdaq below the 200-day moving average. I'm not screaming bear market. Clearly, the indexes are still, sideways with a little bit of a drawdown as the dispersion trade continues to run hot. But does this get worse before it gets better? Does it get worse before it gets better? Maybe. We're already in a decent correction. Individual stocks, certainly. Individual stocks, way more violent, way more volatile, way more drawdown than the individual index, which has been hanging in there with about a 7% drawdown. Okay. The Dow, again, with only 30 holdings, DIA top holdings. Let's see here. I guess I can look at the sector performance right here. Take a look at, let's see, holdings list for the Dow. See if this will just give me the top 31 holdings. Here we go. So I'm going to go by market weight. Goldman Sachs, I knew was up there. Caterpillar, Microsoft, Amgen, Home Depot, McDonald's, Sherwin-Williams, Visa. American. These are not crazy volatile stocks for the most part. Also, this is price weighted, not market cap weighted. However, it's still weighted with Goldman Sachs at 10.41%. So this stock being down about 20%, peak to trough, goes to show why the S&P is down, or I'm sorry, the Dow is down a little bit further than the S&P at this point. But there's enough other strong companies. JP Morgan, again, top 11 in holdings. JP Morgan and financials getting hit a little bit harder. The pinch on consumers, the credit card stocks dropped a lot when Trump had said, we're going to try to cap credit card rates at 10%. Well, the downside with that, and I don't know if this has been discussed, but if we're going to, and I don't know if this can pass, this might be it might just be narrative. It might just be a jawboning, whatever. But if it passes, let's say that they cap credit card rates at 10%. Is that good for the consumer? Sure. Credit card rates capped at 10%. It's not predatory at 23, 25% APR financing. But what it's going to do is going to tighten lending standards. It's going to tighten liquidity. It's going to tighten credit. That is not a good sign. We've been talking about these, widening credit spreads with the private credit market. If you take credit card companies and consumer debt and you tighten that up, you're going to see less and less lending and stricter standards, and that's going to be a crunch in liquidity. A credit crunch or a liquidity crunch is never a good thing for equities. It's never a good thing it's never led to a good thing when it comes to reducing the amount of flow, reducing the amount of volume and liquidity in the markets. Okay. So Visa down recently, peak to trough around almost 20%. MasterCard, same thing. Bigger picture, I do like these stocks, but this is down also 18+%. They're not volatile enough for me to say I'm going to sell. If I sold a 200, I'll do this trade 300 by 280. What would be the drawdown here on MasterCard? We'd have to draw down 53%. Let's look at it. Let's look at MasterCard. Let's look at Visa. Which one's cheaper, actually? Visa's at 300. MasterCard's at 491. Let's look left on this chart. So if I went, let's say Visa at 175, and I did MasterCard back down to this low. That is the 2022 low, by the way. That's a pretty big bear market low. That'd be 270, 280. Okay, I'm going to see if I can grab a little income trade here. And let's look at a couple other ones. Amex is 296. And I'd look at this one probably in the 150 to 135 zone. So AXP, let's go 140. So low here around 142. Previous lows around 135. Yeah, I'll say 140 to 130. So 135, 140. And then our COVID crash low was all the way back here to $70. Again, that'd be a monster decline. If we hit the Liberation Day low of May, March, April 2025. That's down 43% from recent all-time highs. If we get to the bear market chop here, that's 64% from all-time highs. Fundamentally, let's look at Visa. Okay. Visa, Snowflake looks great. Trading below estimated value. Earnings forecast to grow. Okay. Price to earnings, not terribly expensive, but it's up there. Mag 7 stocks are like 30 times earnings. Cash flow, discounted cash flow model, $422 fair market value. I'm talking about a trade down to 175. If I was assigned there, I think I would have a really good chance of making money. I'd have a good chance to repair my trade and make money. So let's see. Let's have a look at all of them. Visa. Trade. Let's look out to September 2026. That's out 184 days. I'm kind of in this window of like, I would be bullish on a lot of things going into the midterm elections. The market just kind of maintains this resiliency. Let me look at the 170. You can see here that the strikes are offering little to no credit, so I don't love this trade. But if I did like the 190 by 180, okay, is it worth me taking this trade for $60 of income? Not really. In fact, I'm not going to take the trade. I mean, that one's not bad. This one's not bad. I mean, I get it. I made $100 on the trade. Like, this is a pretty safe $100. So this is 90 cents. If I get filled for 90 cents, it's not $100, but the probability of profit is 99.5%. If I put this in a margin, it's not going to tie up a bunch of capital. For $267, I can make about $100 return on that. So I make $90 return on a $267 buying power reduction. I'm making 33% on my buy power. That's not a bad trade. Do I love it? I'll come back to it. So that's Visa, 180 by 175. 180 by 175. Okay, fine. If I wanted to go a little bit more, I get $1.67, but I'm doubling my exposure because I could take up to 200 shares, which I don't really want to do, but I still have a 99.5% chance of profit. This one would be a little bit more income. Buy power is 534, but I can pull in about $1.65 out of the 534. Again, around 31% return on my buy power. That's adequate. It's not fantastic, but it's good. It's doable. It wouldn't kill me to take this trade. So that's not terrible. And I'll put a 170 as an option. I'll look at some other trades. Let's go to MasterCard. Ticker is MA. I'm looking at the strike around 280. September 2026 at the 280 strike. This one's a little bit better. I could go 300 by 290. Let's go this one. That one's okay. Let's try to get over $100 on this one. No, that's a big jump. So this one's worth $1.75. Bid ask is a little bit wide, but if I got $1.50 for this one, I don't mind it. So that puts my break even at 280. That would be owning shares of MasterCard way down here. So MasterCard way down here at 275. I think we'd be like 50+% off the highs. Yeah, that's a 53% discount off the highs. I think the trade is pretty safe. I mean, realistically, from the technical side, if we come down to this level, which is Liberation Day 2025, do I think that we can bounce from there and have a range trade? Sure. So does that make my trade nice and safe? Probably. I would guess it's a 99% chance of profit or so. 99.5% chance of profit. All right. I'm going to take this trade from my margin accounts. It's, not super expensive for me, about $500 of buy power. This one drops off a lot. So, I mean, the difference of this trade here for $1, I mean, if I get $1.50, I'll take the trade. I'll try $1.75, go $1.70. I'll kind of work myself into it a little bit. Let's see if we can get here for $1.75 and see if I can get a fill. Well, that was freaking easy. That was almost too easy. Okay, I'm going to try to get more money then. So $1.75. Let's go similar. Let's go up to $1.80 and try another account. $1.80. Not filling. All right, well, certainly a good fill at $1.75. Working order $1.80. Let's try $1.79. I'm just trying to see where the sweet spot is for the fill. $1.79 not taking. $1.78. $1.77. $1.76. I hope the $1.75 wasn't a fluke. No, I'm not filling it a $1.70. Oh, I got filled. Okay, $1.75 seems to be filling. All right, new trade coming at you for Pulver Alerts. This is going in stocks and options trade. This is new trade. This is MA. I'm going 9/18 expiration. Buying the 300 put. Selling the 290 put. $1.75 credit. Filled. So I'm willing to own MA if price is less than 290 by expiration. I'll put unlikely. We have a 99.5% probability of profit. If assigned, break-even price is going to be the 290 strike minus 10 on the profit trap and the $1.75. I'd own shares at 278.25. Which is over 54% discount from all-time highs. Okay, let me post that trade for everybody here. New trade. So everyone in my Pulver Alerts. There you go. And I'll get this posted for my other margin accounts. Yeah, that's having no problem getting filled at a $1.75. So I'll take that trade. And just work my way through the accounts here. Almost there. Okay, so everything's getting filled with $1.75. Very good. Okay, so that's MasterCard. Let me check Amex. So AXP, a little bit lower in like the one. This is way down here, like 140. Let me see what peak to trough would be on this one. That would be over 60%. I might go a little bit further on this one for Amex. That tends to do a little bit better for the wealthier demographic. So maybe on this one, I will go out to November, December. I actually have an October expiration. Let's see what October looks like before midterms. Strike around the 135. I don't even have the strike in the October expiration. Let's go November. I have the 155. Could I do this? That's 20. Let's go 25 wide. Nope. That one's okay. Let's go out to December then. I'll go a little bit more time. So December 2026. A little bit better here. So I'm looking at like the 135, 140 handle, a 150 by 140. Let's go 155 by 145, 160, 150. It's a little bit better. Not a ton of income. 165, 155. That gets me down by 10. That's 145. I mean, this one's adequate. If I can get filled for $1.25, it's pretty good. 99% chance of profit. You know, $1.20, $1.25 income. Return on risk would be about 50% of my buy power. This one only needs about $250. If I get filled for $1.25, I'm making 50% return on my buy power for my margin. Robo says, do you want to be assigned the shares? I mean, I don't expect to be assigned the shares, but I'm saying if I did get assigned the shares, would I take the shares? Would I own the stock at a 60% discount when every single one of them, take a look at Visa from a discounted cash flow model. If I own the stock at what's my break even? If I owned it at 278 and the fair market value is 422, would I want to hang on to that stock to repair it? Yes. If I looked at MasterCard, right? Snowflake looks okay. Price to earnings 30 times. Discounted cash flow 641. I'd own the shares at 278 for a fair market value of 641. Love it. Amex, AXP, cash flow or Snowflake looks good. Price to earnings 20 times. This actually is cheaper than the other two. And discounted cash flow at 386. And I'd be owning this thing at like 130. So, I mean, do I expect the assignment? No, that'd have to be a massive, massive correction, by the end of this year for that to happen. But I have to put the trade on. Here's what I'm doing on a trade like this. This is a ratio spread. I would take this trade with the understanding of if I get assigned, I don't mind owning the shares. I have the capital to own them. Do I want to own them? Not really, but I would certainly own it, repair it, flip it to avoid taking a loss. If I were to take this trade and I didn't want the shares and I want to manage the credit side or the premium side, well, the 150 strike is offering $1 credit. So if I manage that to like a $3, $4 debit, well, there's a proper way to get the stop out. And then I can also use the 160 put as a free hedge. So you can use it to kind of, mitigate a lot of the risk. But if this, $1.50, or I'm sorry, the 150 strike fills for $1 credit, then manage it like a $3, $4, $5 stop loss, take a few $100 out of it, and you're managing risk. So it doesn't have to be the end of the world, right? But I wouldn't mind owning the shares because it'd be way cheaper. So let me see if I can get this one filled for $1.25. And I'll put this on margin accounts as well. $1.25 not filling, mid-price $1.24. As long as this will fill for like $1.15, I'll still take it. $1.21 not filling, $1.20. Come on. $1.20 got filled. Okay. So $1.20 fill on this one. $1.20 fill. Just going to finesse it a little bit. $1.19. $1.18. I said $1.15. I'll take it down to $1.15 if it doesn't fill. Otherwise, I'll let it sit for $1.15 and see if it does fill. $1.16, $1.15. Final offer. All right, I'm going to leave it at $1.15 for my other account. So I got filled on one at $1.20. I feel like that's pretty generous because the broker clearly isn't filling my other trades. So I'm going to go similar. This one's $1.15. I'll try $1.15 on my other accounts and just let that marinate. Now it's getting filled at $1.15. Good. Okay, so those are all sitting there at $1.15. I'll add this in as well. So this is new trade. AXP. This one will go on a little bit further. So this is a 12/18 expiration. Buying the 160 put. Selling the 150 put. Pulled in $1.15 to $1.20 credit. Filled at $1.20 and $1.15 on multiple accounts. Similar to MA trade as far as, exposure. I'm willing to own AXP shares for a massive discount. There's a 99% probability of profit on the trade. If price is less than 150 by expiration. And I'm assigned. Break-even price is, so I'd be assigned at 150 minus the $10 profit trap minus the $1.15 credit, 138.85. 138.85, and I'll use covered calls to repair for profit, or own a bit longer for gain. The chance of assignment's like 2 to 3%. So it's very unlikely that I get assigned. I'm just going to keep it there for a little bit of exposure on my margin accounts. Okay, so that's posted. And this is new trade for American Express, new trade for MasterCard. Marco, what's up, man? How are you?
Hello, doing pretty well. How are you?
Good, good. Nice to see you, man.
Yeah, great to see you as well. I think this is our first time streaming together.
Yeah, all good. What else you want me to go through? I just took a couple trades here on Amex and MasterCard. Just a couple little income trades. I talked about this a lot this whole year, which is I'm trading options. I'm selling premium. I'm trying to stay out of the way. I mean, if this trade gets really ugly and all of a sudden, oh my gosh, the consumer is suffering, there's a credit crunch, they're changing the borrowing standards, blah, blah, blah. I mean, even if this were to fall to this level, I think we still have a pullback and then maybe we go lower. I think by the timing of this trade, I don't think I'm necessarily going to be in trouble. If I own it 55, 60% lower, would I own the shares and repair it for income? Yes. So my goal is to, I don't want to own the shares. I just want the income. Between those two trades, $1.75 and $1.20. I mean, it's a $300 trade. I'm making $300. That's probably the probability profit on that. Nothing to get excited about, but a pretty safe 99% chance of profit, 99.5% chance of profit. In this environment, I would take safe probability, boring income versus trying to do something brave and trade in, this choppy, dicey, volatile environment where nobody really knows where things are going to be going. So that's just me. But what else you want to look at, Marco? You can grab the screen if you want. We can go back and forth. Or what do you have? What do you have in mind for FOMC here in 30 minutes?
Yeah, I wanted to first ask you on the macro situation. So what most people are thinking, is there going to be an escalation or a de-escalation? And I mean, no one knows, but you're of course reading the news, you're on Financial Juice, you're seeing all of the posts coming out. So what would you say, where are you leaning, for a prolonged conflict or the one where there's negotiations soon and the thing dies down a bit?
I don't think it's going to be an immediate de-escalation, but I think that your kind of direct impact would be if oil prices get back above $100, the U.S. is in some more trouble, and the markets are probably going to start showing that. If we stay below 100 and we remain very volatile and elevated, but maybe between 85 to, let's just say $80 to $99, like that's kind of the oil range. I would say for oil to be, let me just add a text box here. I'd say oil less than 80 would be de-escalation.
Okay.
And I would say oil greater than 100 would be renewed escalation. So right now, I think the market's just kind of making some sense of everything. Like, is it going to get worse before it gets better? Move this down here. There we go. So that's my outlook, is watching oil prices. I don't think that the U.S. economy or the Trump administration can really afford to piss off voters any more than they already have by having this as one more thing on top of everything else, with AI disruption, labor market softening, all-time highs, high valuations. The consumers have been feeling this pinch for 5 years, 6 years now with inflation. It's again, inflation is slowing, but everyone has higher prices for the last 5-6 years, and it's bad. Oil prices with the spike up. I mean, we went from $55 a barrel to now 120. That was 115% gain in oil in just a matter of a month or so. I think for it to be a de-escalation, we have to see prices drop below 80. I think that would kind of put a top in for oil. I think that if we reestablish a nice solid close on a let's say a weekly basis above $100, I think that we have a renewed escalation, which means this isn't going away anytime soon. And traders can probably expect this to maybe last into, I would say, into April. I really don't expect this going too much into April because it just gets harder and harder to justify, like, why are we doing this? So that's just my thoughts, is it probably needs to be over in the next maybe 2 to 4 weeks at most. Anything longer than that, I think it's going to weigh on the markets heavily.
Yeah, I found this projection. So if we can just bring up my screen. Thank you, James. Which is from Bloomberg. And essentially, so these are the paths for oil. We have the pre-war, the Hormuz closed for 1 month, 2 months, and 3 months. Essentially, the longer it's closed, the higher the price goes.
Yeah.
So if it goes for 2 to 3 months, which it definitely can, we can hit 130, 140, maybe even 160 per barrel. So that's why. Yeah, sorry.
No, I just said like that stings, man. That's just such a aggressive move in oil. That's so
Yeah, that's crazy.
outlierish. I mean, and what's going to happen in 2026? You look. This is always what's interesting about trading is there's always a narrative that the market latches onto.
Yeah,
We've already created gold. We already created silver. Now we're creating oil. Like all these crazy outlier explosive moves. I mean, if oil gets to 150, 160 a barrel, I mean, look at our charts. Look at oil at 150, 160 a barrel. I mean, we're talking revisiting, I mean, higher highs from March 2022 when we actually had like inflation going nuts.
Yeah.
So,
and Russia, Ukraine, I think that was right around the time when the price exploded.
Let me ask you something, Marco. In the big picture, do you actually see a case? I mean, this would be, I mean, back to like, I mean, $150 was great financial crisis. I mean, gosh, if there's a preview to great financial crisis 2.0, oil gets to $150, and I don't think there's any way this is going to be a good thing for the U.S. economy. So that's what I'm saying. Like, I think this is probably, if the markets want to survive this without too much damage, we don't want to see oil getting back to $100+ sustainably. I think we need to kind of keep that level in mind. Nothing should really come back up over $100. If it does, I mean, this was one of the biggest crises and collapses we had in the markets ever outside of the dot-com bubble and the Nasdaq. But nothing good is going to happen when oil's at $150 a barrel, except maybe a short oil trade eventually. That's about the only thing that's good. But it's not going to be. I mean, if you're in a 50% drawdown in the index or more, and your oil trade, it's like, well, I guess that's one way to hedge. But anyway, do you see this? What are your like kind of big picture views on oil? Do you see this as, you know, major support? And are you now looking at like kind of these intermediate resistance levels? Do you think that we get to 140, 150? What's your big picture?
I think it's all about Trump. So will he taco or won't he taco? If it goes to above 100, if it goes to 120, if it revisits the high that we had on the 9th of March, I think Trump could get pretty concerned, and the pressure coming from Asia, from Europe, from India to resolve the conflict and get the Strait reopen would be just too high, and some sort of negotiation would happen. But for me, I'm betting for a quick rush to the highs when I will probably take my profit at, let's say, 118, maybe even 120.
Okay.
I don't think we're going to go into those extremes of the GFC that we had and the absolute crazy highs that you showed. I think if we go to the weekly, I think.
Yeah, it's all the way back to like, that's like the 2008, 2009 high.
Yeah. So essentially, I don't see such a case, but a bit more upside, absolutely. I'm seeing all of the posts. I'm seeing financial juice. News is coming out. It's not good. Like no negotiations, bombs flying left and right. Iran bombing oil fields in the Middle East, and then US bombing oil production in Iran. So right now, I'm just not seeing any sort of positive news that would make me want to stay out of oil or maybe even go risk on. I definitely don't want to go risk on at the moment.
Okay. From the, let's just do a measurement here. I like this as a potential harmonic where you take this big swing and then there's your big disruptive pullback. But if this is what gold did too. Gold had this massive, this would be your X wave. And then you have your A, B, C, D. That puts us up to around the 114 level. I'm sorry, 117 level. So 116, 117. That's a nice little measured move to be protecting profits around 116, 117. That is about where I'd look at start taking some defined risk shorts between 117 and 120. If I looked at a defined risk trade where I'd have, less risk, more reward, that to me is kind of the line in the sand. If we're going to de-escalate, I mean, like I said, I think under $100 is de-escalation. Below 80 is obviously like, okay, we're solving things. But if we run back up into the 110, 115 zone, I'm probably going to take a defined risk trade here and hopefully have it set up where it's, let's say 2 to 1 or better, maybe 3 to 1. But that's going to be my stop above like the 120 handle. And that, I think that's a fair trade. Now above that, it's like, I think traders have to look at this as just like anything else, like what becomes like the asymmetric trade right now. If we breach 120, I mean, obviously you can look at it and say, well, Chris, I'm going to put a stop loss right here and go for that big scalp to 150. It's like, that's fine because you can call that, higher reward than risk. But on the big picture, to me, I'd say we've only been higher than 120 like 3 times ever. So, I mean, unless we are talking about like really, really cracking all-time highs, I would not look at this and say that with a high probability that you have lots and lots of upside left in oil. I'd say if anything, it's like this is escalated. This is geopolitical tensions. But if you give this enough time, we're probably going lower. It's just right now, it's like, do you set the trade up for 6 months from now? Do you set the trade up for a year from now? Because I don't even know how many. If I went out to futures, let's go oil here. So /CL for oil futures. If I go out to, I guess I can go to the end of the year 2026 or early, or even January 2027. Expected move. I mean, we're trading, right? So oil futures are repriced out to this January contract down to like $76. So this is saying that we could have oil down to like $58 in futures, which is obviously way different than now. So even the futures market is pricing in lower oil prices.
Yeah, which is pretty weird.
Yeah, I think that in the big picture, you're not necessarily seeing big forecasts for all-time highs. I would say, if anything, the higher reward to risk opportunities to me will be about, basically selling oil into these crazy extremes.
Okay.
And trying to set it up for some good asymmetries. That's really the trade I'm going to look for, is define risk, low risk, and hopefully, higher reward. And, I like the idea of give this trade, 60 days, give this trade 90 days. I think that's fair. If you give it out to the end of the year, as long as you get an adequate price for it, I think that we would, be going lower from there.
Yeah. The thing with oil, a lot of infrastructure in the Middle East has been destroyed. And people think once the conflict ends, it's just going to go back to the initial levels. Right. It's not going to happen, because to repair the damage that was done, it's going to take months, maybe even years.
Yeah.
And that 20% supply is going to go down to, I'm not sure about the number, but maybe 10%. Definitely, it's going to be hurt by all of the stuff that was destroyed in the conflict. So we definitely, if there's a de-escalation, we definitely don't go down to the initial level.
Right.
At least long term, we don't. It's going to be higher prices, which is then going to be higher inflation, which is then going to have an impact on the central banks. And that's now a whole different environment that we're operating in, basically.
Okay. And to that counterpoint, I would say, do you think that this is not discussed right now in the current administration? You don't think that like Scott Bessent, Trump, and everyone talking about this stuff now, like this has to be on the drawing board? Like in the game of global chess or the game of global risk, it's like this has to be discussed. So I do think, if anything we have in this administration, they're extremely vocal. One thing the market doesn't like right now is they don't like jawboning, because you can't tell us, like, I mean, the market did it a couple weeks ago on Monday when Trump said the war's almost over, and the market jumped up like, 0.5% or whatever at the end of the day, but then it faded it. So, I mean, you can be told for the day, but it's like, it's the market's not believing it right now. Prices are not supporting, the jawboning, right? We're still making lower highs, lower lows. We're still leaking lower. I think what this market may be interested in doing, and this is what the market's so great at, is it's so great at making traders uncomfortable. And so this like slow burn, slow grind to the downside, it does have impactful concerns, because if we had this slow grind to the downside, all it takes is one key level support to break. And all of a sudden, what felt like, well, it's pretty contained, the market's only down a couple percent from all-time highs, but then it takes one giant drop and you're like, oh crap, major support just broke. Now this market has turned into a bear market. And all of a sudden everyone is clutching their pearls and buying puts and trying to add insurance. And it's already too late, because the VIX is at 30, 40, 50. And it's already happened, right? So I do think all this is being discussed. I don't think this administration is stupid. I just think that I don't know. And I said this on the sessions earlier. It's like, I don't know what the end game is here. I don't know what the reason is, other than, you get into some conspiracies of, well, this was Israel based and we're doing this because Israel's going to launch an attack anyway. So we preemptively beat them to it, or just because we were trying to satisfy the threat that they made. Or this is something with, in a time of war, as they say, like when, buy when missiles fly, because this is good for business. And so your defense trades, your energy plays, like all these things could be great. There's probably tons of insiders that are making boatloads of money in this with the increases in energy prices. But I don't know how this is a good thing outside of, is this a U.S. tactic to try to get a little squeeze in China? Because if oil prices are higher, you shut down some of the global supply. Does that squeeze China? what are your thoughts on that? I just listened to an interesting podcast last night with somebody that he's been in China for like almost 30 years. And he just says, look, I don't love to invest in China, but I don't like to bet against it either. He's like, I'll never bet against the US, but I certainly at this stage from what I've seen living here for so long, he's like, I wouldn't bet against China. I don't like to trade them, invest in them, but I don't like to bet against them either, because right now it's like they have been playing the long game with strategic minerals or rare earth minerals, and the way that they can build things, put things in order, like from top down, whether it's initiative to backstopping the markets to putting in liquidity. But I think they've rotated from a growth at all costs type country to now we actually have like the physical side of what people need. We're more than just a toys and widgets type manufacturing economy. Like they are manufacturing things that everybody wants now. And then you have the DeepSeek and the AI and everything else from the tech side. Like it is a very disruptive country. And I think if the US wants to compete, we can. I just think that we're going about it I'm not going to say the wrong way. I'm just going to say an interesting way. I don't know what this is in the long game or how this makes the US look better.
Yeah, I know that China is trying to have the Chinese yuan as the reserve currency. That's kind of the main bet, long-term bet, because right now, of course, the US dollar is the reserve currency. But what I noticed is I think Iran would allow tankers to pass through the strait if the oil was paid in Chinese yuan. So essentially, which is one step towards the Chinese yuan being the reserve currency. Right. So China is absolutely a major player, but I would still say the US is number one because China is too closed and they're running a closed account, I believe. So they're not letting money flow out of China. But essentially, what I wanted to say, what's funny about the current markets is I'm on Twitter, and most people on Twitter are talking about how they're going to buy the dip after the conflict ends, then actually protecting their account from the massive dip. So essentially, people are mostly focused on buying this because they're expecting the resolution, and they're expecting just a small dip. Then actually thinking through and saying maybe this crisis lasts for longer than expected, and the S&P breaks those key levels, and then it's an absolute bloodbath because it catches everyone off guard, basically, if the level breaks that you mentioned. I think you mentioned on the S&P sort of 654, something like that.
Yeah, 6,500 would be a pretty key level. That would make the bears look much better and the bulls look a lot more on their heels. If the bulls, I'd say they'd have a lot more work to do. If we crack below 6,500, the bulls have a lot of response to get this thing back into like bullish territory. Because then it goes from like, this is a, little slow dip feel. But if we crack 65 with any type of conviction, I think we go into correction territory pretty fast. So, and again, even to that point, though, it's like, okay, so what's your Twitter vibe of, okay, if we're buying this dip short term to then start protecting, how big is the protection play? Are people looking at this to go down to like Liberation Day lows? Are they looking at this to get worse, like maybe to the tune of 10, 15, 20%? Like, how bad is this? How bad is this escalation? That's kind of my question.
As far as I currently understand, the vibe on Twitter and generally the internet is just a small dip. So just a small dip, no biggie. So if we drop, it could actually be a big move because, again, people will be unprepared. As far as levels go, well, if we zoom out a bit and I bring back the S&P, and again, if the Fed doesn't do any rate cuts this year, that's going to hurt the stock market as well.
Sure. So
I think we could hit maybe 6,100. I think that could definitely happen if we get a prolonged conflict. If oil prices go to, let's say, 120, maybe even 130, S&P is gonna get hurt. So the whole situation is definitely not helping the U.S. stock market, which is one more reason why Trump may reconsider the whole move. But now, if Trump pulls back, will Iran reopen the strait? I'm not sure. I mean, they killed the Ayatollah. You have the new cardboard Ayatollah who's running the show now. So essentially, not sure under which conditions would Iran open the strait. That's another question to ask.
Yeah, it's a lot of moving parts.
It is
like I said, when this first happened, I'm just like, why are we throwing more fuel on top of this like escalation in the Middle East? Why are we throwing more fuel on the geopolitical side of things? And again, I'm sure there is a reason that we may not be aware of. We may not be being told. But what I am sensing is that the market is not loving everything's going according to plan. It's like, well, what is the plan? What is our plan right now to have this, what is the plan of having oil prices spike 150%? What is the plan of having, AAA gas prices going from $2.50 a gallon? I mean, if you saw this, it was only a few weeks ago, Trump's State of the Union. I mean, I just did a fact check and I did 10 different sources, all these fact checks. And it was like, false misleading. He's talking about gallon, I was in Iowa for a whatever. I was in Iowa for a speech, and I saw oil prices down to under $2 a gallon. It's like, what's it at now? I mean, I know out here we were at 250, 260, like literally 2 weeks ago. Now it's 379, 380. That's a big jump. It's 30% higher. And that's probably nationwide, and it's certainly worse in other areas. We were just in California last week, and it was like 5 and change a gallon. It's not great. So I just think the market doesn't like to be jawboned into like everything's going to be fine, because we don't know what the end game is here. And I think that's why if you want to look and see, is this escalating or de-escalating, back to your original question, look at oil prices. If oil prices are back over $100, then things aren't getting better. If oil's falling sub 90, 85 or 80, then maybe there's the Trump taco trade stuck in there somewhere. Maybe this is de-escalating a little bit, but it's a disruption in any way, shape, or form. It's going to be a disruption. I think that the disruption, whether or not it leaks into the overall indexes and equities, we'll see. But one thing I do know in the S&P 500 is all of your little energy stocks and all of your mid caps and all your small caps are not big enough. Even if they rip to crazy all-time highs and they're the best performing stocks the entire year, they're not big enough to move the indexes. We can't move the indexes without Mag 7. We can't move the indexes without top 10 stocks. So we need NVIDIA, and we need Amazon and Tesla and Google and Microsoft. We need those stocks to actually be bid or moving higher to bring this market to all-time highs while this rotation is happening. But I mean, if the overall sentiment is so sour and people are running into defensives and into energy, or just going into cash, it's like, I mean, there's somebody I really respect out there that I follow, a simple portfolio mix.
Okay.
And they just went from about a 60% allocation to equities down to maximum 25%. Maximum. So they just reduced, a pretty standard 60% exposure down to 25% just to avoid some volatility drag, just to avoid some tail risk, which I respect. And it's like, okay, so this is why I trade options so much, because I can, kind of park my levels out of the way and I don't have to be participating in this fully invested. But I'm genuinely concerned with the market. If it does fall, how ugly does it get? And so I keep those numbers in mind. I mean, falling back to that level you said around 6150.
Yeah, 61. Yeah.
It's a 12% correction, right? So if we get I think 10 can become 12. I think 10 becomes 15. And my scary correction would be we go from all-time highs and we pull back 20%. And then we see that, maybe the market does have this crazy taco trade down here. But Marco, I don't know if the 20% correction is enough to get us back to all-time highs again, or if it comes back into this area and all of a sudden we're putting in this monster multi-year topping pattern. So it is just like a let the price action kind of play itself out. We're not going to fall in a straight line. I'm pretty certain we're not going to fall a straight line. So let's see how this slow bleed to the downside plays out. If it gets a little bit worse, okay, fine. Buy the dip, okay, fine. Lower high to lower low, maybe it rolls over, but really strong support out here towards like 56, 5,700. But like you said, I like the 6,500. I like the 6,150. I think the market has some reasonable short-term opportunities there. But, playing defense or having some cash on the sidelines is not a bad play for 2026, because there's a lot of uncertainty out there, and this just adds more to it, more uncertainty ahead,
Yeah. I know also Warren Buffett, when Trump won, Warren Buffett went like mostly into cash. So I guess
he's been a net seller since 2024. He's been a net seller of stock since 2024. He pretty much missed everything in 2025. But again, Warren Buffett's not stupid. And I know he's back down from Berkshire Hathaway, but that call was, when he was still chairman, when he was still, CEO. But yeah, I mean, his indicator is overvalued. I think for the most part, we're in like the top 1% of valuations in the S&P and individual stocks and sectors. So it's like, yeah, stuff's expensive. AI productivity or not, I mean, it comes to the expense of the labor market, which is also this whole new dichotomy we have to manage in the U.S. markets, which is, okay, we have all these corporate profits and that's great, but we have nobody to actually work anymore. And again, that's like the dystopian outlook, but corporate profits are great in the near term. But did you see, was it this week or last week that there's a proposal that now companies, I don't know if it's going to be approved or not, but that instead of reporting quarterly earnings, they would give companies the option to only have to report like maybe once or twice a year if they choose to. And that would completely change the game of, how earnings are reported. And that changes all of the flows of the markets when it's like, these companies are heavily influenced and heavily incentivized to have the right accounting practices, fudge it or not, but have these accounting practices which allow them to show proper earnings and change the expectations so the bar is set just high enough to beat expectations, but low enough that it's realistic. I don't know. I just feel like that changes the overall outlook of like, that can't be a good optimistic sign if it's like, well, we'll just do it once or twice a year now, and you can make it optional for Fortune 500 companies. That would change a lot on earnings and volume.
Yeah, no, I also saw that maybe like universal basic income will be a thing where most
no
people
government's
get
ready
fired.
for that, dude. No government's ready for that. We're not ready for that. You know how big our deficits are going to have to be if we're going to run a UBI for everybody, and to be told what you can make and what you're going to be expected to purchase as a 70% consumption nation. It's like, I just think there's no way that manufacturing is going to be that big and popular and prosperous in the US that we can provide that. I don't think our companies are that profitable to want to give. Are we going to tax is this like Atlas Shrugged? Are we going to tax our biggest corporations, 90, 95% so we can have a UBI so they can survive and do business in the US? It's like, I don't think any government is prepared for that. And we would blow out our deficits. We would blow out our debt if we tried to run something like that, because not only have defense spending, Medicare, Medicaid spending, now interest expense on our debt. You throw a UBI in there somewhere and like lump that into like Social Security or load that into Medicare, Medicaid. It's like that UBI would be probably one of our top 5 line items. And what is it? Everyone gets a poverty level? Are we paying everyone like, 30 grand a year, 50 grand a year, or is it a livable wage? Nobody knows.
Yeah.
It's like, dude, that would be, that'd be freaking awful. It would be awful.
People wouldn't have anything to do. What kind of a life is that you're just sitting at home and collecting a check? I know some people love it, but for me and for most people, I think it would be sort of a hellhole. But the best case scenario that I found would be that we create new jobs. So someone to like take care of AI, to monitor it, to implement it. So like with the revolution, with every single revolution, for example, with Excel or computers in general, that was a revolution, and people moved from one type of jobs to a new type of a job. But again, AI can pretty much mimic a human in specific jobs. So it's tough. It's tough to see what sort of a new job market we could get.
Very true. I'm just going to do a quick. I want to deep dive in this a little bit for tomorrow's session. But every major CapEx cycle that we've had in let's say the last 30, 40 years, they've all ended terribly. So even right now, this is clearly a CapEx spending cycle. I'm not saying it's a bubble, because we have hyperscalers and some of the wealthiest companies in the world, biggest market cap companies in the world. They have cash, but they are going to some type of debt to keep building and keep, investing in this infrastructure. But if investors decide that this CapEx spending is not giving us return on investment, this is why the rotation in 2026 is so obvious, because this is already being questioned. It went initially from they have enough cash to do this, and they're just tapping into a little bit of that cash reserve. But then it went from, I think Oracle was the first canary in the coal mine when they started doing debt in order to spend. And then they showed that if they do raise this debt, they're never gonna see it with revenue. And then it went from that to the circular financing that's going on in AI with kind of Microsoft and Nvidia and some of these like core players at the center of the web, and then all these other beneficiaries around it. And it's like, if one portion of this web cracks, it all either goes down together, or it's going to be on like the backs of the biggest companies in the world. And it's like, this is why the rotation is happening, because I think it's putting way too much emphasis, and it rhymes way too much with what we saw back in the 1999 run up, where 2001 was, everything was crushed, right? And the index and the Nasdaq was down almost 90%. Individual stocks down 90+%. Individual stocks were bankrupt and went to zero. But what came out of that was, outside of a financial crisis in 2008, what came out of that was some of the strongest companies that have led us, for the last 2 decades. So I think that this is why I've said it's very difficult to pick one stock to survive and do well. But to me, it's better to trade the index. It's better to trade the haystack, because whatever comes out of this that's good and beneficial, I hopefully you see that move the needle in the indexes, and also avoid some of that crazy volatility.
Yeah.
So
and if
I'll look into this more. I know that this ends very badly when it's all said and done. Every major spending cycle like this will ultimately, start to force an earnings compression. It'll start to question return on investment, and there's going to be some type of value compression, some type of earnings compression in the markets that'll drag prices lower.
Yeah, I just wanted to bring up Oracle. I think right when they announced a massive investment or a massive deal with OpenAI is when their stock sold off quite aggressively. It was right at the top.
Yep.
And that's also the time when Meta announced massive, even more spending into AI. Their stock dropped as well. So investors are not liking the situation at the moment.
Agreed.
With this massive spending. It's too much. It's getting too much. And also, should we check the statement? I think the statement just came out. If I'm not mistaken.
Let me look at some financial juice.
Yeah,
so
sure.
It's going to be pretty vanilla. Let's go financial juice here. But let's see if there's any highlights from the statement. Maybe a couple of red highlights here. Let me go.
So James, if you can just flip to Chris's screen.
Yeah, I'm still looking for. This isn't loading. It's still spinning. Let me go into. Let me see if I have a news feed in my Discord.
I can bring it up. No worries. I have it.
Yeah, if you got it, I'm just going news feed here.
Yep. I have it. Sure.
Let's see here. More Trump stuff expected to soon lift summer gasoline regulations to curb energy prices. I mean, are we just going to deplete our strategic reserves? Maybe Coinbase plans. I'm not seeing anything on Fed yet in my news feed. What do you have? Oh, there you go. That's what I'm looking for.
Yeah, I'm seeing just the numbers at the
just
moment.
Held. Yeah, 3.75 held.
Yeah.
Okay.
I'm not seeing any sort of a text. Okay, we have the projections. So
we have a dot plot. There's a dot plot.
Yeah, we have a dot plot. Yeah.
All right. Where's everyone sitting right now? So 2026. Can you zoom in on that, Marco?
Yep,
we're kind of sitting right around 0 to 1 rate cut, kind of where everyone's hanging out.
Maybe.
Yeah. I mean,
it's maybe 0 to 1. Yeah.
Yeah. Well, I see on the CME watch tool, I only see like a December cut is all I see for the probabilities right now.
Let me see the Fed watch tool. Let's bring that up as well.
Yeah, we're all paused. I like to go to the probability section of the watch tool, so just keep the screen. Probability section will give you like over the next 6 meetings.
I think that's it. What I have. So essentially, by the end of 2026, what is priced in is pretty much no cuts. So we have the same target rate by the end of 2026.
Okay. Yep.
We can go even further, but I know before this statement, the probability was for 1 rate cut of 25 basis points. So it was moved higher. So pretty much hawkish. Looks like it's hawkish.
Right. Well, so are you saying that a pause is hawkish, or are you saying that do you actually see us raising? I don't think the market's going to love a raise.
Essentially 1 rate cut was priced in. Statement came a minute ago. Now we have the probability that there will be no cuts this year. I think just before the statement, this number was around 39 and this number was 40 something. And the impact at the moment, let me check the DXY. Not much, pretty minimal, I would say.
Yeah, and it's barely even. So on if you go watch tool on the vertical column, where it shows probabilities, click on probabilities on the left-hand side. So all the way over where it says target rate on the left, all the way left on the screen. Look at probabilities. It's like the third one down.
This one.
Yep. Okay. So that table will show you that for all the percentages, basically every meeting into the end of the year, it's a pause. Right. And then maybe, and those probabilities are very slim, even going into January 2027. I mean, you can see that the, pause versus cut pretty much neck and neck. It's like, I just think that there's just a big pause until maybe 1 cut into either December 2026 or January 2027. That's about as good as we're going to get right now. What changes this? Probably we have to see oil prices go down and inflation be, trending lower again, because it has not been doing that.
Yep. And is Warsh coming in soon?
I think
So
May.
as the new Fed?
He should step in officially in May. I don't know if there's still a Fed probe out for Powell. I've got breaking news here. They keep the rates the same. Fed projections imply 25 basis points of rate cuts in 2026, 25 basis points of cuts in 2027. I'm not seeing that a watch tool at this time, but this is what is coming directly from the statement. 7 policymakers show no cut. So 7 of the 12 seeing no cut in 2026. 1 sees rates higher in 2027. 4.4 unemployment rate at the end of 2026. Here's what I'm reading. So 4.4% unemployment rate at the end of 2026 compared to 4.4 December. That's the same. Policymakers see end of 2026 PCE inflation at 2.7 compared to 2.4. So they're expecting higher PCE.
Okay.
2.4% GDP growth compared to 2.3. So higher GDP.
Up.
Yep. Let's see here. Policy files. That's a rate statement here if you want to get the link. Fed maintains projections for 1 cut in 2026, 1 in 2027. Now it says 1 cut in 2026, but my question is what month? Because what I'm seeing right now is maybe December as far as like the probabilities, but it's not great. Anyway, we knew this was going to be a no cut, right? We knew it was going to be a pause. More importantly, I think as far as price action goes today, this is what I'm watching for price. This, shaded zone is my expected move based on the broker platform this morning and the market makers. So if the market stays efficient, then we would, hold above this 66.35 handle. If we have a big flat day, then the market essentially opened here and maybe it hangs out around that 6,700 zone today. If we come back and get back to where we closed yesterday, maybe 67.10 or so. What am I watching for? I'm looking to see if the markets, during the press conference, it's going to be statement from Powell, little Q&A.
Yep.
And, maybe that gives the market some reason to move, but essentially it's been nothing today. I think when we open, we're only seeing a plus minus of just a couple of points here. So we opened here. The market has moved 16 points out of an expected about 54 points, 55 points today. So there's still some volatility left. I'm not saying that the markets won't move, but I would imagine that the markets are going to be greater than 66.35 and most likely less than 67.71 because that was my gap adjusted high in the day. So let me see right now. Could I get some premium around this like 66.30 handle? I'm just curious. 66.30 for SPX. Maybe try to get like a 1-to-1 fill or better. 66.35. So if I did this.
So you're betting that the price will stay in the range, right?
I think it's going to stay range bound today.
Okay.
What is this trade right here that I have pending for today? 60. Just want to make sure I'm not. Is that a butterfly spread? Hang on.
Yeah, sure.
It's an iron fly. Okay, so that's still pending. Neither one are trading for my filled prices. I tried to get like a $500 risk going this morning. It doesn't look like that's going to take. I'm going to try this one. Let's go. I'll try this one for a 45 fill. This is $45 credit on a 50 wide iron fly. It's not even close to getting filled. I need to see price actually give us some movement. What I was going to say is the 30 to 35 handle. If I go 30 by 25, 10 wide, I'd be looking for something like this to maybe offer me. This is a 10 wide spread. If I could get, $5 today, $6 today for this trade, that would require price to drop. So if price falls to that expected move level and then bounces back up, if I could get out of a 10 wide spread, if I can get $5 to $6 credit, I'd take that as like a 1-to-1 or better and see if that level will hold. Because if it does, it's just a range trade for the day and I can make a few bucks there. In all for the day, I'm lined up to make, it's nothing crazy. I'm making like $50 today, but I have like, I don't know, $5,000 in profit traps. It's nowhere near it. I have, you can see this yellow box down below. I have a $2,500 profit trap down here, and price would have to fall through this level. I have a $2,000 profit trap up here. We'd have to have this insane rip. Most likely, neither one is going to happen today, but it's there if I need it. And then I'm trying to figure out if there's something I could put in for the remaining session, which we have an hour and 50 minutes until the close. So I'll just kind of hang in there and see what's going on.
Yeah.
Yep.
Well, most likely, as you mentioned, it's going to be a nothing burger and it's just going to be flat. Powell is soon to be out. I don't think he's going to disturb the markets too much. And anything that he says is not going to hold any weight.
Yeah, and he's not going to comment on anything Trump related. He's not going to comment on the current. He probably won't even comment on current situation on Iran. He'll just say, maybe we've noticed what he's probably going to be so by the book for this month and next month until he officially steps out as chair. I think he's the type of guy that's just going to take the high road and just keep it like very vanilla, and just set sail into I don't know what his legacy is. I thought he was fine. I mean, between Yellen and him, fine. I would say that it can't be easy to give 12 people this type of power and expect them to be right when they're never right. They're always reactive. They're always basically backstopping crises because we're using like Keynesian economics, which means that the markets are, participants are stupid and the market needs help. And so the government and the Fed are always going to step in and manipulate things. And that's essentially what we've been doing for the last 17 years since the great financial crisis. Yeah. So supply side economics, folks, that's what it is. And at some point it's like, does it ever fail? I mean, if it fails when our deficits run so hot that the market's like, there's no way this is sustainable. That's my biggest concern right now, is that we just want to run this economy so hot and we want to run our deficits so high that at some point it's like you're getting the law of diminishing returns, which is you just can't put, $5 of debt to $1 of growth and expect that to be a sustainable path. But markets don't seem to care because you kick the can down the road forever.
So let me ask you a question.
Okay.
The guys that have a prop firm here in my city, they love Trump. I mean, they hate him, but he makes them a lot of money.
Okay.
So they were praying that he gets reelected because they were basically trading off of his tweets back in 2016, 17, blah, blah, blah.
Okay.
Would you prefer a Fed chair that was more vocal, more, let's say, out there, move the markets more? Or would you like another Powell who's not going to comment on anything and pretty much it's going to be a nothing burger when he has a speech?
Well, I mean, Powell's never been a nothing burger because he's had to navigate some pretty wild stuff the last 4, 5, 6 years, right?
But
so it's not a nothing burger. But I would say what I do have concern with right now is that the Fed independence is in jeopardy because I do think that Warsh has a history with the Trump family. He knows Scott Bessent. And so I think there's a loyalist aspect to Warsh that the markets don't really love. And so you go back and say, like, well, he was a hawk during the great financial crisis, right? But he's a loyalist today. And so I don't think it was by accident that they hired somebody or they brought in somebody like him. But I also don't think that he's going to automatically come in and make the Fed just completely align with the current government. I mean, the Fed is still trying to exist on mandates of stable markets, liquidity. And right now, the one thing that is happening is this private credit crunch, this private credit market with the Blue Owls, Tricolores, some of these bankruptcies that are happening that will continue to happen. But I do think that the mechanisms and the levers that we have in the financial markets are enough to absorb it. I'm not seeing, if you look at it'd be HYG. Is it getting out of hand? Not really. It's certainly disturbed. I mean, we're going down. That's not a good sign. That's a sign of stress. I mean, this was when we went down during Liberation Day. That's a huge drop. It drops a little, but it's stabilizing. So it's like you just don't want to see HYG going lower. You want to look at LQD. Same thing for investment grade. How disrupted is this? Same type of thing. It's like this rate of change stuff is not a good sign, but it is stabilizing. So I keep an eye on that stuff. I mean, and the hard part is you see this, it's like, do you actually start making decisions based on this right now and say that, I mean, here's another thing. When's the last time that we talked about the 10-year and the 2-year inverted yield curve? Nick and I talked about it a lot, like a couple of years ago, and it's like, it just hasn't mattered. So if we go US 10-year, and I have here
I look at it from time to time, but I don't place a lot of importance on it, if I'm being honest.
Well, so I found it. I mean, this is something I never looked at, but we were paying a lot of attention to this when we went from the longest inversion in history and one of the deepest inversions in history. And what was always brought up is it's not when it inverts, but it's when it disinverts. That's when you need to have that we're on borrowed time. The recession is coming, blah, 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 blah. Here's when it really matters. If we see the 10 and the 2-year blow out to about 200 basis points or more, get concerned, because it's this disinversion or this disinversion when it blows out by 200 basis points. That's when the bad stuff is happening. And so this has been so steady for so many months where it's like, yes, we are slowly grinding higher, but unless this thing gets rate of change that's when I'd be really, really concerned. I'm not going to say like I'm not aware of this. It's like I don't want to be blindsided by anything. Nobody wants to be blindsided by the market doing something you don't expect. But I'm not really overly concerned until we're probably creeping up to like 100 basis points, because right now we're at 0.52. This has to be at like 2.5 or 3 for me to say there's a crisis coming or crisis is already happening. I just don't think we're there yet. So there's still, like I said, since great financial crisis, there's a lot of stuff that the markets can pull out. There's a lot of tools in the toolkit. There's a lot of, tricks up their sleeve, and, call it creative accounting or whatever you want, but it's like, it works. And we have avoided recessions. We've avoided crises for a long time now. And I know at some point it doesn't matter, and it'll eventually correct, and the markets will always do what the markets do. But I think right now it's like, I just can't be a perma bear, because I think it gets clicks and sells, newsletters and headlines, but it doesn't make you a better trader.
Yeah, I absolutely agree. I just wanted to correct myself. It's not that Powell was a nothing burger chairman. It's that he was pretty tough to read and kind of a flat response on everything.
Yeah, agree.
So, the question was more, would you like a Trump-style Fed chairman where he says anything that's on his mind?
No. It's bad enough having a president. I don't want to have it be the president and the Fed and like all the major influencers are like, they just say whatever they want whenever they want. The market is just head faked all the time. It's like, that's so difficult to trade. It really is. But like your prop firm buddies might love it.
They absolutely do, because they trade for like a couple of minutes in and out, and that's about it.
Okay.
So they absolutely love Trump. I'm not sure if they love him again, but in 2016, 17, and 18, Trump was their favorite guy.
Yeah.
So I wanted to get your take on gold. I saw a lot of comments. People want to see gold.
Okay.
It's doing some weird stuff. It's risk off, conflict, should be going up, but it's actually selling off.
Yep.
So what is your take on it?
To me, the sell-off is purely technical.
Okay.
So I said this. I mean, I would even say, even going into late last year, I was like, look, I can't justify buying gold. And even when it was at $4,200, $4,300, when we had this first correction, I did buy gold on that pullback because we finally got one. And then once we ripped to these crazy all-time highs, here's my technical stance. We were 30% away from the 200-day moving average. I've never seen that in the history of the gold charts. We also were 600 plus bars away, which has happened one other time in history. And that was in 2009, 2011, when we had like a 600 bar run, when gold has stretched away from the 200-day moving average. And then it just spent months gravitating back towards it. So you can see here, I put this on months ago, but this is end of March, gold showing signs of correction towards the 200-day moving average, which is right here. So if we get to the same low, or we get to this 200-day moving average, I am kind of patiently waiting for this to play out to the downside. And I don't love that it's, I'll say this. I hope that I'm right and that this level offers a good chance to buy, because I would be long gold into the next 1, 2, 3, 5 years. I would sit on a drawdown if it goes, high, low, lower, high, lower, low. I'd sit on that symmetry and take this thing for the next 5 years. If I have to hold on to it, I will. I think I'm going to try to get my allocation back up to 10 to 20% of my portfolio sitting in gold. Okay. I'll have cash on the sidelines, then I have my equity exposure as well. But I think technically that's why I think gold is correcting. I'm not bearish on this. I'm just kind of patiently waiting to see, do we get some opportunities to buy at reasonable bargain prices, maybe 20, 30% off these all-time highs, and then load back up in a percentage allocation. That's my thought.
And what's your take on gold no longer being the safe haven it is, but being more of a meme coin like Bitcoin, with the recent explosion in price in 25 and what we saw in 26 as well?
I don't really subscribe to that. I think that I think gold is. I said this maybe a few weeks ago. There are a lot of things right now that if you believe in geopolitical uncertainty, if you believe in fear, if you believe in the fiat system is kind of run its course and played all of its cards, and everyone knows that ultimately this market's going to try to do something into more physical store of value. I think a lot of signs point to just owning gold. And we're seeing more ownership in the futures market. We're seeing less and less. I mean, the paper trading side, the derivative side of gold and silver, it's like 300 to 400 to 1 as far as like what's actually physically available to what's trading in the markets. Yeah. And now that we're seeing JP Morgan, Citibank, some of these major US players are actually wanting physical delivery of futures contracts. There's the physical switch of it is now like net long gold and net long silver for big central banks, and it's not just the U.S. but it's also global. And I think that the U.S. has had a great run, and I'm thinking that the U.S. is not going to go down without a fight. But I think the world is going to want something different than fiat, and I think a lot of things point to just like long-term gold. So I don't think gold is a meme. I think that gold got a little speculative. I think it got really mania heavy, and the retail crowd is really what blew this thing out. But know this, Marco, like when the retail crowd started to jump in, they were so late to the party here. This thing has been a 3 to 4 year bull market, and they came in right here. Right. And so they jump in, and what did the futures exchanges do? They increased margin 3 times in about 45 days. And so that shook out all the leverage. And that's why I think you had this disruptive move. And now you have big no leverage funds and no leverage banks that are just dollar cost averaging in, and they're just going to own it forever. That's
if you looked at the Wall Street Bets website, gold and silver were absolutely trending like number one at the end of 25 and beginning of 26. So retail piled in massively right at the end, and of course they got squeezed out with the sell-off.
Well, the day this is crazy. I think that literally the day of this top was when GLD had enough option volume that it matched the SPY. Whoa, that's never happened. It was like that was the type of crazy volume that this market had, and that literally was like that was like the top or pretty much very close to it.
Yep. I totally agree with you. I think gold is a buy. Maybe not here, but on a bit of a pullback. And my game plan is to just buy it as well. I think China is going to continue buying. I think most banks and most funds are underexposed to gold. I think they have been sleeping on gold for the last few years, and now they're starting to catch up, and it's just gonna go up.
I don't
correct more, but
I don't disagree. I think it's a very safe, like, set it and forget it trade. I wouldn't put all my dollars into gold. I mean, honestly, so the next layer of this investment is, well, if I paper trade gold, should I just get the physical side of gold? Should I go buy Costco gold bars? That's a whole different market. And if you want to do stuff like that, there's a website. I listen to the guy all the time. I think his name is Adam Sheckman, Andy Sheckman. But it's Miles Franklin, and they do all sorts of physical silver and gold deliveries. They can within like $1 above or $1 below spot price. They can essentially fulfill. They'll buy all your gold and silver pretty much at market price. They will do the physical deliveries as well. They'll send you the FedEx packages to send in things or receive delivery. Anyway, there's the whole new market of like physical side of gold and silver. I trade gold futures. I trade GLD. I trade the CFDs. And so I have a paper trading element to my portfolio, but I want the physical side as well for something totally different that has nothing to do with the spot price. I'm not doing physical silver, physical gold for anything about the spot prices. That's more like I just want to own it. But I think technically speaking, if we fall to 4,600 or 4,400 or down here to that 200-day at 4,200, I would love loading up to get my allocation back where I want it to be. I think that we could probably ultimately end up at 7,500 to 10,000. I don't care if it takes 5 years or 10 years. It's like I think it's still a good investment. But if, like I said, if you're long fear, if you're thinking that governments will continue to print and devalue their currencies and debase their currencies globally,
which they will.
They will. I think that's a very high probability bet. I think gold reflects that. So yeah, I think gold is a pretty good play. It's just be patient, because clearly if you get into the wrong time or you use margin and leverage, you can get burned very, very quickly. I'm sure there's a lot of traders that got in for all the right reasons and just overextended their margin, got over their skis, and all of a sudden they got beat up with the leverage changing on them. So you got to trade what you can. You got to know the rules you trade. And that's trading. If it was always easy, then everyone would just be, multimillionaires and making this easy peasy. But crazy stuff, man. Gold, silver, and oil, 3 big stories for the last, 4, 5, 6 months. And it's not going to stop. Bitcoin at some point would be another story. Quick question on Bitcoin. What do you think? Do you like Bitcoin? Do you not like Bitcoin? What do you think? What's your outlook right now?
Super interesting. If I bring Bitcoin on the chart here, so Bitcoin has been acting as a bit of a sort of a hedge to the whole conflict, because we went up right on the 2nd of March as we opened, corrected, and then went up again. So pretty strange price action, because Bitcoin is supposed to be this massive riskiest investment you can have in the financial markets, let's say. And it going up is pretty weird. It's telling me two things. It's telling me first that there's very little sellers in this market, because the price just cannot go below this floor, I would say. And second thing, the reason that I saw from some of the experts on the topic, the reason why you may see buying in Bitcoin is money is trying to move away out of the Middle East because of the conflict, of course. And the easiest way to do it is to just bring a USB. You can't really bring out cash. It's super tough to bring gold bars, but what's super easy is to bring crypto on a USB or some sort of another form. So that could be one more fundamental reason why there is Bitcoin buying during the conflict. Personally, Edgefinder is giving it a bullish reading, if I remember correctly. So that's nice. I would like to buy, but I would first wait for a breakout out of this range. I think we are in a clear overall range. We're trying to break out higher, but we cannot commit. We cannot get a daily candle close above the resistance level. If we do get it, I'll be interested to try and take a stab at it. I think Nick has the same opinion, which he mentioned on his stream. So also one more negative thing, we have the 4-year cycle of Bitcoin, the halving cycle.
Yep.
And we are now in the bearish part of the halving cycle, supposedly.
Right.
The bullish part comes in November. So
of this year? Is it November 2026?
Yeah,
okay.
November 26.
Gotcha.
I have the chart somewhere on the PC, but I lost it.
Okay.
I don't know where it is.
From a technical side, I think that I'd be surprised to see all-time highs on Bitcoin anytime soon, even after the halving cycle is done. Technically speaking, here's one thing I'm pulling from. This was an 80+% pullback. This was an 80% pullback. My concern is that even though this is up to $120,000 and it's been more, financialized and institutionalized with BlackRock and Fidelity and all these big players in the game, and unless we're going to go into, this beta was, let's say 10 compared to the S&P. If the beta is now a 2, I don't think that people can expect like 100% upside a year on Bitcoin or 45% upside. I think it's like, we're probably in the realm of maybe Bitcoin's capable of like plus or minus 30% a year, plus or minus, right?
The lottery ticket factor is done.
I agree. So here's what I think makes this interesting is, this 80% correction, this 80% correction, if we see another 80% correction, it's not going to be fun, but I do think that this offers another very, very solid trade for, it's just a trade. If I was going to buy and hold Bitcoin through this, my stop loss is 0, right? Okay, so if it goes to 0, I'm willing to risk that. And my highs would be, what's my X return? If I buy this thing, let's say at 40K and it goes up to 130, that's going to be roughly a, 3 to 3.5 times return. I will take that as a trader all the time. But when it gets to 130, 140, does that mean that I get out of everything? Maybe I just keep some skin in the game, keep it as an allocation, and I keep it as risk capital, like it's always been for me since 2017 when I started trading it. It's never been all in Bitcoin. I've done okay. I've done pretty well with Bitcoin over the years, but as I started incorporating it into client accounts, it is an allocation, and that's all it is. I can't go all in Bitcoin. I don't know if it has a permanent future that's going to be safe and unhackable and it's the greatest asset ever. I don't know. But as a trade, it's like, look, if I can put 5% into Bitcoin and it can turn into, 5, 10, 20% of my portfolio and gain, that's a great trade. But if it's 5% allocation that I lose, I'm going to survive and still keep trading. But that's just me. So, from the technical side, if we go high, low, the one concern I have technically is right here. This little high to low pullback towards that 100K handle. I could see this happening, Marco, where the market falls to 60, goes back up towards 100, forms a beautiful little flat pattern there, and then sells back off to symmetry. And that's how I'm getting that like 40 to 30K projection. Yeah. So I think as a big picture buyer, it's going to be 40 to 30,000 to then go to all-time highs. As a near-term buyer, maybe you get a run back to like 90 to 100. I would be taking some profit. I'd be reducing exposure. If you feel like you got over your skis on Bitcoin, I'd trim that trim that back, or I'd sell more premium. I would do something where it's just like try to reduce the exposure, take some profits along the way, because I don't think that the lows are necessarily in at 60K, but that's just me. So, all right, we have a Fed conference going. I've seen a couple comments there. James, are we pulling up the stream? Are we going to pull up like Powell's press conference? I'm just curious.
I can pull it up. I have it prepared here.
Okay.
But I'm just not sure if the sound will go through. So we're going to have to give that a try.
Okay, let's see if the sound goes through. If not, then again, let's look at Financial News Juice, and they do a pretty good job of pulling some of his highlights and anecdotes. Okay. The man, the myth, the legend. What can we do to get a little audio there? James, can you grab the screen as like a additional host and see if we can push audio? It's going to be, I'm sure his statement's going to be very plain.
Today, the FOMC decided to leave our policy rate unchanged. We see the current stance of monetary policy as appropriate to promote progress toward our maximum employment and 2% inflation goals. The implications of developments in the Middle East for the U.S. economy are uncertain. We will remain attentive to risks to both sides of our dual mandate. And I'll have more to say about monetary policy after briefly reviewing economic developments. Available indicators suggest that economic activity has been expanding at a solid pace. Consumer spending has been resilient, and business fixed investment has continued to expand. In contrast, activity in the housing sector has remained weak. In our summary of economic projections, the median participant projects that real GDP will rise 2.4% this year and 2.3% next year, somewhat stronger than projected in December. In the labor market, the unemployment rate was 4.4% in February and has changed little since late last summer. Job gains have remained low. A good part of the slowing in the pace of job growth over the past year reflects a decline in the growth of the labor force due to lower immigration and labor force participation, though labor demand has clearly softened as well. Other indicators, including job openings, layoffs, hiring, and nominal wage growth, generally show little change in recent months. In our SEP, the median projection of the unemployment rate is 4.4% at the end of this year and edges down thereafter. Inflation has eased significantly from its highs in mid-2022, but remains somewhat elevated relative to our 2% longer run goal. Estimates based on the Consumer Price Index and other data indicate that total PCE prices rose 2.8% over the 12 months ending in February, and that excluding the volatile food and energy categories, core PCE
100 plus cryptos, countless stocks and ETFs, and options. eToro has
reflect inflation in the goods sector, which has been boosted by the effects of tariffs. Near-term measures of inflation expectations have risen in recent weeks, likely reflecting the substantial rise in oil prices caused by the supply disruptions in the Middle East. Most measures of longer-term expectations remain consistent with our 2% inflation goal. The median projection in the SEP for total PCE inflation this year is 2.7% and 2.2% next year, a bit higher than projected in December. Our monetary policy actions are guided by our dual mandate to promote maximum employment and stable prices for the American people. At today's meeting, the committee decided to maintain the target range for the federal funds rate at 3.5% to 3.75%. From last September through December, we lowered our policy rate 0.75 percentage point, bringing it within a range of plausible estimates of neutral. This normalization of our policy stance should continue to help stabilize the labor market while allowing inflation to resume its downward trend toward 2%. But the implications of events in the Middle East for the U.S. economy are uncertain. In the near term, higher energy prices will push up overall inflation, but it is too soon to know the scope and duration of the potential effects on the economy. We will continue to monitor the risks to both sides of our mandate. We are well positioned to determine the extent and timing of additional adjustments to our policy rate based on the incoming data, the evolving outlook, and the balance of risks. In our SEP, FOMC participants wrote down their individual assessments of an appropriate path of the federal funds rate under what each participant judges to be the most likely scenario for the economy. The median participant projects that the appropriate level of the federal funds rate will be 3.4% at the end of this year and 3.1% at the end of next year, unchanged from December. As is always the case, these individual forecasts are subject to uncertainty, and they are not a committee plan or decision. Monetary policy is not on a preset course, and we'll make our decisions on a meeting-by-meeting basis. To conclude, the Fed has been assigned two goals for monetary policy: maximum employment and stable prices. We remain committed to supporting maximum employment, bringing inflation sustainably to our 2% goal, and keeping longer-term inflation expectations well anchored. Our success in delivering on these goals matters to all Americans. We at the Fed will continue to do our jobs with objectivity, integrity, and a deep commitment to serve the American people. Thank you, and I look forward to your questions.
Thank you. Colby Smith of the New York Times. There's been some debate about whether the Fed should look through the inflation that will come from higher oil prices stemming from the Middle East conflict. Is that the right approach at this juncture? And to what extent does the fact that inflation has been above target for roughly 5 years now influence the committee's thinking around this?
So, first, let me say we're well aware of the performance of inflation over the last few years and how a series of shocks have interrupted progress that we've made over time. And that happened most recently with tariffs, and now there will be some effects on inflation coming forward. The thing that's really important that we see this year is progress on inflation through a reduction in goods inflation as the one-time effects on prices of tariffs go through the system, go through the economy. That's the main thing we're looking for going into this exercise. And we need to be seeing that to sort of understand that we actually are making progress, because on net, we didn't make progress. And if you look at total core inflation, it's about 3%. And some big chunk of that, between 1/2 and 3/4, is actually tariffs. So we're looking for progress on that. The question of whether we look through the energy inflation doesn't really arise until we have kind of checked that box. It, of course, is kind of standard learning that you look through energy shocks, but that's always been dependent on inflation expectations remaining well anchored. And I think now it's also dependent on what you mentioned, which is that broader context of 5 years now of inflation above target. We have to keep all of those things in mind. And the question of looking through when it does arise will be one to approach not lightly, but in the context that you mentioned.
And just on the SEP, can you help us make sense of why there is still a bias to cut for most officials this year, despite the upward revision to headline and core inflation and the essentially unchanged forecast for growth and unemployment? Just curious, kind of what's the genesis behind the need? What's the need for the cut?
Yeah, so there are 19 people, and so 19 reasons, 19 individual submissions. And if you notice, the median didn't change, but there was actually some movement toward a meaningful amount of movement toward fewer cuts by people. So 4 or 5 people went from 2 to 1, let's say, 2 cuts to 1 cut. And each person has individual, stories behind what they want to do. But essentially, it is that the forecast is that we will be making progress on inflation. Not as much as we had hoped, but some progress on inflation. It should come as we start to see in the middle of the year progress on tariffs. Going through once and then tariff inflation coming down. We should be seeing that. And the rate forecast is conditional on the performance of the economy. So if we don't see that progress, then you won't see the rate cut.
Howard.
Thank you. Howard Schneider with Reuters. Just to follow up a little bit and to be clear, is the higher inflation penciled in here for 2026 solely the result of the oil shock or something else?
So that's going to be part of it. But, that wouldn't be most of core, right? So the oil shock for sure shows up here. Some of that will be in core as well. But yes, but no, there's also just the feeling that we haven't seen, the progress that we had hoped for on core goods. And on tariffs and on the rest of it, so for whatever reason, people did write up their inflation forecast. That will certainly be tied to events in the Middle East and the price of oil. But it's also, I think, a reflection of the slow progress we've seen on tariffs, which we believe we will see. It's just a question of how long it takes for them to get all the way through the economy, and it just takes some time.
Right. And is the lack of change in the SEPs, again, just to explicate this a little bit, more due to the expectation that the oil portion of this will pass through, or more out of concern that there is a potential blow to consumption and growth coming in the form of wealth effects with the stock market down, in the form of gas prices, diverting spending from other parts of the economy?
So I didn't get the second part of your question.
That consumers are going to be potentially diverting money to gasoline from other parts of the economy. There could be a growth shock or a redistribution of spending there that can hit consumption, wealth effects as well. I guess I'm wondering, is the rate forecast not changing because you think the oil shock is going to be temporary, or because you want to be sure you're positioned in case growth starts to slow?
So the thing I really want to emphasize is that nobody knows. The economics effect could be bigger, they could be smaller, they could be much smaller or much bigger. We just don't know. So people are writing down something that seems to make sense to them, but have no conviction that to your point, if we have if we have a long period of much higher gas prices, that's going to weigh on consumption. Now, it'll weigh on disposable personal income, and it'll weigh on consumption. But we don't know if that's going to happen. It's something quite different than that. We might have much lower than expected pass through. So people write down, this is one of those SEPs where a number of people mentioned if we were ever going to skip an SEP, this would be a good one, because we just don't know. So I wouldn't say there's a conviction that this is going to go through quickly or not quickly. It's just, you got to write something down, and this is something that is that people wrote down. We don't debate how long. How do you do that? We wouldn't be able to debate what the length of or size of these effects would be. We just have to kind of make an individual statement. And also, what you've written down before you'll be reluctant to move too far away from that, just because you don't know. It's so unclear what the direction from this particular end will be. Meanwhile, the growth has been solid, and inflation, the overshoot is mainly from the goods and tariffs. And, the labor market is, the unemployment rate, of course, is little changed since September. You have a very, very low break-even rate, apparently, for new jobs, with little growth in either demand or supply. But the U.S. economy is doing pretty well. It's just we don't know what the effects of this will be, and really no one does.
Steve.
Mr. Chair, in the past, the staff has suggested that higher oil prices, they have a hit to consumption, which Howard was talking about, but that's somewhat offset by increase to domestic production. I wonder if you could talk about that dynamic, especially to the extent that how much U.S. production is happening right now.
So the first thing is, there is, the original thinking, the long-standing thinking, put it that way, is that you do look through energy shocks. But as I mentioned, that's conditioned on inflation expectations and that kind of thing. So, sorry, your question was?
What the staff is saying about, and has said in the past.
Yeah.
About
so there'll be an offset.
Offsets, yeah.
So that's true. We have, we're a net exporter of energy, right? So any effects on employment and economic activity and spending would be offset to some extent by the fact that our oil companies will be more profitable and they may even do more drilling. If you ask oil companies about doing more drilling, though, they're going to want to see, a consistent rise in oil prices from where they were before the buildup for the war, and they're going to want to believe that that's going to be persistent for a fairly long time. So they're not sitting there waiting for oil to go over $70 a barrel, and then they're going to start drilling or whatever. They're going to make a reasoned, careful judgment that we're going to have higher oil prices for an extended period, meaningfully higher. So I wouldn't say there's much of that happening, not much of it happening now, but some of that could happen over time if you see that. But so the net of the oil shock will still be some downward pressure on spending and employment and upward pressure on inflation, of course.
And if I could just follow up on Colby's question, how much do you worry that having looked through tariff inflation and inflation running above target and looking through the oil price shock would undermine the credibility of your commitment to the 2% target?
We have to do our analysis and think these things through carefully. But of course, that's on everyone's mind. We're well aware of the history, but you don't want to overreact to that. You want to make the best judgment you can based on the facts. I don't think we're going to let it color our decision making more than is appropriate. It's more of the thought that it's been 5 years, and we've actually had we had the tariff shock, we had the pandemic, and now we have an energy shock of some size and duration. We don't know what that's going to be, actually. And it's one of those things where it's a repeated set of things, and you worry that that's the kind of thing that can cause trouble for inflation expectations, and so we worry a lot about that, and we are very strongly committed to doing what it takes to keep inflation expectations anchored at 2%. And I think it's important that we do that. Very important.
Nick. Nick Timoros, The Wall Street Journal. Chair Powell, you've described monetary policy as modestly restrictive. If the unemployment rate is roughly stable, inflation moving sideways in the high twos, with an ongoing overshoot in services and non-housing services, not just goods, and the economy doing fairly well as you just outlined, what gives you confidence that inflation returns to target over the next couple of years?
Okay, so I would say the rate is, you can characterize it as in the high end of neutral, or you can characterize it as perhaps mildly restrictive, even modestly restrictive. No one knows for sure, but it's in that range where it's somewhere around the borderline between restrictive and not. Remember that a big part of the disinflation we're looking for is just the runoff of when tariffs are put into place. Of course, what they do is they raise prices to some extent, to the extent those prices the tariffs are paid by consumers on a one-time basis. And we're waiting for that process. It takes 8, 9, 10, 11 months, a year to go through the system. And we're waiting for the tariffs, which were put in place over the course of the middle part and later last year. We're waiting for that to go through the system so that goods inflation will return closer to what it's always been. I mean, it used to be, for many, many years, it was negative. And then, the year before tariffs came in, it was 0. And it's running at like 2% now. So, and so that's kind of, goods inflation is running at 2%. So that's not coming from standard Phillips curve restrictive policy. It's coming from the runoff of a one-time thing. We also think it's important, though, to keep policy either mildly restrictive or close to that, but not too restrictive because of the weakness in the downside risk in the labor market. We are balancing these two goals in a situation where the risks to the labor market are to the downside, which would call for lower rates, and the risks to inflation are to the upside, which would call for higher rates or not cutting anyway. So we're in a difficult situation, and we feel like our framework calls on us to balance the risks, and we feel like where we are now is just kind of on that borderline, the the higher borderline of restrictive versus not restrictive, we feel like that's the right place to be.
Can I ask about core non-housing services, though? Because there are some people who think that it hasn't come down very much, if at all, over the past year. If wage growth has come down, if the labor market has loosened, why has non-housing services inflation maybe been slower to follow?
That's a good question. It's frustrating. Labor non-housing services they basically moved sideways for a year. They're at the same level, and we do expect that they will come down. But it's a bunch of idiosyncratic things. But at the same time, that is one of the things we should be seeing, because to your point, the labor market is clearly not a source of inflationary pressures, and that should really matter for non-housing services, but we're not seeing progress there. So we do, what we expect for next year is what we want to see for this year, rather, is continued progress on housing services, finally seeing that, the goods inflation come back down because the one-time effects of tariffs are through, and then also get some help from non-housing services. That's what we'd like to see. But it's a good question why we didn't see much of that last year.
Edward. Thanks, Chappelle. Edward Lawrence with Fox Business. So in December, we saw employment numbers revised down to negative 17,000. January revised down. February posted a loss of 92,000. Is the employment side a far greater risk than the inflation side? Because we are seeing inflation, CPI is close to 2%. PCE has ticked down overall.
It's really, I wouldn't say that. I wouldn't say that that's clear at all, that one is more at risk than the other. So you can point to the unemployment rate being stable, and in a world where both supply and demand for workers have come down very, very sharply over the course of the past year due to immigration policy largely, a ratio is going to be a better thing to look at than job creation, for example. So, and the ratio is the unemployment rate, and it's been stable since September. So that tells you that. Inflation, you can. We're at 3.0% core. Inflation 2.8% headline. So we've been well above the 2%, that amount, whatever it is, 0.7, 0.8, or a full percentage point above 2% for some time. And that's a concern. We need to get back down to 2%, and we need to keep focused on that, even though we do now face some new inflation from energy. So I'd be hard pressed to say that one of them is.
If there's no Federal Reserve chairman confirmed on May 15th, would you stay on?
So if my successor is not confirmed by the end of my term as chair, I would serve as chair pro tem until he is confirmed. That is what the law calls for. That's what we've done on several occasions, including involving me, and it's what we're going to do in this situation. And while I'm at it, on the question whether I will leave while the investigation is ongoing, I have no intention of leaving the board until the investigation is well and truly over, with transparency and finality. And I would refer you to the statement that was in the Fed's brief that you all have seen, and I won't have anything more for you on that. On the question of whether I will then continue to serve as a governor after my term ends and after the investigation is over, I have not made that decision yet. And I will make that decision based on what I think is best for the institution and for the people we serve. Figuring you probably were going to set the dominoes off there, Edward. And I'm not going to have any more to say on those issues, by the way.
Thank you very much. Claire Jones from the Financial Times. People have drawn quite a few historical parallels with the current situation. We've seen oil price shocks in the past. Some people have said the first Gulf War and the Fed's response to that, where there was a focus on the growth risks, is the right parallel. To what extent would you agree with that, and to what extent do you think we're in a different place today? Thank you.
It's really hard to say until we see the situation, the actual situation. In some circumstances, that might be the right case. In fact, for example, if we do see the kinds of disinflationary progress that we expect to see due to tariffs that I mentioned, I think it's hard to say, and it will depend to some extent on the size and duration of the effects we're seeing on prices, and it will depend a lot on what we can see in inflation expectations.
And just one follow-up, if I may, just on the BLS report that was mentioned briefly there. It doesn't seem from the projections or from the comments you've made today about the unemployment rate and focusing on that your view on the labour market story, to a large part being a supply side story, has changed despite the quite negative number in February. Would that be the right take? And was there anyone else in the room who thought differently and that the February jobs report was cause for concern?
So I think you have to take the two together. You know, in a way, the January report was a positive surprise, and the February report was a negative surprise. If you put them together, you get something in the middle, and I think you have to really, as you do, I'm sure, realize there was a strike and there was weather, and that's about 80,000 of the negative effect total on the February report. Notwithstanding that, so what do you see if you take a step back overall? There are a number of indicators that suggest a degree of stability, but the thing that I think good number of people on the committee are concerned about is just the very, very low level of job creation. If you adjust what has been the trend job creation over the past, let's say, 6 months, if you adjust that for what we think, our staff thinks, is the overstatement due to overcounting, effectively there's zero net job creation in the private sector. But actually that looks like that's about what the economy needs in terms of dealing with very, very low, non-existent really growth in the labor force, which of course we've never had in our history. So you've got a sort of a zero employment growth equilibrium. Now that's balance, okay, but I would say it does have a feel of downside risk, and it's not kind of a really comfortable balance. So we look at that, we see it, we get it, and I mean everybody understands the arithmetic, and that's you can say the break even is zero, but nonetheless it's something we're watching carefully, and are concerned about. But ultimately, though, you can argue that it's a consequence of deliberate policy, which is really the changes to immigration. That's the biggest factor there, and but nonetheless, something we watch carefully.
Andrew.
Thanks, Chair Powell. The economy's experienced a series of supply shocks in the last few years, COVID, tariffs, 2 oil price shocks. Do you think that is bad luck, or has something changed in the world that makes supply shocks more common? And does the central bank need to start taking account of the risk of supply shocks as a more common problem?
We did go through a long period where the shocks were all demand shocks, and so we've had a lot of practice thinking about supply shocks in the last 4 or 5 years for sure. And it's just a very different thing, and a very much more difficult thing, because it does immediately raise the question of tension between the two parts of our mandate. But, has the world changed? I mean, COVID is a one-time thing, right? This energy supply shock is a one-time thing. It's not because of some broad tendency or anything, I don't think. And the oil shock with Ukraine was also a consequence of military action. So I don't know that the world has changed in a way that there'll be more supply shocks. But there's people have written that paper and that speech a number of times. A number of people have tried to make the case that is the case. And in fact, we have seen more supply shocks in the last 5 years than we've seen in many years before that. It's a fact.
Okay. You said last year that the Fed was reviewing its communication strategies, including the SEP, as part of its framework review. Whatever happened to that? And I have like 5 follow-ups to that, but I guess, what would you change about Fed communications if you had the time? Thanks.
What happened about that was not much, and I'll tell you why. So, we looked carefully at many aspects of the SEP and of our communications, and there weren't any ideas that had very broad support on the committee. And you don't want to make a change to your communications unless you have the committee behind that. So we didn't really make any changes on that. I had hoped that they had some things that I wanted to do, but they didn't attract broad support, and we'd already made all the changes we made to the framework. That was a critical thing. So we didn't. And I wish we had been able to do some things, but we didn't. So maybe the next chair will take a look. I'm sure he will.
Michael McKee from Bloomberg Television and Radio. The minutes show in January, some members of the committee wanted to include a two-sided guidance on policy. Was that discussed today? And given the rise in the inflation expectations, how much support for a two-sided policy warning would there be?
So it did come up today. The policy that the possibility rather that our next move might be an increase did come up at the meeting, as it did at the last meeting. The vast majority of participants don't see that as their base case, and of course we don't take things off the table. But you correctly characterized, what was in the minutes that several participants indicated, and something very much like that conversation did happen. What was your second question, though?
I was just one question there, but follow up would be. There are a lot of goods besides oil that are trapped in the strait right now, and a lot of supply chains getting snarled. How much concern do you have about whether, if this becomes an inflation problem beyond just oil, whether there's anything you can do about it or would do about it, given the efficacies of monetary policy?
You can worry about other commodities. You can worry about all of the ways that oil-related commodities go into manufacturing and that kind of thing. The truth is it's completely out of our hands, and we just, like everybody else, we have to just wait and see what happens. And it'll come down to how long, the current situation lasts, and then what are the effects on prices, and then how do consumers react and that kind of thing. Really, I wouldn't speculate in any way, and there's really not a lot we can do other than kind of watch and see.
Maria Luisa. Afternoon, Chair Powell. Maria Luisa Capurro with Bloomberg News. I wanted to ask you, you've said longer-term measures of inflation expectations reflect confidence that the Fed will get back to its 2% goal, but there are some colleagues of yours who have pointed to higher dispersion in household service, in business service as well. So, and that they take as a signal that inflation expectations may be less sticky than in the past. I'm wondering if there was a discussion around that at this meeting across the committee, and what were the views of what is the state of inflation expectations and the risks from higher oil and gas prices.
So at this meeting, I mean, a number of people mentioned and staff briefed on short-term expectations having moved up quite a lot for reasons we understand well. But long-term expectations, you can always find one that's troubling or some aspect of one that's troubling, but ultimately right through this whole period, the overwhelming majority of the things we look to, including markets, including surveys of the public and also of forecasters, they've all been pretty solid on longer term inflation expectations being right where they need to be, consistent with 2%. So that continues to be the case. We didn't have a lot of conversation about that. I think everyone does agree that we'll be watching those extremely carefully as we see the effects of the price increases come through from the conflict.
And still on how the discussion went across the committee, before coming to this meeting, there were some members who were discussing the risks of a slowdown in growth and at a time of where inflation remains high. It really doesn't seem that most members are penciling in a slowdown in growth.
No.
But has there been any discussion of the risks of stagflation at this point?
So people actually wrote up their growth forecast by a tenth, and I think that's probably to do with just growing confidence in productivity. But sorry, and your second question was just.
If there have been any discussions about the risk of stagflation scenario.
Yeah, so as I mentioned, there's tension between the two goals, right? The upward risk for inflation and downward risk for employment. So, and that puts us in a different situation. When we use the term stagflation, I always have to point out that was a 1970s term at a time when unemployment was in double figures and inflation was really high and the misery index was super high. Add them together, you get the misery index. And that's not the case right now. We actually have unemployment really close to longer run normal. And we have inflation that's, 1 percentage point above that. So calling that stagflation, it's not, I would reserve the term stagflation stagflation for, a much more serious set of circumstances. That is not the situation we're in. What we have is some tension between the goals, and we're trying to manage our way through it. It's a very difficult situation, but it's nothing like what they faced in the 1970s, and I reserve stagflation for that, the word for that period. Maybe that's just me.
Elizabeth. Thanks so much. Elizabeth Schulze with ABC News. President Trump says that oil prices and overall inflation will go down very rapidly as soon as the war ends. Do you agree with that?
I don't have a forecast on that.
When we're thinking about the impact on American households, as you know, they've been facing these higher prices for years. They've seen an almost $1 increase in gas. How worried are you about households, especially lower income families, being able to afford those price hikes? And should people be bracing for higher costs, including for food now?
We don't know how big these effects are going to be, and I don't want to characterize them in any way. Of course, people are already seeing gas prices. Gas prices are up almost $1 a gallon. We hope that isn't for a long period of time, and of course, people will feel that. But I don't want to speculate about what that might mean, because honestly, that would sound like I have some idea of what's actually going to happen, and I don't think anybody really does. We're going to see how this works out, and I just would leave it at that.
Victoria.
Hi, Victoria Guido with Politico. I just wanted to ask, for purposes of the next meeting, how the Middle East war develops between now and then, how are you thinking about what might guide action at your next meeting? I mean, if we have oil prices, above $100 a barrel the entire time until the next meeting, is that going to change your wait and see stance? Like, what would lead you all to move, or are you on hold pretty indefinitely?
We'll have to wait and see. I mean, we always say we're going to learn more by the next meeting, and usually we do. But in this case, we're going to learn a lot, because we're going to learn 6 weeks to the day till the next meeting, and we're going to see whether what happens is it's going to be very important for the way the economy looks and the way the outlook evolves with what happens in the Middle East. That's going to be a big factor, and we'll know that then. I don't know how it's going to affect our thinking. I really don't. And we did talk about alternative scenarios a little bit, but it's just, I wouldn't bring that in here. It's very uncertain, and I just want to remember that we don't know, and we shouldn't assume it's going to be one thing or another. We're going to see.
So is it a matter of you don't know how the situation itself is going to evolve, or even if things remain as they are, the economy could still remain relatively durable in face of them?
Yeah, that's true too. No, I mean, the U.S. economy has just, made it's been strong through a whole bunch of challenges. I mean, if you go back to 2023, when we raised rates a lot in 22 and 23, and close to 100% of economists called for a recession, which didn't happen. In fact, 2023 was a really strong year. So the U.S. economy has really been just doing pretty well through a lot of significant challenges over the past few years. It's been amazing to see. And I don't know what's going to happen in the next intermeeting cycle, and I don't know what's going to happen in the Middle East. I wouldn't want to speculate.
Hi, Chair Powell. Thanks for taking our questions. What makes you so certain that tariff-related price increases will be a one-time effect? I don't think we've seen you since the Supreme Court tariff decision, and it's pretty clear that none of us know what the extent of the tariff shock will be as the administration moves to replace some of the tariffs that were overturned. So I suppose I'm curious, what would make you question this certainty that tariffs are going to be a one-time price effect?
Well, I would not at all use the word certain about my views on that. I'm not certain. I'm uncertain. But just if you think about what it is, it's a one-time increase in the price of a good, right? And what inflation is ongoing increases in prices this year, next year, the year after. That's what inflation is. It's not a one-time price increase. There's a very, very big difference. The public doesn't really focus on that, but that's the difference. And tariffs should be in theory, unless they cause people to start expecting still more tariffs the next year and still more tariffs the next year. They should be a classic one-time thing. People say the same thing traditionally about an energy price spike, because traditionally prices go up and they come back down. And by the time monetary policy would react, you would it would be over. So I don't have tons of confidence on that. I mean, I think that the theory is probably right, but as usual, the time it takes to get all the way through the economy is just very uncertain. And we found that coming out of COVID, that the inflation did go away, and largely for the reasons we thought it would, but it took 2 years longer than we thought. So I think we have to be humble about knowing how long it will take for tariffs to go all the way through the economy. And so what we've been doing, as our staff's been doing, it's very interesting. They started off with just an estimate because there wasn't a real history. And then they built, based on the history that they're seeing of tariffs coming through into prices, they can now have an arc. But you won't see further increases, and we should start seeing that more and more in the middle parts of the year. We do expect that. Now, you're also right, though, that the level of tariffs came down fairly meaningfully in the wake of the court decision. But the administration said they're going to get that rate right back up to where it was. So, and we assume that they'll do that over time. So that's how we think about it.
Thank you.
Chris Rugaber.
Hi, thank you. Chris Rugaber at Associated Press. You talked about the shortcomings of the SCP in this environment. I wanted to ask about, or throw in an additional thing, which is the fact that it's happening before transition. Is there still some value, perhaps, in the public knowing what other Fed officials are thinking, the ones who will stay on for the rest of the year and beyond? And does that even handicap your successor in any way? Well, just in terms of having a whole committee expressing its views, is that something that locks them in for the rest of the year?
No. We never. The SEP is never. People are more than happy to change their SEP dots. They're no way bound by them. It's your opinion at a moment in time, which can change based on events. Sometimes very quickly. So it never locks people in. People are more than happy to be proven wrong in either direction. And so I just think we do it. And I mentioned this was a time when it's very hard to do it. During the pandemic, we actually took one meeting off, I think. But we don't like to do that just because it's hard to do. We should just keep doing it. But I just would say for this one, though, I think it's even more than usual good to take the forecast with a grain of salt, because subject to just very high levels of uncertainty.
Brian.
Hi, Chair Powell. Brian Chung with NBC News. So you mentioned at the beginning of this conversation that you're well aware of the history of inflation running above target. It seems like that might be what's underpinning the affordability problem that we're hearing a lot about on Main Street. Are there any signs to you that that's impacting the psychology of the consumer, especially given that they're a big driver of overall economic activity?
I'm not sure what that's all about, but I'll tell you what I think and what we see in surveys, and that is, there were big price increases all around the world, by the way. Everywhere in countries like the United States had basically the same kind of thing. It was a global inflation coming out of the pandemic, and everywhere people are feeling like real wages have been going up in the United States now for 3 years, roughly. But people are not feeling good about it yet. And it will take some years of positive, real earning gains for people to feel good again, we think. But you're right. But when you talk to people, they do feel squeezed. And, there are areas where prices are still going up, like insurance. Various different kinds of insurance are getting more and more expensive, and that's just catching up really from inflationary pressures that take a while to get to into the price. So we take it very seriously. We don't dismiss it at all. It's a very real thing from the standpoint of what what people are experiencing. And what it does for us is, makes us even more committed, if that's possible, to getting inflation back to 2% on a sustained basis.
How does the Fed's independence play into the ability to address affordability?
Well, independence is what allows us to do our jobs, and stable prices is half of our mandate. It's one of our two mandates, maximum employment being the other. I mean, look at every advanced economy that looks anything like the United States anywhere in the world, in a market economy, in a democracy, and you'll see, pretty much central bank independence that looks a lot like, in some cases, stronger than what we have. But it's critical that we have that so that we can do the things when we need to do them to preserve price stability. And it's an accepted standard practice, and I think has a lot of support, certainly in Congress, which is where our oversight is in Congress. And you see that among Democrats and Republicans in the House and the Senate.
Hi, Chair Powell. Richard Escobedo at CBS News. Thanks for doing this. Two questions. One, how high would oil prices and broader inflation have to go, and for how long, for the committee to consider hiking rates? And then secondly, diesel prices are rising faster than gas prices. How concerned are you that the increase in diesel might drive up food and goods prices and lead to broader inflation?
Yeah, I'm not going to give you an example or specific answer on the first question. We're prepared to do what needs to be done, but I wouldn't want to hypothesize about what that might be. In terms of diesel prices. So your question there is, are we concerned about it? I mean,
how concerned, and whether or not it will drive up, the cost of food and other goods that really rely on it to.
So I think it's a more general concern than that. It's diesel prices because that's transportation of food and things like that. There are just lots of ways that oil and derivatives of oil get into the production and transportation of many, many things. So, and those, there are big effects in headline inflation, but things like that leak into core as well. And the effects may not be as big, but they're quite real and they're material. So we are aware of that and we're watching it, but we're right at the beginning of this, and we don't know how big you just don't know how big this will be and how long it lasts. It may or may not be something that really makes a big imprint on the U.S. economy. We're just going to have to wait and see.
Thank you.
Archie, for the last question.
Thanks very much. Just to sort of stare into the future for a little bit, I was looking at the longer run bits of the SEP and noticed that the growth estimate had been revised up a good chunk from 1.8 to 2, and the kind of long-term Fed funds rate as well. It'd be great just to hear, is that AI productivity or what's going on there exactly?
Yeah, I think it's just productivity. We actually started seeing meaningfully higher productivity some years ago, 4 years ago, 5 years ago, and that's not because of generative AI. We won't know for years what it's really due to, but it could be due to the kind of things that people did during the pandemic to economize and somehow become more productive because there was an incredible labor shortage. But I think economic forecasters are very skeptical of periods of high productivity because they're so rare and they're often revised away. And for many of us, I never thought I'd see this many years of really high productivity. And by the way, I expect it to continue. And we haven't really started to see the effects of generative AI. And that should certainly contribute to that. So it's quite unusual. And it's this is the higher productivity is the thing that allows incomes to rise over time. And so it's a great thing. Was that your question?
Yeah, no, I was just curious what lay behind that. And just briefly on that as well to finish up, you hear the argument a lot, this is a sort of disinflationary story, and if you believe that productivity thing, that should also weigh down on inflation over time, maybe then kind of pull down where rates end up. Do you kind of agree with that line of thinking, or do you think that's not how you should think about where the rates?
I think you have to be cautious about that, in particular if you're talking about AI, about generative AI. So remember, in the short term, what's happening is we're building data centers everywhere, and that's actually putting pressure on all kinds of goods and services that go into building these things. So that's actually probably pushing inflation up at the margin. In addition, it probably raises the neutral rate. So in the near term, you're not looking at something that would immediately call for lower rates or that would be lowering inflation. Over time, though, sure, it can be if it's expanding potential output, which is what higher productivity does, then it actually can be. But I think it's an empirical question because it's really what is the demand growing faster or slower than the supply side, and I think we just don't know that answer ex ante going in. We'll just have to wait and see. Thank you very much.
All right, Marco, what do you think?
Hawkish,
huh?
Yeah, I was following the DXY kept going up. USD JPY pretty close to the 160 level. Looking to sell it right after the stream. So, I mean, the things that were coming on in financial juice definitely sounded hawkish.
Yeah.
Not sure if we're going to get even one rate cut this year. I know the markets are pricing in one cut, but if the conflict drags on, it's probably
subject to change because if Powell is done in May, new Fed chair, the market might come in and test him a little bit. I think I wouldn't be surprised if the market comes to test Warsh and see like, all right, are you going to cut rates? Are you going to raise rates? Are you going to do nothing? Like what? I don't know. Maybe like this April-May window could be a really interesting kind of first 30 to 60-day test for the new Fed chair. The dot plot that is printed, probably take it with a grain of salt. I think a lot of it's going to change in the next 30 to 60 days with the next one. But like you said, currency strength-wise, dollar gets a bid today. Markets are down. VIX crossed some intraday highs. Not a ton. I mean, really, the VIX was relatively stable. I've been sitting here playing around with a couple of trades. I've got a couple of trades running into the end of the day. I'm trying to get a fill on this one. I'm just not happy with the credit. So I'm looking at like a little broken wing butterfly, maybe trying to get like a couple of dollars. I just don't know if I'm going to get it. We have the recent lows around 66.25. And this would be my break even is at 66.25. So I'm probably not going to execute this trade. I'm looking to see if these levels down here, these are all open orders. If price falls just a tiny bit more, maybe into like this 66, 15, 10 zone, I might have a bit of a profit trap in here that offers me a few $100s. If that doesn't happen, I'll just end up grabbing $50 on the day. That's fine. I played it really safe and really conservative. This is the expected move again, just kind of showing this all prepped ahead of time. I don't think that prices should necessarily be closing below 66.36 today. So I'm looking for a little short-term opportunity to get a bounce off of 66.36. If anybody's looking for a short-term trade, I just got filled. Ooh, this is going to be interesting. Oh, it's got real interesting, Marco. I just got filled for a $47 iron fly. So I'm risking $300. I'll keep an eye on this one. Let me check this out. So this is SP March 18th. So 1, 2, 3, 4. If we get a bid, this is a iron fly. So this trade just got filled. My max risk here is $3, but I can make up to $4,700. I need to see price get a bid here in the next 40 minutes. My break-even price on this trade from the put side would be 66.53. It's going to be a little iffy. Yeah, 66.53. We'd have to have a pretty good rally into the close. But if I throw $300 away, that's it doesn't.
Yeah, I mean,
doesn't
the
make it
reward
fun.
risk
But
is there.
yeah, I mean, if we come up to 66.55 or 66.60 into the close, we got a 50% ATR. Yeah, we'll see. I mean, it's a low risk, high reward setup. It did feel late in the day. If it was 350, I kind of hate this trade, but it's 322. A lot could happen here in the next 40 minutes. So like I said, don't be surprised if the market can at least muster up a little bit of courage here. If I get back to like 55 or 60, I'll make a few bucks in the iron fly. You say hawkish on Powell. I think it's classic Powell. He didn't really comment on anything with the war. He didn't, what's the word? Prognosticate, I guess, on what's going on in the Middle East. But same stuff. It's like there's inflation. We're paying attention. We care about the American people, blah, 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 blah. I'll stay in power if I have to by law. So, pretty classic Powell, but we'll see what Warsh actually deals with when he comes in as Fed chair in a couple months.
Yep.
So that was fun, man. We should do it again sometime.
Absolutely. Just before we wrap it up, I'll be putting on a sell setup on USD JPY. So for anyone that is watching, if you want to get that signal, make sure you join the A1 Discord and use the code Marco for 25% off. So it's going to come up in like 10 or 15 minutes once I write it down. This has been absolutely awesome. I really enjoyed it. It was super fun. Hopefully we can do it again. And yeah, that's about it from me.
Okay, sounds good. See everybody. Come back and join us tomorrow. Bye-bye.
Awesome. Goodbye.
Thanks again for watching today's show. Our goal at A1 Trading is to continue to share free value to our audience through daily videos and articles, keeping you up to date with the latest market coverage. If you enjoy our content, make sure to subscribe for more. From all of us at A1 Trading, have a great day, and we'll see you next time.